Good morning. It is the final trading day of January, 1 month of the year. It is gone. Markets now looking at much lower opens this morning as earnings roll in from Caterpillar, Honeywell, Chevron, and more. Plus, here we go again with GameStop. Shares of video game retailer spiking in the pre-market as two online brokerages have said that they are removing some of the trading restrictions that had been on it. And Robinhood CEO speaks out on his company's controversial decision to curb GameStop trading and on the heavy criticism from a popular online voice. Dave Portnoy has been online and has said all sorts of relatively nasty things about you and about Robinhood. One of the things that he has raised is the idea that Citadel pressured you to do this. Is that true? The answer to that question and much more of that interview with the head of Robinhood as the final hour of Squawk Box begins right now.
Good morning and welcome to Squawk Box here on CNBC. I'm Joe Kern along with Becky Quick and Andrew Ross Sorkin. And we have, thankfully, some breaking news right away. And it's not about Robinhood or GameStop. It's about Johnson & Johnson. Meg, tell us, save us, help us.
Joe, these are the one-shot vaccine results we have been waiting for from J&J from its phase 3 trial. In the United States, they showed 72% efficacy against moderate to severe COVID-19 with just one dose of this vaccine. Now, overall, worldwide, they ran this trial across 3 continents, and including in South Africa, where they had a lot of that new variant. And so overall, the efficacy is 66%, brought down, of course, by the presence of that variant, especially in South Africa. Now, importantly, the vaccine showed 85% efficacy in preventing severe disease. Complete protection, they say, against hospitalization and death 28 days after getting that shot. So you get one shot 4 weeks later. That protection against being put in the hospital or dying from COVID. Experts tell me that is what you look for in a vaccine. Now, they ran this trial in multiple countries and so did pick up that B.1.351 variant we've been hearing about from South Africa, and 2 cases were just detected in the U.S. yesterday. So the efficacy regionally really varied. In the U.S., 72%, Latin America, 66%, South Africa, 57%. Now, J&J tells me it plans to file for emergency use authorization with the FDA next week. Remember, this is a one-shot vaccine. They're going to be packaging it in a 5-dose vial. It can be stored in the fridge for 3 months at that regular fridge temperature. So a pretty easy shot to then put right into the supply chain, guys. 72% efficacy in the U.S. Really interesting data just because of all of these different variants. You see J&J down there, 3.6%. But guys, folks that I'm talking with focus on severe disease and the fact that you can prevent severe disease, hospitalization with one shot. One shot. That's a big deal.
If you did a one-shot analysis of Pfizer and Moderna, you'd be 50% probably, right, Meg? So, I mean, you need to take all of that into account. I'm not telling people what to do with the stock, obviously, but it's nuanced, and there's pros and cons to the J&J versus the Pfizer and Moderna.
There absolutely are. I mean, we know with Pfizer and Moderna, they're 2 shots, either 2 or 3 or 4 weeks apart. And with Pfizer, particularly, you have to keep it ultra cold. Moderna's has to be kept quite cold as well. Those are tricky. And, J&J is running trials of 2 shots in different countries around the world. So they'll have those data as well. But the ability to roll out a one-shot vaccine that can just be, put in the fridge for 3 months, that's just very easy. The questions are going to be, about supply. We don't know exactly how much J&J will have immediately whenever it gets EUA from the FDA. We'd heard from Moncef Slaoui approaching 10 million doses in February. They wouldn't confirm that to me. They've just said they'll meet their supply commitments, which are 100 million doses to the U.S. by the end of June. So we'll see how fast this can really help with our response. But being able to keep you out of the hospital and protect you from the severe effects of this disease, that's what vaccine experts say is important for vaccines.
Hey, Meg, let's try and compare this because J&J has been running these trials under different circumstances than Moderna and Pfizer were. Moderna and Pfizer, we saw 95% efficacy, but that was before you saw these other strains that are going around. Now, we did hear from Moderna that there is less effectiveness when you start throwing in the South African strain, but I don't know how to match that up to efficacy levels like you would be looking at the 57% or whatever it was, the efficacy for this J&J vaccine in South Africa. I mean, what did they say? It was like six-fold fewer, or six? What was the for Moderna when
yeah, the titers were
the South
six-fold
African
lower.
Vaccine was. So what does that mean in terms of
but
efficacy?
The problem is,
how can we match that up?
We don't know exactly. So we don't know exactly what level of antibodies you need to provide protection, to have that correlate of protection, to be able to make that calculation. People are, of course, trying to do that, but without actually testing these mRNA vaccines against the B.1.351 variant to see how well it protects against disease, we just don't know. I mean, we might get those correlates of protection fairly soon and be able to try to make those calculations, and that is probably going to be how new versions of vaccines are evaluated, just because we won't be able to keep running these giant efficacy trials that take months and thousands of people. So once we have that information, they'll be able to make decisions about how to get these new vaccines going. I mean, talking with J&J, they've already started looking at new potential vaccine constructs in case they needed to before they saw these results. And what we might be seeing from all of these companies is potentially multivalent vaccines, vaccines that protect against multiple strains in the same vaccine. We have that with the flu shot, and we could see that here as well.
Yeah.
Just because this virus does mutate, and especially when we give it the opportunity to, and we don't bring case numbers down.
Yeah, with the flu, I always look for the quad shot, the one that has the 4 different strains every year, so you can get the most protection out of it. Just in terms of what this means for the FDA, originally, before we had anybody who had crossed the finish line with any of these things, we were told, I think, 50 to 60% effectiveness would be what they'd be looking for, that would be enough to say, okay, that's about as effective or maybe more effective than the flu shot in some cases. So it seems like these numbers would potentially get the FDA to go ahead and grant emergency use authorization, right?
Yeah, I mean, we'll have to hear from the regulators, obviously, and there is an NIH briefing going on right now with Dr. Fauci and NIH Director Dr. Collins, so we'll get to hear how they are thinking about the utility of this vaccine. But the bar was 50% originally before we knew how well these vaccines could work. The mRNA vaccines came in at 94, 95% protective, but of course those trials were run 3 to 4 months ago where, you know, it was a different environment where we didn't have these variants circulating. And so I'm told it's hard to compare apples to apples, but 72% in the U.S. and that 85% protection against severe disease, including in South Africa, I should say. So that was not diminished by the South African variant. So that's a big deal.
The hospitalization and severe disease was not reduced even by the different variants?
That's right. And that's pretty remarkable. 85% overall that's worldwide protection. Yeah, it is. Thanks for helping me clarify it.
Meg, thank you. It's really good to see you this morning, especially with great news like that.
Thank you.
Okay. Meantime, Robinhood has now confirmed to CNBC that it restricted trading in cryptocurrencies as the price of Bitcoin rose sharply. Earlier today, users began reporting that Robinhood had halted instant deposits for crypto purchases, meaning they could only buy digital currencies with funds already deposited in their accounts. Now, new deposits can take up to 5 days to clear. Robinhood told CNBC it made that move due to extraordinary market conditions. Separately, Coinbase says it is looking into site outage issues itself, and we're going to monitor this situation. Bitcoin, as we've been talking about all morning, has risen dramatically after Elon Musk placed a hashtag Bitcoin in his bio on Twitter, leading to a mini frenzy that took place overnight. But as we're watching these frenzies take place within social media and then on these apps and on online brokerage accounts, it seems to be raising all sorts of questions about whether the system unto itself can handle it. Yeah, Joe?
Yeah. Anyone tweeting Elon greater than Ray? Did you see any of that? You know, Dahlia said some stuff yesterday, and Bitcoin was like, Nothing.
Ray was a little bit more reticent.
I know. But Elon says it, and it's like it's like a SpaceX rocket taking off. Dalio says it, and people are like, really, Ray? 5 years late. Anyway, let's get to the stock story dominating investors' attention all this week. The surge in the shares of GameStop and moves yesterday by retail brokerages like Robinhood to restrict trading. GameStop is much higher this morning. Both Interactive Brokers and Robinhood are planning to ease trading curbs today. This comes after Robinhood said yesterday it was raising more than $1 billion from existing investors. It also drew at least $500 million on a line of credit from a group of banks in order to meet lending requirements from its central clearinghouse. And in an interview with Andrew Ross Sorkin on CNBC last night, Robinhood CEO Vlad Tenev said his company had stopped allowing users to buy shares in GameStop and 12 other stocks to protect the firm and to protect our customers. That move, though, sparked outrage among active traders in GameStop, like those in the Wall Street Bets Reddit forum. One of the questions that's now emerging is whether Robinhood was right to protect its customers or if it unfairly denied them their right to choose how they deploy their own money at a critical moment. But we also now know that it wasn't just that. It was about protecting the firm. William Galvin is Massachusetts Secretary of State. Kevin O'Leary is chairman at O-Shares ETFs, Shark Tank co-host, CNBC contributor, rabid libertarian, free marketer, has no problem with any of this, and even says if they lose all their money, they need to learn. That's not the first time you've said something so callous and unfeeling, O'Leary. We'll get to that in a second. Let's start with the Secretary Galvin, though. Should regulators, is there something that needs to be done based on what the events of the past couple of weeks, Secretary?
Absolutely. No question about it. First of all, the whole issue here is not simply about an individual company or an individual issue. It's about the honesty of the marketplace and the reliability of the marketplace and the danger a defective and dishonest marketplace has to our economy. We're at a time of contracting economy. Having this type of activity going on the way it is just unacceptable. There's no doubt. The one thing that everyone in this discussion can agree about it, there is no reality to these trades and these issues that we've been speaking about. They're not based on anything other than speculation. And clearly, when the market is engaging in that type of conduct, that is not good. I think it's a broader question, though. I think the whole issue of shorting has to be addressed. Whether shorting, whether it's by hedge funds or anybody, is in the best interest of the market. Clearly, shorting is going to go on, and we need to have shorting as a defense in the marketplace. But there should be some restrictions on shorting. Maybe it's on the uptick. There needs to be a review by the national regulator on shorting in the marketplace. Having said that, in the short run, no pun intended, it is extremely important, I think, to get control of the marketplace back again. I voiced my concern the other day about the effect on unsophisticated investors. Obviously, some of those who think they're sophisticated took offense at that. I'm concerned about the marketplace, though, and I'm concerned about the spillover effect of all of this activity on other aspects of the market, ETFs, other aspects of the market, which weakens the overall situation. This is not a good time to be playing these games. The national regulator needs to get involved here, and promptly. In addition to that, I think, as I suggested previously, if we didn't trade in these types of issue at all, this particular one I was speaking was GameStop, for a period of time, I think that would have an effect. I'm not just talking about those who trade through Reddit or individual investors. I'm talking about people across the board. There needs to be a review of this entire conduct. This is extremely dangerous to the marketplace and dangerous to our economy.
What do you think, Kevin?
I don't agree with any of that. The truth is the market has always been a speculative place. No, but I think you have to hear the other side of this, Bill, because at the end of the day, there's some very powerful forces in play here that are actually good. So let me take a shot at it. The definition of the market is speculation. When you buy and stay long a stock, you're speculating the profits you hope are going to come finally appear, and you take that risk. The best thing we could do for this market now is leave it alone and just shine the light of transparency on it. If you are short, let it be transparent. You now run a new risk that these effective social media vigilantes are going to come after you and squeeze you as a short. That's going to make a lot of hedge funds think a second time before they try and go short stocks, which I think is great. But here's the point that I think everybody is missing. 4 or 5 years ago, we had 100 million Americans with nothing set aside for their retirements. We still do. And that's because our educational system, including the one in Massachusetts where I had my kids and they grew up in, best schools in the world, I would argue, they taught them nothing about investing. And then along comes a platform like Robinhood, and all of a sudden, kids in their 20s and 30s that would never get touched by Money Center Bank or an online broker because they're not a profitable account. They only have a few $100s to invest. Vlad and his team create this platform and now have millions of people learning about the ways of the market. And the market, even for sophisticated investors.
They're learning by losing, though. They're learning by losing.
Every investor loses money, Bill. Every loser. Everyone learns from the market.
I don't think we...
So you're going to protect me from losing money? Are you kidding? Speculation is the definition of the market.
I don't kid.
Yeah, the bottom line is when you put money in harm's way in the market, you risk it. That will always be the way after both you and I are gone. And the more regulation you put on it, the more you hurt it. Because some people to investing a millisecond is an investment, and others 10 years. And you shouldn't have the right to define it for them. Let the market do that. That's what the market does. If we want viable capital markets, you have to let the market be the market. Just shine transparency on it. Don't try and make rules that have all kinds of second consequences that you can't determine at this point.
There is no transparency. There is no transparency here. There is
it's more transparent today
in many aspects.
You can't say that what happened over the last 48 hours, the last two trading sessions, wasn't driven by transparency. We've never had millions of people at night talking to each other in social media saying, there's a hedge fund that's short, let's go get them. You know, you want to stick it to the man, I have no problem with it.
Being made. The problem is, in order to have transparency, you have to have some certainty. And there is no certainty in any of this. There's wild speculation based on nothing. That is not an honest marketplace.
I'm sorry, but you're going to have to live with speculation. You're always going to have
speculation. I can live with based on rationality. Rational speculation is one thing. Dishonesty.
How do you know that GameStop executives aren't going to take advantage of this situation and build a brand and make a pivot, just like Netflix did when they were shipping out CDs in the mail? You don't know.
Because they've shown
you have no idea. Either do I.
They haven't even raised any capital on it. If they were going to be doing that, why wouldn't they be raising capital now to try to do that? They're not.
Well, maybe they will. We don't know. That's the market. My whole point is if they can raise capital at these prices, they should.
What I do know is many people who are investing in this have absolutely no idea why they're getting into it. They just think it's a train they don't want to miss. And I fear many of them will lose. I also think it's going to have effects on other aspects of the marketplace. This is not healthy for our economy at this very fragile time.
Hey, Secretary Galvin, you might like this, Kevin. Back in 1982 when Apple came out, I guess, are you familiar with this, Secretary Galvin, that Massachusetts didn't want anyone buying?
Yep.
They wouldn't let anyone buy the shares of Apple because they were way too speculative, and they thought people might...
That was before my time.
I know.
I'm not sure
is that not... Well, I mean, is it that when things go absolutely bonkers and a state, a nanny state or whatever you want to call it, gets involved...
Well, it's not a nanny state. I mean, giving people honest advice...
Well, you can't protect everyone from everything,
It's not. We have a reputation and a deserved one of protecting investors. We believe in honesty. That's what we want. Yes, we want transparency. But when you're enticing people who have very little idea what they're doing, as some of these entities are, to invest in things that have no rational basis, that is not good. It does call for a national
Who decides what's rational, though, Secretary? I wouldn't want a politician deciding that, or...
Well, I think regulators
Bill,
who are... It's not necessarily a politician. That's why we have a Securities and Exchange Commission.
You have every right to voice your concerns, along with the hundreds of millions of other people that are on social media voicing theirs too. And let the collective decide. That is the definition of the market. The beautiful thing that we call the market that is the envy of the world, where people raise money and start companies. Leave it alone. Let it do its thing. That's exactly what it should do.
Kevin, let me just ask you this, though. If this goes wrong, and I think it's almost impossible to think that it won't, the quote-unquote speculators never blame themselves. They don't. And I imagine you will also find, on top of this, some levels of fraud people taking advantage of people throughout this process. So the question is, do you believe that the American public is, quote unquote, responsible enough and is willing to demonstrably accept the losses, and therefore there should be no, this goes to the social safety net and everything else. If people start filing for bankruptcy, who is supposed to pay their bills? Are taxpayers supposed to pay their bills? We as a country have tried to, I mean, the lessons of the financial crisis seem to be turned on their head in this instance. There have been this emphasis on trying to protect the little guy, and now everybody's saying don't protect the little guy, because by protecting the little guy, you're protecting him against the big guy, right? And it's sort of this unique dynamic. It's very hard to try to understand what the right answer is, but I think the answer is you are supposed to protect the little guy in the end from losses that they can't afford. You think that's not fair?
No, I think what's more important is that they educate, that they learn the ways of investing that they're going to need later in life to support themselves in retirement. And frankly, I am not a fan of saving any business. I hate the PPP loans. I hate the bailouts. I don't want any of that. I've said that many, many times. The only people I want to protect now with the capital we're printing are people that are unemployed while our economy shifts and turns into the digital behemoth it's about to become. I don't want to support airlines. I don't want to support AMC. I don't care if GameStop goes bankrupt. And I really don't care, Andrew, if a few hedge funds go to zero. Who cares? I think it's great.
No, I'm not talking about the hedge funds. The hedge funds. But what happens with the kids who are taking the stimulus checks, putting it on margin, and could eventually be filing for bankruptcy?
Oh, no, Andrew, they're learning how to be investors. They're learning about the risk of the market. Oh, no, that's a horrible thing. We forgot to educate them in high school, so let them learn in the real world, which is even better. I support Vlad. I support Robinhood. I think this is fantastic what's going on. Leave it alone. It's a great thing that's happening here.
Obviously, I disagree. I think you're putting the marketplace at risk. I think by introducing this type of wild speculation, you're putting our economy at risk at a very fragile time. I think it demands action by the national regulator, and I hope it happens very quickly.
Okay, we'll end on that note. Secretary Galvin, thank you for making your points. Kevin O'Leary, I don't know. You just need to just be more strident about things, and you know, all this so wishy-washy all the time. You got to tell us what you really feel next time. Can you do that? You're free to do it.
Absolutely, Joe. Oh, okay. You know I love doing it.
God, we love having you too. I could use you on about. I put anyone in Secretary Galvin's seat, and I'll stick you on the other side, and I know that we're going to have a good conversation, and that's what we're looking for. It's cable. Anyway, and this extra, thanks guys, thank you. And this extra note, got a money dispute? Kevin wants to hear all sides and help you determine the best way forward. Go to cnbc.com/money dispute and tell him your story. And another note, don't miss the former chairman of TD Ameritrade, Joe Moglia, right here on Squawk Box on Monday morning at 8 a.m. Anyone noticed how great, I mean, Coastal Carolina, they got great at football. They even got good at basketball. I don't know what this guy did. So I don't know. He runs companies. He runs college NCAA sports teams. I mean, Coastal Carolina was the real deal. He wasn't there anymore. I don't think. But I think it's his program.
The Moglia
basically.
effect.
Yeah, the Moglia effect.
Yeah, it's the program he set up, and he did wonders with it.
Unbelievable.
Guys, I want to get back to the news that we just got on the efficacy of Johnson & Johnson's COVID-19 vaccine. This is pretty important. The market is trading this down. It's a Dow component. They don't like the efficacy numbers because I'll remind you again, it was 72% effective in the United States, 66% efficacy worldwide. And that's because they are testing right now in areas like South Africa and Latin America where you're seeing these other strains. Those strains weren't there when you had Moderna and Pfizer that were out doing their testing. Dr. Scott Gottlieb was tweeting about this, and I think this is important because Dr. Gottlieb, of course, is the former head of the FDA. He's also on the board of Pfizer, which is a competitor of Johnson & Johnson. But this is what he says. The J&J vaccine turns in a fantastic result. We now have 3 highly effective vaccines. This vaccine, J&J's, showed sustained and increasing immune protection over time, perhaps from a robust early induction of memory immune cells, CD4 and CD8. The protection was strong and durable. This one-shot vaccine was highly effective at preventing severe disease, even with the new variants. The milieu of disease is now more complex. Even in the U.S., trials done today are running into more mutated cases. Make no mistake, this is an important and wonderful development. And I think this is huge news because there are so many people who thought, okay, what are we going to do when it gets down to, will you take a shot that's less effective? Will you take that vaccine? And I'm saying this as somebody who's probably likely to get the J&J vaccine at some point. I'm not going to qualify for a Moderna or Pfizer's shot anytime soon because of where I fall on the line. I would get that shot, even with 72% effectiveness or efficacy, even if it was lower than that, because the idea that it's preventing severe disease and keeping you from the hospital, that sounds like a pretty good deal when you are sitting around waiting. Would I love to have one of the other ones that has tested with higher efficacy? Sure. But if it's a question between getting this one now or not knowing when I'm going to be able to qualify for an appointment to get the others, I would take it. I had a family member who tested positive for COVID this week. Time matters when you're looking at some of these things. This is one shot, not two shots that have to be spaced out over 3 weeks, so you're talking about 6 weeks before you get the effectiveness. I would take it because we're at that point in this pandemic right now.
It's an unbelievable situation, Becky. It's an unbelievable situation to watch this, and people are going to be trying to figure out which ones they want to take. I imagine there's going to be bits of races for different ones at this point, but it's a positive. No question, it's a positive for humanity, hopefully. Meantime, on the other side of this break, more of my interview with the CEO of Robinhood on this GameStop saga, including his response to heavy criticism from Dave Portnoy of Barstool Sports. Plus, there's growing reaction in Washington to the drama as well. Top Republican on the House Financial Services Committee will join us on this topic. And new this morning, Robinhood restricting Bitcoin trading from instant deposits. You can check out Bitcoin jumping this morning. It was up as much as 20% at one point on the back of a comment by Elon Musk adding the hashtag Bitcoin to his Twitter bio. He also posted a cryptic tweet. In retrospect, it was inevitable. Was he talking about the run-up in price there? We'll talk about it when we return.
Enterprise Artificial Intelligence has the power to transform the most all thanks to 1 billion predictions per day. C3.ai is AI at a global scale, harnessing the power of data to build a better future. C3.ai. This is Enterprise AI.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC. Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Rocket Company CEO Jay Farner on housing and what it's like to have 30% short interest in your stock. Plus, Congressman Patrick McHenry on Washington's flourishing interest in retail trading platforms. Stay tuned, everybody. You're watching Squawk Box, and this is CNBC.
As the Pakistan economy climbs its way out of the deep COVID hole, gradually the fiscal policy is also shifting towards greater restraint, while the monetary policy settings continue to be accommodative to support the emerging recovery. We think this is the right mix of macroeconomic policies to help Pakistan.
Welcome back, everybody. We've been tracking the wild price moves in GameStop, AMC, Bed Bath & Beyond, and some of the other names out there. All of that activity is also impacting shares of publicly traded brokers. Our very own senior markets commentator, Mike Santoli, joins us right now. He's got more on that front. Mike, good morning.
Morning, Becky. Yeah, it just sent tremors throughout the market, made some big investors feel a little bit offsides for this level of volatility, even though it has not been all that volatile. We have sort of, this is a 6-month chart of the S&P 500 index fund. We kind of lost that really orderly, predictable uptrend that we had. Wednesday's low in the S&P 500 is just under 3750. That would be about 375 for this. So you're going to be playing with those levels. I think it's a matter of repositioning, working against pretty good macro sentiment. The bond market's not really showing a lot of stress. That's probably a positive. Let's look at those brokers, though, because the retail brokers are serving massive volumes right now. We're seeing the news with Robinhood having to go raise a little bit of liquidity just to be able to backstop a lot of these trades. And what this shows you is Interactive Brokers, Charles Schwab, and Morgan Stanley, which now owns E-Trade, they have rolled a little bit. Even though you have these huge volumes, it's a really cost because people are paying zero commissions. So there's a lot of friction, a lot of capital requirements. And it's not as if it's a disaster for the firms. Ultimately, it's good to have your customers be very active in doing a lot with you. But in the short term, it's a little bit tough. Meanwhile, Virtu Financial, which is an electronic market maker, a middleman, handles a lot of the trades for these firms, has actually perked up because the volumes and the volatility and the opportunities to play these different price moves are a tailwind for a company like that, guys.
Okay. Mike, thank you for that. Just want to mention, we're seeing some comments crossing the wires from Dr. Fauci in regard to the J&J news this morning on this vaccine that appears to have a 72% efficacy demonstrated here in the United States. However, and this is where things get a little bit more complicated. You're looking at the stock down because of what they're seeing in South Africa. And this is having some people nervous, including Dr. Fauci, who's saying we can see we are going to be challenged, given what's happened in South Africa with that new strain. It's really a wake-up call for us to be nimble and to be able to adjust as this virus will continue for certain to evolve and mutate. He calls it a wake-up call. and that, of course, weighing on Johnson & Johnson. And I think there's going to be some questions about how investors are going to be thinking about this as well, given this mutation and how significant it may or may not be. We're going to continue to follow this story throughout the rest of the program. When we come back, though, we're going to talk to the CEO of Rocket Company, as shares of his personal experience heading a firm that's seen its fair share of stock shorting, plus housing in 2021 and beyond. Stay tuned. You're watching Squawk Box on CNBC.
I heard you guys have Workday now.
Yeah, they're a great partner. They're always there with insights and guidance. It's like having a business caddy.
Who can run Detroit? The VP there is well qualified.
We can staff Detroit from within.
You good for golf on Saturday?
Can't. Closing the books.
Team's already finished. Took half the time.
And I'm back in.
There's an opportunity in New York. Not this quarter.
Workday, a finance, HR, and planning partner like no other.
The countdown to the open of the US markets is sponsored by IG.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
On the next Managing Asia, a one-on-one with Hong Kong property magnate Adrian Cheng.
We have now 4 production lines that will be in production end of April, early May, in producing around 7 million masks per month when the number of viruses is going down. And we're seeing a very big V-shaped rebound in April, especially in the retail sales as well.
How much more do you think this pandemic will weigh on the Hong Kong property market? Adrian Cheng, Executive Vice Chairman of New World Development, on the next Managing Asia.
Welcome back, everybody. In 2020, we saw the housing market grow despite the COVID-19 pandemic, actually in some cases because of it. In fact, a nice chunk of that growth was because of the pandemic as people sought more space outside of cities. Investors are now wondering if the market growth will sustain in the new year. And joining us right now to talk about that is Jay Farner. He's Rocket Company's CEO. Rocket Companies is the largest mortgage lender in the United States. By the way, its stock has seen quite a bit of shorting, so we're also going to ask Jay about that too, just in light of this week's huge moves in GameStop. But Jay, welcome. It's good to see you. And why don't we start with the housing market? How are things doing right now?
Yeah, good morning, Becky. Well, great question, and actually ties into the comment that was read before the break from Dr. Fauci about the concern over the vaccine, and I think we're in this for the long haul, and that ties into the housing market. There's less than, I think, about 2 months worth of inventory out there right now. Demand for housing is tremendous. It's the highest it's been in over 15 years, and so we imagine 21 is going to be a very, very strong year for housing.
You know, there's been short supply, and we've also had incredibly low interest rates. What do you see on the supply front changing potentially any of that? And how have things happened with interest rates? We saw interest rates start to pick up a little bit before the 10-year fell back below 1%. Did you see any impact on what that meant for either mortgages or refinancing?
rates are incredibly low and the payments are great as well. So a little bit of movement here or there really hasn't affected people's desire to buy. I think that you're going to continue to see technology play an important role in housing in 21, opening up inventory, encouraging people. We own forsalebuyowner.com. You're going to watch more people think about selling their homes that way. And so with that technology, hopefully we'll get a larger amount of inventory. And with low interest rates, we'll see housing continue to grow.
Jay, I always wonder what happens with this because you guys are the biggest right now, and you've grown every single year, gotten bigger and bigger and bigger. I know your expectations or your goal for what you're looking for market share is, what, 25% by the year 2030?
Yeah, we've said 25%. I mean, look, our mission here is to continue to grow out our platform. We've just announced our broker directory that we put on rocketmortgage.com. We've got over 43,000 brokers we're partnering with. We've got our thousands of retail loan officers. We've got our thousands of insurance agents and real estate agents that are working to originate Rocket Mortgage or refer clients to Rocket Mortgage. And so, you know, our mission has been to grow that funnel, and really any way that a consumer wants to get a mortgage, a refinance, or a purchase, we're here to assist. And that's really kind of how we think about the future and how we're going to grow that market share and reach, whether it's 20, 25% or beyond. It's really about becoming that tech and client experience platform that empowers anybody in America to get a mortgage or buy a house.
What happens if the housing market turns down on a national level like it did back during the Great Recession, or what happens if, you know, there are problems because interest rates rise pretty rapidly? What would that mean for you?
Well, that's why we've got to diversify our ability to reach clients. Even in a down market, you'll see somewhere close to $2 trillion of mortgages to take place between purchase and refi. And so with that reach, with our brand that we're investing $1 billion a year plus in, including the Super Bowl Square promotion that we're doing right now, we've got the ability to grow market share. That's what we've demonstrated in the past. And if you look coming out of the Great Recession, that's exactly what we've done. And so although it can be a bit painful, of course, as we see interest rates rise or a shift in the housing market, usually what that means for us is our ability to grow and take market share because our competitors aren't quite as efficient as we are when it comes to acquiring clients and taking care of mortgages. And the other thing, Becky, of course, is the additional businesses that we've added to our platform. So whether it's our Rocket Homes real estate business, our Rocket Auto car business, they're selling thousands of used cars a month at this point in time, our personal loan business, Rocket Loans, we've got the ability to take care of clients in other ways in addition to mortgage.
Hey, Jay, you guys don't have any specific news this morning, and yet your stock right now is up by about 13%. We've talked an awful lot about GameStop and the other companies that have seen Reddit kind of really boost their shares and go after short holders, or the shorts in those stocks that are heavily shorted. You guys had a pretty significant short. I think as of the end of the year, it was 30% or something. Why is your stock up this morning? What do you think about what's been happening with Reddit?
Yeah, it's an interesting week, and as we have come out as a newer company to the public markets, I think there's always going to be a little bit of a tendency for the shorts to show up. But I'll remind everybody, between myself and our founder Dan Gilbert and our leadership team, we own 95% of Rocket companies because we feel so strongly about our ability to grow. We've been growing for 35 years. We've shown consistent ability to grow and be profitable in any kind of market cycle. And so I think the more we tell our story, the more we explain to folks the platform that we're building, you'll see our stock continue to do the right thing. The other important component, and you just pointed this out, we got a lot of retail investors in our stock. It's one of those stocks that people understand. They get a mortgage. They know the experience. They're familiar with Rocket companies and Quicken Loans. And so I think what you're seeing is they're participating at a higher rate than some other companies. And I think that bodes well for our stock.
Are you happy to see the retail traders chase out the shorts?
Well, like I mentioned, I feel really strong. I've been here 25 years. I know all the things that we're doing. I understand the power of the platform. I understand the profitability we're able to drive. And so, my advice would be that this is not a stock that you want to be short in. You might want to rethink your position if that's how you're playing it. We've got a great track record and a lot of exciting things we're working on.
Jay, I want to thank you for your time today. Always good to see you. Again, we'll keep a close eye on this, and we hope to have you back soon.
Yeah, thank you so much.
Thank you. Joe?
Thanks. That coming up, the latest on DC's plans to look into markets and retail trading. House Financial Services Committee member Patrick McHenry will join us live. Stay tuned. You're watching Squawk Box on CNBC.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The Brave Ones, Blake Mykowski. CNBC.
Coming up when we return, Robinhood CEO on yesterday's contentious decision to restrict GameStop trading. Plus, his response to criticism from Barstool Sports' David Portnoy. Stay tuned. Squawk Box returns right after this.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
to Squawk Box. Robinhood CEO Vlad Tenev speaking out as we conclude a wild week of trading in names like GameStop and AMC. In an interview last night, I asked Vlad how concerned he is and how concerned really customers should be about the robustness of his own system right now.
Well, to be clear, this was the system working. We have the ability to restrict buying in symbols for unprecedented market conditions such as this. And to be clear, we didn't shut down the system. We shut down buying for these 13 stocks, for these 13 securities, but customers that held positions could still sell, and customers still could buy and sell the thousands of other securities on the Robinhood platform.
But when you look at the precipitous fall, for example, of GameStop today, do you think that Robinhood bears any responsibility for that?
I can't comment on, price action of securities, and probably it would be inappropriate for me to do that. And also, I should note, Robinhood wasn't the only firm to restrict buying in securities. Other brokerages have been restricting the buying and trading of these types of securities all week, and even today. Of course, we get the lion's share of the attention since we've been the cognitive referent for retail investing in America, but other people are dealing with these challenges as well.
I think it's fair to say that the system, in truth, did not truly work, but maybe prevented a true liquidity crisis from taking place. Meantime, we're showing you images right now of Barstool's founder and day trader Dave Portnoy, because he was blasting Robinhood online all day yesterday, and he alleged that perhaps Citadel pressured Robinhood to partially restrict trading in GameStop and other stocks. And I asked Vlad Tenev to respond to that accusation.
Completely false. Yeah, that's complete misinformation. That did not happen. Hopefully I'm being clear about that. Nobody pressured us. We didn't do this at the direction of a market maker that we route our orders to, or any other financial market participant. No, this was an internal operational and risk management decision that the firm made so that we could protect the firm and protect our customers.
Do you believe, though, that Citadel knew that you were going to have to take these steps and effectively ran in front of it?
I can't really comment on. I don't think so. That seems another one of those misinformation and conspiracy theories. Certainly, we made decisions based on the financial requirements, including SEC net capital obligations and clearinghouse deposits that brokers have to comply with. And Robinhood was not the only broker that restricted buying of these securities. This has been unprecedented activity, concentrated in a few names, and it's really the first time that I've seen where social media and financial services have intersected in this way.
Have you gotten calls from the SEC?
I probably can't comment on specific conversations that we have had or are having, but our team is in constant communication with our regulators and agencies, and working very, very hard to reopen trading to reopen buying in some of these securities as soon as we possibly can.
You can see the full interview right now on cnbc.com/pro. Joe?
Thanks, Andrew. For more on how Congress plans to investigate the new world of retail investing that's emerged in the last few weeks, let's bring in North Carolina Congressman Patrick McHenry. He's the ranking member of the House Financial Services Committee. So what will you look at? Will you look at the ability to short 140% of the outstanding shares, or will you look at the Reddit mob, if you will, that decides to squeeze the shorts and act in a concerted way to drive the stock higher? What's more important, Congressman?
Well, I think first we have to ensure that existing laws were adhered to. And then the second question is, what antiquated regulations or laws would need to be looked at that perhaps enhanced this event? And so, in particular, what I'm thinking is about the use of technology, the broad innovation, the democratization of capital that we've seen in our heavily regulated industries of financial services. This broad desire of average everyday investors to get access to more sophisticated, more interesting products. And it appears to me that these investors were pretty sophisticated in their action. And so I want to look at those antiquated rules like the accredited investor standard and other things along those lines to ensure that we're not cutting people off from additional access to markets and therefore leaving them to activities like we've seen with GameStop and a few other tradable securities.
You can always make the case that trying to drive a company out of business is untoward and nasty and shouldn't be done. I mean, there are some people that think stocks get overvalued for whatever reason, and you know, obviously there's a long side and a short side to everything. I'm just wondering if the Reddit, WSB, if the website, WB, whatever it is, if it went after a company the other way, let's say there's a company that all these guys and gals decided that they didn't like, and they did a concerted short attack on a company. Is that democratizing the markets too? Would that be viewed the same way? Because they're able to say in this case that these nasty hedge fund guys were trying to destroy an American company and we're just trying to buy it and, you know, make it viable. What if they went the other way?
Well, look, if it's a pump and dump or market manipulation event, yeah. But I mean, if in essence you see movement regardless of the direction, we have existing laws about that. Right? Okay. We have existing laws about that. And
how do they apply to this with the intersection of social media and chat rooms and all acting in concert to do this?
Well, look, I mean, it's like saying that the fax machine, the telephone, Twitter, Facebook, that we were going to ban these technologies so that people can't have this type of communication. You can't put technology back in the box. Innovation's here. We have to embrace it. We have to broaden access to our markets. We have to broaden access to our financial products. We have to speed the pace of settlement, a number of things like that, so we can meet the real-time needs of average everyday people. What I'm seeing here is this larger case, which is average everyday investors are cut off from the access that insiders like C-suite members of companies and hedge funds and private equity naturally get. And that accredited investor standard has bifurcated our markets into a highly prosperous lot and then the rest. And so let's fix that problem so you can actually have these capital flows go to the useful and best place. Final thing I'll say here, Joe, is that people should not invest money that they can't afford to lose. I think that's very, very important. Buyer beware here. We're not sure how this thing ends. But what we need to know, what we need to respect, though, is that these are people that are making decisions with their own money. And as a government official, I should be telling them how to do that.
All right, Congressman, I just wonder, bipartisan, what it's like, because your views are certainly different than some of the views I'm reading from the other side of the aisle. And as usual, I don't know where, you know, what the two sides can agree on. But obviously, the market's got to stay free and open, and we all want that, Congressman. Thank you.
Absolutely. But everybody's seeing what they want out of this thing, sadly.
Markets have to live free or die, Patrick McHenry, right?
Proudly.
Right. Okay. There's some other guy. Your uncle, maybe. Anyway.
Hey, Joe.
Yeah, go ahead.
Hey, Joe, I don't know if you're seeing this, but talking about a sea change in the world about shorting and what's happening to short sellers, Citron Research now just out saying that they're discontinuing short-selling research. After 20 years of publishing, Citron will no longer publish short reports. Wow. We're going to focus on giving long-side multi-bagger opportunities for individual investors. So you want to talk about effects? Wow. There's one.
What a week. Well, nothing will happen in 2021. We know that. Now that 2020 is over, it's going to be quiet. Anyway, have a great weekend to you both. Let's do it again next week. Guys. And make sure you join us. Squawk on the Streets next.
Your
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. Kramer has the morning off. Futures are off the lows, but still weak as this final day of January happens. Three big baskets of news: the Reddit squeeze, corporate earnings, and now J&J with vaccine data that Dr. Fauci calls a spectacular result. Our roadmap begins with the retail trading frenzy. Shares of GameStop, AMC, and others surging once again as some trading restrictions are lifted.
Plus, what traders, Reddit users, and regulators may do next in response to this short squeeze saga of the week. And COVID vaccine hopes. J&J says its shot is 66% effective, but may fall short against variants. And Novavax nears 90% efficacy in its phase 3 trial. Good news on both, as you said, at least, according to Mr. Fauci. Certainly, Carl.
Yeah, David, and also Scott Gottlieb calling it a, let me get it right, a wonderful and important development. We'll get to J&J, obviously. But, David, I mean, you got to start to take the week in stock and talk about the degree to which this debate over market structure and these short dislocations are depressing sentiment. And we'll see to what degree they drive de-risking in other areas.
Yeah, that is a great question in terms of what the impact is on the broader market at this point. We've been so focused, of course, on some of these names. They are, as you see, soaring again, in part because people are going to be able to buy them on many of these platforms, certainly the Robinhood one, Carl. And that's kind of where I've been focused because it's fascinating. I mean, there's so many different parts of the story that are interesting that you can go down and do a lot of reporting on, whether it's the hedge funds and the health of some of them or lack thereof and what the losses are there and how that business may change in terms of the willingness of anybody to do work on an individual name and be known as sort of being short that stock. And that may not be the case. You heard Andrew just talking about Andrew Left, noted researcher on the short side, closing up shop essentially is what that is. Obviously has taken significant losses, one would imagine, as well. So there's that part of it. And then there's Robinhood, you know, this platform that has only come to the fore over the last couple of years, incredibly popular. Its CEO on that interview last evening with Andrew pointing out that it has been #1 in the App Store the last few days. So many new accounts. And yet, what do the risk management profile look like for that company? What is its ability to mitigate risk when you've got this kind of volatility and you've got settlement that is days away? You've got people who are obviously on margin. How many accounts are negative equity as a result of that? What's the concern in terms of insolvency at a company like that? They took in the $1 billion, as you saw today. So, you know, Carl, there are just so many moving pieces here. We're trying to keep an eye on all of them, and then you get into the political response and the losses on the amongst the Reddit users and everything else. But the Robinhood part, I guess I would say here, and we can talk more about it. And I know Morgan's got plenty on the options market and things of that nature, Morgan. But don't expect that Robinhood may not be in a position where it's going to have to ban trading again. Where it's going to have to prevent people from buying certain names again as a risk management tool.
I'll pick this one up.
Morgan?
And I got to say, I went way down the rabbit hole. I've been going way down the rabbit hole this week in terms of options trading and volatility. I actually been kicking the tires. I don't know if you can see it. I got my boots on here, my kick the tires boots. So I'm ready to go this Friday morning. But in general, yeah, I mean, there's so many questions you can ask here and so many different angles you can look at. I mean, just look at the futures market, right? We're seeing that de-risking event happening in light of everything we've seen this week in general. You've seen some of those mega cap tech names that have been favored longs of many of these hedge funds coming down and seeing some weakness. First time really that we're seeing this in the last couple of days versus the last couple of weeks because you are seeing this risk unwind. You can also go down the rabbit hole in terms of trading and what this has meant in terms of volatility and implied volatility as well, which is its own special part of the market. And all the questions this raises around derivatives trading, I think, as well, which we'll talk about with some of our guests in the next hour. Now, I know Citadel has come out and said they had nothing to do with this. Robinhood has come out and said this was specifically a Robinhood, event. But you do have to wonder, as one very smart trader said to me last night, that whether it was explicit or implicit, suits pulling the plug on retail here. Because when you think about it, you're talking about a platform that people are trading on basically for free, mostly for free. Nothing is ever for free, as we learned with the Facebook situation of the last couple of years. And yes, I'm drawing a parallel there. I realize it's apples to oranges in certain ways, but this idea of for you, the user, to be on a platform like Robinhood that is democratizing investing and trading, somebody somewhere has to basically pay for that, and it is in large part being subsidized by those order flows. And I realize there's also another piece to this in terms of Robinhood and its back-end infrastructure and what all of that means. And yes, this is potentially a liquidity event for Robinhood, and we saw them drawing down last night and the investor infusion last night as well. But there are many different pieces to this.
Yeah, but a key one, Morgan, is just Robinhood being in a position where if it wants to stay in business, it cannot have negative equity in many of these accounts.
It cannot.
And given the volatility and the moves that we saw, I mean, when you're talking, 92 million shares at 335 and then going down from there. And by the way, the losses. I mean, there may not be that many winners there. Certainly, there are going to be some on the Reddit Wall Street bets, but there are plenty of people who lost a lot of money yesterday. Perhaps some hung in there. But Robinhood, if you want to stay in business, you've got to make sure to mitigate as much risk as you can't take those negative equity positions that you're starting to see in all those accounts. And by the way, the clearinghouses that provide you margin are raising the margin on you, and that's why you've got to say, we can't do it. So there are a lot of conspiracy theories about who pulled the strings.
And I'm not getting into the conspiracy theories. I'm not taking sides on the conspiracy theories.
Right, but my point is it's simple business in terms of a brokerage firm wanting to stay in business.
Absolutely. That is absolutely the case, and it is self-preservation for a company like Robinhood, in part because, again, not only the regulatory situation for them themselves, their in-house clearinghouse, et cetera, but also the fact that, in general, where do they make their money more broadly, longer term as well? And I think there's so many different pieces to this. It's very nuanced. It's hard to talk about it in sound bites on TV. I'm sure there are going to be many books and many investigative pieces written about it over the coming days, coming weeks, coming months, coming years.
Yeah. But David's right. It's multifaceted. The layers to the story, the regulatory issue. We heard from Maxine Waters yesterday, David, as you implied. A lot of discussion about whether or not Robinhood has somehow betrayed its users. I went back and looked at terms of service. It's very clear. Any services related to my account immediately may be discontinued by providing written notice. Vlad Tenev did talk to Andrew Ross Sorkin last night and again this morning about the capital raise and the degree to which they need to be concerned about things like that clearinghouse dynamic. Here's what he said.
Well, to be clear, this was the system working. We have the ability to restrict buying in symbols for unprecedented market conditions such as this. And to be clear, we didn't shut down the system. We shut down buying for these 13 stocks, for these 13 securities, but customers that held positions could still sell, and customers still could buy and sell the thousands of other securities on the Robinhood platform.
But when you look at the precipitous fall, for example, of GameStop today, do you think that Robinhood bears any responsibility for that?
I can't comment on price action of securities, and probably it would be inappropriate for me to do that. And also, I should note, Robinhood wasn't the only firm to restrict buying in securities. Other brokerages have been restricting the buying and trading of these types of securities all week and even today. Of course, we get the lion's share of the attention since we've been the cognitive referent for retail investing in America, but other people are dealing with these challenges as well.
As for the impact on the broader market, David, Barclays takes a shot at it today. They say, look, the total dollar value of short interest is $800 billion, but for stocks where it's short to float of greater than 20%, it's $40 billion. So it's unclear exactly how many rich targets these hunters will have down the line.
Yeah, again, the impact longer term on the broader market, right? Difficult to say. Will this be with us for a long period of time? Most likely. Are there going to be any true regulatory changes here? Perhaps there'll be more attention on short selling. Certainly not to the point of where you can get short more of a float than exists. That would seem to be something that perhaps would be put a stop to. I know people have quoted numbers in terms of GameStop, which, by the way, you can borrow now quite freely. but that may not have been quite correct. But and certainly there'll be a lot more focus on risk mitigation. I mean, we talked about it. These hedge funds, I think some of them didn't realize how many were following Melvin into the same trade on retail. Melvin got a lot larger as a hedge fund itself, and probably has lost more money than it made during the life of the fund, which we've seen so many times through some of these funds, whether it's John Paulson, whether it's John Paulson, or whether it's even Julian Robertson. I've made the point through the years, many of these hedge funds get so very large. This guy's a great stock picker. Gabe Plotkin was very good on the short side, but again, you do have to wonder about the risk mitigation strategies that they were employing there or keeping an eye on, Morgan. And that's going to be a new case, certainly for the hedge fund industry as it moves forward, as it has to be prepared for this possibility. And by the way, this day is just beginning. GameStop is up almost 100% right now. We'll see where it starts. I would point out again, we got to keep a close eye on Robinhood and whether that firm is going to feel comfortable continuing to allow people to buy in these names if it starts to see some of the same things that move them to shut it down yesterday morning.
Yeah, and not to be overlooked, with the volatility we have seen just in GameStop trading in general, I mean, how many halts were put on this name yesterday as well? So even if you were...
At least 5.
Yeah. So even if you did have access or you were finding a way to buy into that name, I mean, how many of the hours of the day were you actually able to do so? I think also just speaking to that piece of it, one of the questions that has been raised to me by some of the people I've spoken to in the last 24 hours is, and again, I have no opinion on this, it's just the question that's been raised to me, which is why blanket freeze on anybody who's buying options further out than the expiration today or buying the underlying stock in general. You can make the argument, or they were making the argument, that accounts with options expiring today, maybe you freeze, you limit, you have them liquidate because of concern of capital requirement that's assigned a position in the underlying stock, but to do so blanket, I think is really part of what is the question that was raised and has enraged some of the folks that maybe were trading and going long in a name like GameStop yesterday. David, I also think it's interesting that when you see a name like GameStop, that's what, something like 1,700%. I mean, we're hearing about it on the AMC side, but in terms of the opportunity here to potentially sell more stock, raise more capital, it's been interesting to not hear a name like GameStop coming out and at least publicly considering that option.
You would imagine that they should. Why not take advantage of what the market is giving you? As you point out, AMC has done so, at least what it had on the shelf, and then Silver Lake, of course, moving to convert what had been a fixed equity, a convertible note into stock as well to try to save themselves some money there or make some money where they thought they had a loss. And we can all argue about the long-term nature of the business at GameStop, and I think that does underlie some of the questions here as well of what we're seeing. But, I mean, heck, Hertz tried to sell stock and did, in fact, sell some stock when it was bankrupt because people were willing to buy it. All right, let's move on now to another big story, of course, we're following this morning. That is Johnson & Johnson out with new COVID vaccine trial results, and Meg Terrell has the details for us. Meg.
Hey, David. Well, these were obviously very anticipated because it's the first one-shot vaccine we are getting for COVID. Results from massive phase 3 clinical trial, 44,000 people across 3 continents. In the U.S., the efficacy figure against moderate to severe COVID was 72%. Now, when they incorporated the global results, which included a much lower rate in South Africa, where you have that troublesome B1351 variant circulating, 66% efficacy overall. Importantly, against severe disease, being able to prevent people from going to the hospital or dying from COVID, 85% efficacy globally, including those results from South Africa. So that's what we're hearing experts really focusing on today, the ability to keep people out of the hospital with a single shot vaccine. Now, of course, in addition to just being one shot, there are other benefits to this vaccine, including that it can be stored in the refrigerator at temps of 36 to 46 degrees Fahrenheit for up to 3 months. And they'll be packaging this in a 5-dose vial. The NIH just concluded a telebriefing on these results. Dr. Fauci talking about them and acknowledging that people are going to compare that 72% in the U.S. with the 94 and 95% we saw from the prior vaccines from Moderna and Pfizer. He said, if you look at this number, with out. In the absence of the 94, 95%, one would have said this was a spectacular result. But guys, check out the trading of other big vaccine players in the COVID space today. You are seeing Moderna soaring. You are seeing Novavax soaring 63%. They presented some data from the UK and South Africa last night. Pfizer up 3.5% there. So the market's seeing this as an inferior result, although experts really saying this is spectacular. One shot can keep people out of the hospital and prevent deaths from COVID. So you're kind of seeing that play out in the markets right now, guys.
Yeah, Meg, let's get some straight talk on whether or not, I guess, you see this as disappointing and whether or not you could improve that overall efficacy with perhaps a second dose of J&J's own or some kind of booster. What's in the future there?
Well, they are testing a 2-dose regimen, both in the UK and in the US, and so we should see data on that as well. But they are moving forward, planning to file for emergency use authorization on the one shot in the US next week. So this will move pretty quickly and potentially get on the market, within a few weeks. Impossible to compare apples to apples, that 72 and the 94 to 95, because we don't know which variants were picked up in the data in the J&J trial. They haven't sequenced all of the cases in the United States, so we don't know if there was some B117 in there. That's the UK variant. We just don't know. The other argument is that there was just so much more disease when J&J was running this trial, and that could affect the efficacy as well. We should remember the FDA bar was 50% efficacy. We're seeing 72% for J&J here. This is still a good result, guys. Back to you.
Yeah. Yeah, and keep in mind what the average flu vaccine is able to do these days and compare it to that as well. Meg, big stories on your beat this morning. We'll come back to you later on this morning. Our Meg Terrell doing great work as always. Obviously, plenty to get to on the corporate earnings front. We'll get to Honeywell and Caterpillar, Mondelez, Lilly, Chevron. Take a look at the Dow futures off the early morning lows. We're back in a minute.
Tomorrow is just waiting to be created, to be reinvented and redefined. And it's those who dare to push the world forward, discover and reshape markets, and embrace the possibilities of data that will reimagine our potential and transform society as we know it. With new ideas and new technology, get there with NASDAQ.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Tyler Matheson, Melissa Lee, Kelly Evans, Our Lunch on CNBC.
Companies routinely manipulate their own stock. We're watching the same kinds of things happen everywhere. Outfits like Robinhood, that say, we're going to give you prizes to come join with us. And then say, but you have to sign something that says there'll be an arbitration clause. So if it turns out that we really did cheat you, it'll never be made public. There'll be very little that you can do about it. That doesn't create a healthy market. What we need is a healthy stock market. And to have a healthy stock market, you got to have a cop on the beat. That should be the SEC. They need to step up and do their job.
Senator Warren on Closing Bell last night. David, it was interesting to hear her focus in on the SEC and equities because some of her prior tweets had mentioned private equity, and you could imagine private equity saying, wait, don't drag us into this.
Yeah. I mean, listen, Carl, I'll come back to you. I don't quite understand. Do you understand? What was she saying?
I think she wants, I think she wants better, more aggressive SEC enforcement.
Period. Right? That's it, I guess. Yeah. Listen, all due respect to Senator Warren, I just don't know exactly what that was. In listening to it, at least, maybe a larger conversation we get further. I think, again, Robinhood is doing what it needs to potentially protect its business, even though by, of course, preventing people from buying stock on your platform, you're perhaps sending them to other ones, so that's not necessarily good for your business. But you got to do what you got to do to keep yourself alive and solvent. There are going to be a lot of things to look at. And when Gary Gensler is approved as the SEC chair, I would assume, Morgan, he will be nothing but busy.
Yeah. It certainly seems that way, and it's not surprising to hear Senator Warren commenting on this, despite the maybe ambiguous nature of that comment, or to see some of the other senators and congresspeople that we've seen commenting. I mean, it would seem at a time where Congress tends to be very divided on quite a number of topics, including the latest stimulus proposal. Let's not overlook that, something we've been keeping an eye on for the last couple of days as well. It does seem there's some bipartisanship between some of the senators here, but it goes back to that question about what really can be done, and the devil's in the details whenever you talk about any kind of regulation. All right, we've got a lot more. Here's another look at the futures as we count down to the opening bell right now. We're poised for a down day to end the week, with the Dow poised to open 157 points lower. The S&P implied to open down 14 points. Stay with us.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Investment apps, including Robinhood and Interactive Brokers, have introduced trading restrictions after social media campaigns caused volatile movements in the prices of companies like GameStop and AMC. That story is on the website now. Retail investors have also sparked a rally for joke cryptocurrency Dogecoin. The currency added over $7 billion after users on Reddit talked about making it the crypto equivalent to GameStop. Head online for the full story. A global tax on tech giants is now highly likely, according to German Finance Minister Olaf Scholz, following a call with new U.S. Treasury Secretary Janet Yellen. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quinton.
The Reddit squeeze has resumed this morning as some of those restrictions have come off. In the meantime, the SEC has a statement out saying they're closely monitoring extreme price volatility of certain stocks. We will closely review actions taken by regulated entities that may disadvantage investors or inhibit their ability to trade certain securities. Obviously, one of the top stories today. A lot more Squawk on the Street continues in a moment.
I heard you guys have Workday now.
Yeah, they're a great partner. They're always there with insights and guidance. It's like having a business caddy. Who can run Detroit?
The VP there is well qualified.
We can staff Detroit from within.
You good for golf on Saturday?
Can't. Closing the books.
Team's already finished. Took half the time.
And I'm back in.
There's an opportunity in New York. Not this quarter.
Workday, a finance, HR, and planning partner like no other.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our staff.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
We mentioned that SEC statement a moment ago, reading it a bit more in full here. Extreme stock price volatility has the potential to expose investors to rapid and severe losses and undermine market confidence. They go on to say, David, issuers must ensure compliance with federal securities laws. We will act to protect investors when facts demonstrate abusive or manipulative trading activity that is prohibited by law.
Yeah, I wonder who that ends up protecting in some way. You know, if that's a reference to Robinhood, I don't really know. You know, the best way to protect is to make sure your firm stays in business. It'll be interesting. Again, we come back to this, and obviously the SEC right now is missing its leadership position, sort of direction from that, even though obviously they have a lot of working commissioners and the like. But Morgan, it'll be interesting to see what they really choose to focus on and what, if any, true changes occur as a result of what we've seen this week.
Exactly. And I think there are so many different angles to this in terms of, back to your point, that we're going to be seeing regulators probably very busy looking at it. I mean, it's a gray, unprecedented situation. You've got the retail side of it and just the run-up in these stocks. But then on the other side, you do have these hedge fund unwinds, the short positions, the market makers getting destroyed on that volatility, given the blowout we've seen in that. Here's the opening bell. It is...
Yep, there is the... And a look at the S&P 500 at the bottom of your screen. Obviously, final trading day of January this morning. Still looking at a losing week. And for the month, Dow's down 3 points for the month. S&P and NASDAQ do have a gain for January. NASDAQ by 3.5. But again, we'll see how much collateral damage there is in some of these dislocations. David, we mentioned that Barclays note earlier today. And look, they say it's been a wake-up call, in their words. Retail traders are likely to continue to be a force to be reckoned with, and that will permanently affect the business models of institutional investors as that long-short risk protection strategy gets recalculated.
Yeah, it does. Listen, I mean, you can still short a basket of stocks. You're still going to try to put some hedge in your hedge fund if you are one of the managers behind the $3 trillion plus that is in that asset basket, so to speak. But, you know, in talking to, and for years I've talked to so many of these largely guys. They're not going to short single names, that's for sure, Carl. They're just not. You don't want to do it at this point. You don't certainly want to ever be associated with a particular short position. That is where things sort of began to go bad for Mr. Plotkin at Melvin. Somehow people learning about his very short positions. And to be fair, it was a basket of retail names as well. And obviously he didn't have it properly sized. Perhaps he didn't fully understand how many other hedge funds were following him into those same trades, given the level of success that he's had over these last few years. I mean, his firm, he was up 51.4% last year. Year before that, 46%. So it does give you a sense as to his performance. But yeah, Carl, you're just not going to have single name shorts. And that's why a guy like Andrew Left, who's built a business over 20 years on it, saying, I can't do it anymore. Nobody's going to bother listening because the risk is simply too high at this point. Whether that will change, we'll see.
Well, and there's a conversation,
I think. That has huge implications.
Go ahead.
No, I was just going to say, David, huge implications if you were unable to hedge the way you historically have hedged. To what degree do you de-risk on the long side? Those spreads get wider, markets get more brittle. I mean, there'll be a series of unintended consequences that we really don't even understand at this point.
Yeah. I mean, and there's going to be a bigger conversation to have around leverage, I suspect, as well. I mean, we can talk about that in terms of what we've seen in retail, the retail and investor landscape, and on a platform like Robinhood. But you can talk about that probably on the hedge fund side as well when you are talking about some of these shorts. I also got to wonder, just from a fee standpoint, what this does to that 220 model. I mean, that's been such a debate. How long, David, has that been a debate where the hedge funds are concerned?
Yeah, no, I always point out, I've kind of watched this industry become an industry. You know, when I started, it was sort of 5 guys, and we didn't have Reg FD. You know, there was an ability to sort of get close to that line. And then it became a true, as you say, true industry. And 2 and 20 has made a lot of people extraordinarily wealthy, and many of them, of course, not really putting up returns that were anything more than what the overall index did, or the S&P. And fees have come under pressure. Mm-hmm. There aren't that many managers out there, or certainly not as many as there once were, being able to actually hold the line on those numbers. That said, when you have a great track record, you can ask for what you want. The money seems to find you regardless. And that, of course, can sometimes pose a problem, because sometimes you get outside of your core competency, or sometimes you simply start to take perhaps more risk than you realize you are taking. And that may have been the case with Melvin. But yeah, we hear it a lot. Hedge funds are here to stay. The compensation structure, maybe not quite so much, although I did make the point yesterday, Morgan, I think it is worth making. They do serve a lot of different constituencies. They manage money for a lot of different types of people. It's not just about the enormous wealth that accrues perhaps to a handful of people at the top, although that is certainly something that I've been focused on for years and talked about and questioned. But that's the way the world works. They're not doing necessarily anything illegal, despite the fact that so many would like to believe they are.
Yeah.
They're not.
Yeah. I'd also just note silver. Silver's been jumping. You've seen that silver ETF as well. I think that started picking up last night. It's getting attention as well. This idea of a short squeeze playing out in that. It looks like J.P. Morgan as well named 45 stocks that could be susceptible to, quote, fragility events in the coming days as well, including some names that we've talked about on this show. Macerich, I know you've been pointing that one out, David.
Macerich, yep, absolutely.
Cheesecake Factory, Stitch Fix among the list there, too. So other names to just, I think, keep an eye on and watch, given some of the conversations that seem to be bubbling up around those.
Yeah, everybody's got their list of potential targets. By the way, we got a halt on GameStop for volatility, probably the first of many if the last few days are any indication. There is a slight industrial bid, guys, this morning. Caterpillar comes out with a pretty nice beat, revenue ahead, see sequential improvement in operating margins. They expect to recommend a div hike this year. Machinery sales, the least negative since November of 2019. So Cat's one of the few Dow components of the green. And then David, Morgan Stanley, on an ordinary day, we would be talking about their double upgrade of Boeing, in which they say consensus has gotten too negative, runways cleared, kitchen sink quarter, and Boeing also one of the few Dow components that are solid.
Yeah, it is slightly in the green, as you say. We had Dave Calhoun on, of course, the other day talking about the fact that they do believe they have sufficient liquidity, despite what were those significant charges for on a couple of different areas, Carl. And then this focus, this continued focus, I think you'd have to say on what the third quarter of this year. Gary Kelly, of course, we were talking to yesterday as well about sort of the progress that he sees being made. So much of this, though, Carl, does come back to the vaccine and the distribution of the current vaccine. And now today, of course, the good news in terms of Novavax and J&J, which perhaps will be added to the mix soon. But we're still got to watch on that front. Thankfully, hospitalizations and cases have been trending down. But, Carl, there is a great concern about these new variants as well and what that could mean. And, again, that comes back to travel, which comes back to Boeing.
Yeah, exactly right. UBS has a note out this morning, obviously looking at a global population, but they say at the current run rate, UBS, we'd vaccinate 10% of the global population by the end of the year. So that's obviously including all kinds of developing markets, not just developed. But that number needs to inch higher. And we're beginning to see, David, some slight increases of average vaccination per day. I think we're now doing 1.26 million a day in this country for a total of a little over 27 million. So we'd like to see that number obviously accelerate.
Yeah, and then we get that J&J data that was out this morning. You have that Novavax data that came out last night as well. The expectation around J&J that you could potentially see an emergency use authorization happen as soon as next week. What's expected to be, I think, a pretty aggressive ramp in terms of production there. I mean, there is that discussion. I know Jim, I think, has brought it up on the show more than once in recent days that perhaps we are going to have much more supply than originally anticipated, quicker than anticipated, if you do start to see some of these other shots come online much more quickly. And of course, the question then becomes, how quickly can you get them not only produced, but distributed into people's arms, which of course we've seen that's where the logistical hiccups have been in recent days. I think it's also worth noting just the fact that the Pentagon is now being called upon to do more in terms of, instead of just sort of behind the scenes logistics around vaccine distribution, to do more in terms of actually potentially getting those doses into people's arms. So that's going to be another development to watch pretty closely and speaks to that federal push that's happening in a much more aggressive way now under the Biden administration, Carl.
GameStop's reopened, guys. Now a 64% gain. You know, David, what's interesting is some of the action on mega cap tech. Apple down again today, and I wonder about Facebook as well, on the heels of what were obviously very strong quarters. But yeah, there's a couple of dynamics. One is that companies that were beating earnings were already underperforming relative to the broader market before GameStop happened. But you could build, I guess, a thesis that some of this is depressing sentiment on names that are clearly not just blowing out Q4, but highlighting and forecasting, in the case of Facebook at least, continued revenue growth of 30% plus.
Right. I mean, they had a 33% top line growth number for Q4. But as you point out, the stock yesterday really didn't do much of anything. I think it did end the day down. Apple is also down. In a typical week, if we didn't have what you're looking at right there, that Reddit rally, so to speak, we would have been much more focused on earnings, given we heard from Apple and Microsoft, as well as Facebook and Tesla, shares of which are also down a bit. But they kind of came and went. But to your point, we got to keep an eye on them. Apple shares did get to a point. It's still up for the year, by the way, I would point out. A little less than 2% are shares of Apple, whereas the S&P is down. So it is still outperforming the broader market right now. It does trade at, 35 or so times earnings, something like that, although a number of the analysts are going to be changing their estimates to a certain extent, given the very strong quarter, what, the $100 billion revenue. Some of the numbers are truly hard to imagine when it comes to Apple. Forgot to even check their cash position. We were so busy yesterday. But it's hard to avert your eyes, guys, from the main story this week. I mean, GameStop is now up 75%. Of course, that has caught the attention of so many. It is still sort of the focus. But AMC shares are up 59, almost 60%. By the way, in this idea of selling stock, Mike Santoli let us know, you know, they're towards the end of their quarter. They may be in a quiet period, unable to actually do that, need to refile new numbers. So perhaps GameStop will try to take advantage of this at some point by selling. I mean, at this point, you could just sell 10%. It would be over $2 billion that you could raise, amazingly enough, when the market cap of the company wasn't far. Yeah, sorry, Carl.
No, right on the money, David. Dow Jones now at the headline that American has entered into a new equity distribution agreement, $1.12 billion. So some of these CFOs are not looking a gift horse in the mouth.
No, take advantage. Why not? It's the smart thing to potentially do it, even if the market is acting irrationally. So what? Give yourself, you know, an opportunity to secure equity at a cheap price, so well, at least for them, and not have to access the debt markets, which has been more the case. You know, look at AMC, right? What it was borrowing at, and now it's able to potentially sell stock. You know, this is a company that was very close to just staving off bankruptcy here and there and trying to sort of make its way, and then it gets caught up in this fervor. By the way, some of the names that I keep an eye on as well, Viacom, and now it's down. It actually been up as much as 3%. That stock has been a beneficiary of this short squeeze strategy. Discovery, another one. Again, any of these names, Morgan, that have large short positions. Now, in both of those cases, you can make arguments as to why the stock should be higher. Certainly Discovery in terms of its multiple, and even Viacom multiple to EBITDA and the like, and perhaps some recovery in the advertising market that they've been seeing. But it's funny to see how many names have been caught up in this. And yesterday, both were down rather sharply.
Yeah, that's right. And, you know, and I mentioned it yesterday, but there are some of those names that I watch pretty closely, like, for example, Virgin Galactic, Space, which is also up again another almost 5%. It's $45 per share right now. I mean, that's a name that bounces around in general. It's been a name that's been highlighted for quite a while, I think, on some of those sites like Wall Street Bets. But to your point, it is these names that do have a lot of short interest in them that is getting a lot of attention. I also just think, going back to the whole selling stock conversation as well, I mean, there's probably a case there to be made for the SEC to make it possible for some of these companies to move even more quickly, potentially, to be able to sell more of their stock in the midst of all of this volatility, because you got to think that too, potentially putting that supply out there in the market could help with some of the huge spikes that we've seen. Yeah. It's a debate to be had.
It is. Carl, it's been a funny week because I barely mentioned SPACs. And by the way, just because we haven't mentioned them
so many of
doesn't mean that many haven't been getting priced and or doing their deals. I see this one, TPG today, doing Nerdy. Yeah, Nerdy. I know. Direct-to-consumer gig economy platform. It's transforming, apparently, how people learn as digital disruption accelerates market expansion. I'm just reading from a press release there, but it does value that company, Carl, at $1.7 billion. The SPACs continue. It used to be a focus for the Reddit crowd. Certainly when it came to SPACs and EV, that's at least how we, through Jim, got to learn about what was going on there a number of weeks, in fact, months ago. But that has not been the focus this week, Carl.
Yeah, I thought it was going to be, because we went into the week with that Goldman David Costin note about SPACs being somewhat bubblicious, but we definitely got a curveball handed to us in the middle of the week, David. So it's the worst week in about 3 months across the board. Let's get to Bob Pisani. Hey, Bob.
Hello, guys. Happy Friday. Lousy open, 2-1, declining to advancing stocks. Remember, it's the last day of the month. As goes January, we'll see. We're right on the knife edge on this. Take a look at the sectors. Banks were the only major group that kind of opened in the green, and they are also negative as well. But China, which has had a great month, that's MCHI, the big China ETF. Energy's had a great month, but Down's been declining for a few days here. Consumer staples, they're the loser on the month. Tech's done very, very well. Down today, as you can see, all the mega caps are to the downside. The earnings still matter, and they've generally come in very good. You mentioned Caterpillar. Those numbers were good, but they're not going up. Stocks haven't been going up. Many of these stocks just don't go up on good earnings. Honeywell was good. I think the guidance was a tad disappointing. I think the street was expecting a little more. Chevron was one of the few stocks that actually had a disappointing top line number for that, but perhaps not that surprising here. As for the shorts, we've been showing you all the heavily shorted names here have been soaring here in the different levels. It's been quite a week here, but Bed Bath & Beyond, AMC, Express, even iRobot, one of the few that was a favorite earlier in the week, not doing anything. Just want to, here's some numbers on GameStop. So at the open, it was market cap was about $26 billion. That's bigger than almost 50% of the rest of the S&P 500. It's not in the S&P 500. It's in the S&P small cap, and it's the biggest stock in the S&P small cap. And depending on where it is now, it may be the second largest stock in the Russell 2000. I believe Plug Power is the largest stock in the Russell 2000. This is now number 2. But this gives you an idea that this was a stock that was a fraction of this value just 1 week ago. We care about it today because of the options, the weekly options. Now, these started on individual stocks several years ago. They're generally weekly options expiration, non-events. We never talk about it. It may be an issue today because GameStop calls are so deep in the money. We're talking about a $40 stock. Last week, that's 300. We don't know how it's going to end at the end of the day. So investors have to take delivery or sell. Those who are long it, who bought the calls, have to take delivery or sell. So if you're long, you bought the call, do you have the money to get delivery? You still have to pay for the stock for whatever strike price you had there. And if you're short, you know, if you sold the call, so you're going to be able to borrow the shares to deliver. And again, normally this is not an issue. It never comes up. But when you're dealing with these kinds of crazy price swings, today, that's an issue. And this came up with that whole clearing issue around Robinhood as well, of course. So we got to keep an eye on all of that. As for the month, well, you know, remember, as goes January, that's an old saying. We're right on the knife edge. Essentially, the S&P 500 is flat. This was at the open up 0.8%. We're now flat for the month. But the Russell still had a great month, even though it's off of the highs. The NASDAQ is off of its highs, but it's still a good month. Flat on the industrials, and the transport's down 0.8%. As for the sectors, the best performing global index still remains China, although it was down overnight. Still good. Energy, banks, technology, and consumer staples and utilities, the defensive sectors, they're the ones that really had a tough time right from the get-go. They never really had any juice at all behind them. So it's been a fascinating close to the month. We'll see how the day ends up. Guys, back to you.
Bob Pisani, thank you. Chicago PMI out just moments ago. We've been showing the results at the bottom of your screen. It came in at 63.8, well above the consensus estimate of 58.5. But David, just to go back to the market more broadly. Okay.
There's the bond report.
All right. Just there you go. That's the. We'll take a look at the yield on the 10-year right now, 1.09%. But we'll go back to Carl as well, as we do continue to see the sea of red in the major averages.
Morgan, thanks. You know, one thing we've missed all week long has been the wisdom of our friend Jim Cramer, who joins us this morning on the phone. Jim, for all the viewers, and there are a lot of them, who wonder where have you been, can you explain your absence in the past couple of days?
It's been a vast conspiracy, Carl, to keep me away from people who may otherwise want to buy GameStop up here, and they can't have it. No, I had a pinched nerve. I got it alleviated. I'm actually trying to check out today. You know, you got all these rules. You can't just walk out. I was perfect attendance, Carl, so it's very unusual for me. But anyway, I just missed you guys. I wanted to call in, and I did want to help people because when you wake up, if you're like Rip Van Winkle and you see GameStop at 342, you say, "Will you please sell some?"
Yeah.
Yeah, Jim. We're glad you're feeling better. We can't wait to get you back.
Can you get Adam Aaron on the phone right now from AMC and tell him to sell 100 million shares? I see thank heaven, American Air's doing that. But GameStop is just being, I mean, I understand. My wife came in yesterday and said, Dave Portnoy came on and said sell it or something. And I said, wow, okay, absolutely. I agree with Mr. Barstool. This is crazy, guys. It's crazy.
Jim, you can't even get away from it either. I don't know. You know, I was trying to listen to sports radio this morning. There's the one here in the New York area, WFAN, figuring, all right, I'll listen to the latest on Deshaun Watson and where he may be going. And they're talking about Stevie Cohen and Dave Portnoy and their feud and wondering whether, you know, how Cohen's going to be impacted. It's this story is just impossible to avoid.
I have an idea. I want to be like I usually am, as opposed to whatever the hell I just put in my back, which was just to alleviate the pain. Here's the deal, guys. GameStop is a $23 billion company right now that, frankly, even if it were operating in all gears, would be worth about $5 billion. It's $23 billion. I mean, we're worth $5 billion. So it's actually literally like more than 4 times what it should be worth. AMC was a few days ago. Adam Aron, he's a very respectable CEO. We've known him for a long time. Yes. He came out and said, "You know what? We're not bankrupt." Well, that's a real reassuring, right? So his stock's at 13. If he just raised $900 billion, he just raised what? Almost $900 billion. What? Some huge amount, David. What was it? $9 billion?
Yeah. No. But yeah, they raised almost $1 billion, I think. Yeah.
Almost $1 billion.
$900 million. Yeah.
He needs to raise about $9-10 billion, right? I mean, come on, you got to pay down the debt.
Listen, but Jim, I mean, it's been an interesting, here you are, you've for years, right, on Mad Money and on this show, we've been trying to inform, you certainly have been working to inform what you call the retail investor. You call these guys
the regular person.
Right, the merry men, because they're different. This is a different cohort to a certain extent.
They're very, look, first of all, congratulations to them. We all wish people can make as much money. And we wish they were making it on Apple, or we wish they were making it on Microsoft. But they're making it on companies that the three of us know are actually not doing that well. I'm not saying that GameStop should ever have been as low as where the short sellers were selling it. Just because it obviously, there was a very smart buyer. Ethan Cohen came in. Was it the fellow, the guy,
Chewy.
The guy who started Chewy. He bought a lot of stock at $8, and he's a bright guy. But, it's at 338. Do you believe that if you were to poll every single member of the board of directors right now, right? Every single member, every single member would sell it, and their families would sell it, and their lawyers and their doctors and their dentists and their PTs would all sell it. And that's what I don't like about this. Now, of course, that's inside information. I'm not condoning that. But there isn't anyone who is involved with GameStop in any sort of way, shape, or form who would accept the fact that this company should be at 338. But there are people who are buying it because, Carl, you see this too. The system is broken right now for certain stocks, for the heavily, heavily shorted stocks. And people are thinking somehow, well, this is a home run. Take the home run. Don't go for the grand slam. Take the home run. You've already won. You've won the game.
Yeah.
You're done.
Well, but Jim, to that point, though, we were just having this discussion a few minutes ago. The population of names where the short interest as a percentage is this high is limited. So is the after effects of this GameStop phenomenon also limited?
Yes, it absolutely is. I mean, let's take the most visible one that I'm very close to, Bed Bath & Beyond. Mark Tritton, absolutely fantastic CEO, came out of Target. Chief merchandising officer, really amazing. John Duskin, great agitator, changed the management there with a very aggressive proxy fight. And, that's a stock it's hard to figure out. Was it worth 10? No, I think the short sellers actually pushed it down. Is it worth 36? It's probably worth, like, say, 25.
Right.
But that's the only of all these, Carl. This is the only one that's a judgment call, but it's got 66% short. The other ones are just overly shorted, and then you start getting down to stocks. If anything under 5%, and if you're buying it thinking there's a short squeeze, you're going to be wrong because the company can alleviate the short squeeze. Why GameStop? I called GameStop 3 times last week. I mean, I almost called it from the OR. I should have called it from the OR. I was more coherent than they are. And there's definitely no doubt about it that they should be selling stock here.
They might be towards the end of their quarter, Jim, and unable to do so until they actually report numbers. Mike Santoli's pointed that out. But, on GameStop, by the way, not that many people are short anymore, Jim. I mean, most people have covered. And so, this is, I don't know. This is not just squeezing here. This is just pure buying.
GameStop has the ability to pre-announce. People have the ability to go to the government. You can go to the
and by the way, and I'm fairly certain, Jim, their fiscal year ends in a matter of days.
Yeah.
Oh, you can do whatever. I mean, look, these are just lawyers talking. This is the market at stake. When you have something like a GameStop, which is making everything look like a farce, the Treasury Secretary should be talking about it. We've got people who are more scared about the stock market because of some dumb video game brick-and-mortar outfit. This is just nuts. We've got really great companies in America are being written up all over the place. And, it's like maybe they should crash because of GameStop. These America, you got to hand it to American Air, right? They knew that they need money. So what they do, they raise cash. I said Bed Bath has a good balance sheet. They don't need to do it. AMC has a bad balance sheet. They do need to do it. It's called the balance sheet. And GameStop could do a spot offering right now, pre-announce its quarter, and get rid of that $1 billion in debt that they don't need. But nobody wants to do anything that's commonsensical here. And you've got these two sides duking it out, and it's just a tragedy that's going on like this. And I don't care whether, I'm not saying red is good or bad. I'm not saying the shorts are good or bad. I'm just saying that the government has to step in and at least try to address the situation so that the rest of the market isn't panicked by 4 stocks that are heavily shorted.
Hey, Jim, while we have you, J&J, your verdict?
That's a tougher one because, look, it's what you really want is obviously you want Moderna because that's 95%, or you want Pfizer because it's 95%. But if you can get a drug right now that is going to keep you out of where the hell I am, which is a hospital, then you want it. And so, I mean, I think that we're going to have to start thinking, you know what? There's perfect and there's good, and good's pretty damn good. So do I buy the stock J&J? Well, obviously, I would have liked it to have 95%. So you're not going to get that. But does it save lives? Yes, it's certainly worth something. But now we're going to have to default and start talking about the rest of J&J's quarter, which, by the way, was excellent. And it's the principal beneficiary of a weaker dollar of all the drug cohort. It's a pretty damn good stock at 2.5% yield. So I don't mind. J&J could go back under 150. Yeah, but not much more than that. The one that is confounding me is Lilly's. I'm looking at Lilly and thinking that's had quite a run, and don't think it's on at this point. Don't think it's on. It's definitely not on COVID. It's on Alzheimer's.
Right.
Jim, it's Morgan.
I'm trying to save people some money on this GameStop before they lose a lot. I mean, I'm calling in from the hospital bed because of GameStop. It's just not right.
That's exactly.
I just can't watch people lose all this money.
Yeah, Jim. I mean,
I'm sorry.
Hey, it's Morgan. I'm glad you're feeling better, and I just wanted to go back to that point you're making. I mean, when you talk about taking the home run, at some point everybody's going to start taking the home run, and it's going to be a race back down to the bottom. I mean, at least if history is any indicator that it could end really badly, and I just wanted to get your thoughts on that because that's going to be scary.
I've got nurses here and doctors are saying, should I be in it? And it's like these are real people here and making real difference and working real hard. I'm talking about first responders asking about GameStop, and it's like, guys, have some heart. Company issue a statement saying we don't know what's going on with their trading. We want to raise money, but we think we should be able to. We don't have a good balance sheet. The short sellers, let's find out who really covered that short at what price. Let's have some disclosure. Let's have a government investigation of how the trading went so this doesn't happen anymore. Because you've got trillions of dollars at stake in an even stock market. This is like the flash crash, and we all thought the flash crash took the stock market down. It shouldn't.
No, but Jim, we know where this stock's going to end up. I've said that. We don't know when, but I know where. I think most people feel pretty confident, right? And you do too, based on its fundamentals.
I'm calling for my damn hospital bed because I'm not going to sit here and let real people lose a fortune on this.
Right, based on the prospects that it has as still
Lisa's going to come in here. She's going to come here. She's going to take my phone away. But I'm looking at this stock and I'm saying, this is David and Carl and Morgan, thank you, and CNBC, thank you for giving me an opportunity to say, please don't lose a lot of money on GameStop.
Yeah, but if you're Robinhood, you've got to be careful here too because you don't want gaps down either. In margin accounts right now, you got to make sure everybody, you don't want negative equity to start showing up in all these accounts, and then you have an issue yourself.
Yeah.
And obviously they can't sell the long calls. They don't know how to get out of them. They should be selling common against the long call, which is a synthetic short. At least they'll be closing out the position. In other words, people are playing with fire. The people are playing with high calls. And, like a 300 call, 220, 250. We've never seen margin requirements like this. We've never seen the level of collusion behind us that there's no sunlight going on here whatsoever. We need Louis Brandeis and 5 other great justices to get involved in this. But the one thing that should not happen is people should not read into the rest of the market from GameStop. The rest of the market, the numbers have been really, really good. And everything that I've seen, I've been trying to catch up and sneak it when the doctors aren't watching. And I feel pretty good. They're supposed to try to keep me down. But there's the biggest joke. But yeah, I just said I got to call in to tell the guys that this thing should not be anywhere near. And I'm not against anybody who's long it. And there's no vast conspiracy against me or GameStop or anybody else. There's just a very overvalued stock. And if there's 3 guys on and it's the 9th inning, and you're up and you're down by 1 run, okay, and it's a home game, you don't need to hit a grand slam. You can hit a single, and you've just hit the single of a lifetime. All righty.
So, Jim, are we going to see you on Monday?
Well, if you don't tell Lisa, I'm going to try to sneak to the studio. I have the COVID studio at the end of that hall. But maybe you guys can distract her so I can do a show. But you will definitely see me Monday. Believe me, if I were on the operating table, you would have seen me yesterday.
Yeah, I imagine we were reading. He was reading the J&J conference call while they were operating on him. I think, Carl. I could see that, couldn't you?
I tried to FaceTime you. You didn't pick up. Anyway, please don't let people get hurt. Okay, so that's our job. Don't let them get hurt. All right?
Yeah.
Love you guys. You
sound good, Jim.
Yeah, it's good to hear you.
I'm in the Brooklyn Marathon.
Jim Cramer phoning in from the hospital on this Friday morning. Good Friday morning, everybody. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with David Faber and Morgan Brennan. Stocks on pace for their worst week in about 3 months here as we close out the month of January. All sectors are red. VIX above 33 is something to watch. Obviously, checking in on some of the movers of the morning. J&J publishing some of its large clinical trial. We've got the chief scientific officer joining us on that news later this hour. The Reddit trade continues higher. We'll get you the latest next, but first, pending homes. Diana Olick has that. Hi, Diana.
Hi, Carl. Yeah, pending home sales fell 0.3% from November, but they were still over 21% higher annually and the highest December reading ever from the National Association of Realtors. Pending sales represent signed contracts on existing homes, so an indicator of future closings. This is the fourth straight month of declines as buyers are getting hit by record high prices and record low supply. Low rates did help during the month as the 30-year fix dropped in December. Not enough, though, to offset those prices. Demand uneven across the country with the largest decline in sales seen in the Midwest. Pending sales rose in the Northeast and were basically flat in the South and West. This follows a disappointing report on sales of newly built homes in December as well. Back to you guys.
All right, Diana, thank you very much. As we said at the top, seeing a bounce again in some of those so-called Reddit names, including at GameStop, which has already been halted and resumed. There's American, which actually is issuing some new equity, raising more than $1 billion. Comes after Robinhood said it would allow limited buys of the volatile stocks today. David, interesting to see and hear Jim talk about the urgency of people not getting over their skis.
Yeah, making a point that we've made many times. It's not hard to make that GME, perhaps at a $24-25 billion value, is a bit overvalued given the prospects it has as still a brick and mortar retailer in a world that is moving quickly to digital distribution of video games. Many of the analysts out there, as you know, who've abandoned coverage at this point, though, had, $10 targets and the like on the stock. We will see what happens, but today it is up. People are allowed to buy it yet again on the Robinhood platform. But Carl, that's kind of where I've been focused is Robinhood and what that company is needed to do. You heard the interview last night that Andrew Sorkin brought us with the CEO of Robinhood, and what they are going to be able to do to continue to focus on making sure they stay in business, that they have enough solvency. They took in $1 billion, but if you're Andreessen Horowitz, one of the key investors there, for example, I mean, you've just got to be making sure that their risk mitigation policies are correct, that they know what's going on in terms of clearance and settlement, that they have access to what they need in terms of the clearinghouses, even if they're raising their margins, and that they understand exactly what's going on with their customer balances. But when the stocks go from 335 to 120 in 20 minutes, Morgan, it's kind of hard to figure out exactly how much you have at risk. And so, we've got to at least warn people it's possible, and this is from people who run these businesses, other businesses, not Robinhood, it is possible that they have to stop people from buying these stocks again. It's possible that could go into effect if Robinhood feels like it is crossing certain thresholds.
Yeah, and certainly just last night, I mean, we also know that, to your point about that company trying to protect and save that company, Robinhood, that they did draw down on a line of credit from 6 banks that amounted to between $500 and $600 million. They did get that cash infusion of more than $1 billion from existing investors as well. And this is a name that has not only pioneered this democratization of trading, if you will, and sort of forced everybody else that was more established in the industry to follow suit in terms of taking those costs, those fees down to zero. But it is a name that is poised to go public later this year in its own right as well. And I also, again, I brought this up in the last hour, but it also does shed that light. And anybody who uses Robinhood had this in front of them to read the fine print or whatever, to be able to get on and use the site, what the business model actually is for you to be able to get on as a user and trade for little or no money, essentially, where that is being subsidized, how that's being subsidized, and how important your trade flows and that data actually is to the bigger, more structural, fundamental business model around Robinhood, Carl. Okay, so that's where... Sorry, Carl. We're going to bring in Elon now and focus on one of the other stories of the day, which is the latest events on Capitol Hill and the reaction there to all of this GameStop discussion that we've been having.
Well, Morgan, Republicans and Democrats want to take a hard look at what's been happening this week. Already, both the House and the Senate are planning to hold hearings on this. And the chairwoman of the House Financial Services Committee, Maxine Waters, said that she wants to rein in abusive practices. She said she's focused on short selling, online trading platforms, gamification, and the systemic impact on capital markets and retail investors. Now, no date has been set yet for the hearings, and the witnesses have yet to be announced. But last night, Congresswoman Alexandria Ocasio-Cortez connected what's happening now to the breakdown in trust in big institutions dating back to the financial crisis.
It almost felt like this week, one of the reasons that there was this huge, almost populist bottom-up type of rally on what was going on was that it felt like almost the first time that anybody was holding these folks who game this system accountable.
Now, a lot of the ire has been focused on Robinhood. Representative Ro Khanna tweeted that there should be an investigation into why Robinhood stopped allowing purchases of GameStop. And he said that shows the need for a financial transaction tax on hedge fund shorting and SEC regulations on short selling practices. The backlash has also been bipartisan, with Republican Representative Patrick McHenry saying that while he does support fintech innovation, any market manipulation or pump and dump schemes should be investigated. But at least one GOP senator is warning against a knee-jerk reaction. Senator Pat Toomey is cautioning both regulators and Congress against needlessly inserting themselves into the market. Guys, he said that while Congress should be careful about this, investors also need to accept the consequences of their decisions, whether that be gains or losses. Back to you.
All right, Elon, nice setup here. Let's continue that discussion with California Congressman Brad Sherman, a member of House Financial Services. Congressman, thanks for the time today.
Good to be with you.
Chair Waters didn't mention Robinhood by name when she announced these hearings that we think we'll get. No date either. But is the hearing about Robinhood, or is it something larger, do you think?
Well, I think it'll get larger than just this one GameStop situation with Robinhood. A decision will be made as to whether those hearings are at the full committee level or before the Capital Markets Subcommittee that I chair. And I think we have to look not just on how the markets affect the participants, but how they affect the entire economy. I'm not a fan of day trading. I'm not a fan of short selling. What we want to see our capital markets do is to provide capital for businesses that are actually functioning out there in the economy. All this talk about GameStop, and the company hasn't received any of this money. It's not building any new stores. I don't think the capital market should be a casino. If they are, to the extent they are, we got to make sure it's a fair casino. But what I'd much rather do is go back to a period of time when the average stock was held for 4 years rather than just for 6 months.
So that's interesting. When we start to talk about required duration of holdings, I mean, you're getting into an interesting area there. I mean, Senator Toomey notwithstanding, we did see. Go ahead.
I'm not proposing some law that says you buy a stock, you have to hold it for a year. But we ought to have financial education in our high schools and colleges so that people realize that the purpose of investing in a stock is because you believe it'll go up over the long term, not because you believe that you're going to beat the market by 6 seconds or 6 minutes.
Well, Congressman, the horse may have left the barn on that one. I mean, advances in technology make it so that just by picking up your phone, you can trade stocks, sell, buy within seconds. It's unclear that's going to change.
Yeah, that doesn't mean you should.
Yeah.
Technology allows you to drive a car over a cliff.
Yeah, right.
I had driver's education. They told me not to do that.
No, and you're right. There is a lot of education. It's frankly what we try to do here, although many would attack us for actually doing that. It's been a fascinating week to watch. I wonder when you talk about short selling as well, I would point out, and it's hard to defend in certain areas, but there are short sellers also who've uncovered frauds in the market through the years. When I used to do more reporting on that, working with some of them, they were excellent policemen for the market. So, every regulation has brings something else that unexpected. I just wonder how much you think really can be done here when there's a full understanding of what's occurred.
Well, in the UK and in Europe, there's disclosure whenever you have a short position of over 0.5% of the stock outstanding. We ought to take a look at adopting that. It hasn't destroyed the stock markets of the UK and the EU.
Congressman, in general, should it be allowed to be able to short companies at more than 100%? Is that sort of the key area that a lawmaker like yourself might be honing in on?
Certainly no one short seller should be shorting over 100%. In this case, it's hard to say who went over 100% because you had a whole group of people who may or may not have been connected. And at the other side, you had those in the Reddit group who were bidding the stock price up. The stock price should reflect the real value of the company, not some tug of war between guys on Reddit and guys in the C Street suites on Wall Street. We've got to get back to a situation where we have long-term investment based on the value of the company, not momentum investing based on the idea that the company may not be worth anything or the Bitcoin may not be worth anything, but I can sell it to a bigger fool and get out of it and make a profit.
When we see Ocasio-Cortez and Ted Cruz agreeing on something like this, at least in theory, Senator Toomey's comments notwithstanding, I wonder, do you think that there is enough circularity here where policy is actually possible? We talk all the time about the lack of bipartisanship, but of the issues you're looking at, do you think this is the most bipartisan?
Well, I think there's a bipartisan angst that something is going wrong here, that both on the short selling side, but also on Robinhood, creating a relationship with its customers, then cutting them off for no apparent reason. So I think, but I don't see a Cruz and Ocasio-Cortez focusing on the same piece of legislation. So I think that right now the unity is just on something's wrong when a stock was worth $10 a few months ago. The company hasn't changed. It's not like they developed a vaccine, and now it's selling for $480 and then down to $380, and maybe it's worth nothing, and maybe it's worth $380, and maybe our capital markets should reflect the value of the company. And the vast majority, you got the ticker on the bottom there. The vast majority of the stocks are being bought and sold by people who think that's kind of the fair value of that stock at the present time, given the company's prospects. I don't think anybody involved in GameStop really can make that case.
Congressman, the hearings are going to be big news, at least for our audience, and we thank you for giving us at least a peek as to what might be discussed. Congressman Sherman, thanks. Have a good weekend.
Good to be with you.
As we head to a break, J&J's long-awaited vaccine trial data is out this morning, and we will talk to the company's chief scientific officer. That is next. Stay with us.
The countdown to the close of the European markets is sponsored by IG.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Keep up with the crisis. Squawk on the Street on CNBC.
J&J is out with vaccine news this morning, and our Meg Terrell joins us. She's got a special guest, J&J's Chief Scientific Officer, Dr. Paul Stoffels. Meg, take it away.
David, thanks so much. And Dr. Stoffels, thanks for being with us this morning. The world was waiting for this news, the first trial on a single-shot vaccine for COVID. But you are starting to see people comparing the 72% efficacy you saw in the U.S. versus the mRNA vaccine's 94 to 95%. Dr. Fauci said in the absence of that comparison, the data would be considered spectacular. How do you respond to those comparisons we're hearing this morning?
Well, Meg, this study was done at the height of the epidemic across 3 different continents when a lot of transmissions are going and a lot of variants are circulating. So we have been able to show that across that, we got 85% protection against severe disease, 100% protection for death, and 100% protection for hospitalization. And when you look at the challenge of the pandemic at the moment, it's exactly that. It's people dying, people get to hospital, and people getting to intensive care. And so it showed that across the regions, including in South Africa, where 90% of the patients were with the South African strain, we got this very high protection, including protection for death and hospitalization. And that's where we think it's important. The second thing is the onset is early at day 14 after a single dose. It's maturing day 28 and even further. So we'll learn more as we speak in the coming weeks. And then it's this variant, which is starting to be very worrying as it has taken over most of the infections in Southern Africa. And that's now also showing up in the rest of the world. So broad spectrum, very significant protection is the key takeaway for us. Mm-hmm. Mm-hmm.
And of course, we know that that variant that originated in South Africa, known as B1351, was just detected here in 2 cases that are unrelated to each other with no travel history in South Carolina, suggesting we have community transmission to some extent of this variant in the United States. I talked with Paul Offit, the vaccine scientist at CHOP this morning, who said your efficacy against that variant was outstanding. I mean, tell us what you saw in South Africa in particular, the severe disease, outstanding, I should say. What did you see in South Africa for severe disease?
Well, for severe disease, we saw 89% protection and complete protection for hospitalization and death post day 28. And so that's very remarkable. And it's a combination of antibodies, but especially also T-cell immunity. The vaccine, when we developed this, was selected based on high antibody response, but also T-cell immunity. And we did a lot of research over the last several years on optimizing a vector, and we combined that with optimizing this vaccine, the COVID vaccine. And so that's what we observe. We only know this since a week. We sequenced all the strains, and it's clear that it was a South African strain which was present in our study with that type of protection, 89% total protection for death and for hospitalization.
So you did the sequencing in South Africa knowing that that variant was going to be very important as you looked at the results from this trial. How much sequencing were you able to do of the U.S. cases to know if there was any effect on efficacy from variants here in the U.S.?
Yeah, that's ongoing. We have more than 450 cases, moderate to severe, several hundred coming in at the moment because this is an interim analysis. The study is still ongoing, and we'll learn as we go in the next few weeks as the sequence information becomes available, sensitivity by region, by population. We are going to learn a lot in the next few weeks. But as the South African variant was so significant for the world and so worrying, we made sure that we did that work first. And we were able to show the significant activity on the strains, and we determined those strains were in fact variants.
Well, tell us about the regulatory path forward. We understand you're going to apply for emergency use authorization with the FDA here in the U.S. next week. What kind of timing are you expecting then for this to potentially be on the market?
Yeah, so the team have been working hand in glove with the FDA on discussing the transmission of the data, so that's already happening now. Next week, we'll submit in the course of the week our file, the summary of all the data, and then it's up to the FDA to take their time to evaluate, and that will probably lead, if it's deemed sufficient, to a advisory panel in due time. And probably that can still happen in February, but that's up to the FDA to decide when they do that, and we'll wait for a response from their side when the FDA advisory panel will be called.
And what can you tell us about your supply? If this gets on the market in February, how many doses could you have here in the U.S.?
I'm not going to talk about number of doses, as that is also still dependent on, first of all, the FDA approval, but the EUA approval, but also approval of many of our manufacturing sites. That's ongoing. We have a commitment to the U.S. government, which were to deliver vaccines, and that is public, and so we'll deliver that as we committed to.
Yeah, Doctor, just to dig into that a little bit more, I mean, with some of these other vaccines that we see that are already being deployed right now, obviously a very complicated and tricky process, both in terms of manufacturing and then also in terms of delivering and actually getting them into people's arms. How is your vaccine different? I think it's worth reviewing that again, given the fact that it's a one-shot dose.
Well, it's a one-shot dose, but it's a totally different production process. Our vaccine is grown on cells. We have optimized that, and we have that very much under control, and then it's fill and finish. And so none of these manufacturing was readily available. So we worked with the U.S. government and partner companies to, within 12 months, we started Large March when we knew we had to go to a very large-scale manufacturing, upscaling in the U.S., in Europe, and now also in India. And so we hope that we can get to, we are working towards 1 billion dosages in the course of the year. And in this case, that will mean 1 billion people vaccinated as it is a single dose. But it's going to be an upscaling throughout the year with doses available very soon after, immediately after approval, but it will be an upscaling through the year.
Dr. Stoffels, we know that you're also testing a 2-dose regimen of your vaccine. How do you look at the data you have today, including on the B.1.351 variant, and think about the context of needing 2 doses or perhaps an updated version?
Yeah, we studied a 2-dose vaccine because we knew that we need to have very long-term protection. And we know that the optimal timing between dose 1 and 2 is somewhere between 2 and 3 months. So that's why we started the study with a 2-month interval. And that will give us a good idea on how long, but also how strong we can do that and whether it's needed. But in the pandemic now, it's important that that people get vaccinated as fast as possible with a single dose, with the 85% protection against severe disease and full protection, hospitalization and death. Vaccinating fast will take out the difficulty in the society, which is hospitalization and death. And hopefully with that, we can prevent that in hundreds of millions of people already in course of the year before the data of the 2-dose will be available.
You know, you have have analysts who follow the other vaccine developers out this morning with notes. Michael Yee at Jefferies, who follows Moderna, saying that J&J will be used in some global regions given dire need, but we believe it's a two-tier system with mRNA leading as the preferred platform. Do you think that's a fair assessment?
I think that's maybe if you look superficially at the data, you can say difference between 19 and 72% is different. But we are in a totally different time at the moment with variants and huge transmission. And the real world evidence we have generated in the world with the data I just talked to you about, with the high protection, is very significant for public health. In addition, the vaccine is at a very favorable storage condition, 2 to 8 Celsius. We can distribute it, and that will also facilitate large-scale deployment. And therefore, I think if you take all the features together, we have a very simple tool to prevent a very severe consequence of this disease on a global scale. And that is what it will come down to get this pandemic quickly under control globally.
Mm-hmm. Knowing that we have this B.1.351 variant here in the U.S., and we don't know to what degree, but suggestions of community transmission, what do you think that the pandemic here in the year ahead in the United States looks like in the context of potentially your vaccine coming to market? But what are we in for here?
Yeah, you see that the UK variant, it's called the UK variant, but it has emerged in many places in the world. It's called the South African variant. It has emerged independently in different parts of the world. It's a logic evolution of viral multiplication, and the virus evolves. And so we need to be very careful that we need to take very strong action and fast to make sure that we reduce the burden of transmission very quickly, so that mutations cannot continue to take place. We need to be very vigilant on eventually adapting the vaccines if that's needed. And also we didn't know these results until a few days ago. We started working on the South African variant as an additional booster, but we'll see now whether that will be needed with the clinical results we have. But we have to stay vigilant and make sure that we adapt vaccines as quickly as needed. There is a big risk of new strains taking over at the moment, and we have to stay vigilant to prepare for that.
All right, Dr. Stoffels, we really appreciate your time this morning. Thanks for being with us.
My pleasure.
And Meg, thanks to you for bringing that to us. Now let's get to our ETF spotlight. We're going to take a look at the Vanguard Communications Services ETF. The ticker there is VOX. It's up more than 20% over the last year, led higher recently by one of its core holdings. Yeah. AMC, one of the Reddit trades of the week, of course, up more than 140% for the week. You could see up another 43% today. A Reuters report, by the way, saying the company is exploring raising more capital, including a potential sale of stock. Of course, we've been talking about this possibility, capitalizing on that huge move up in shares for a company that, well, its prospects don't look particularly good, at least near term. We're keeping an eye on that story along with the other major Reddit trades of the day. Squawk on the Street is right back.
The world needs to pay attention to climate change and the broader sustainability agenda.
At Walmart, we're working in 4 areas specifically: climate, nature, waste, and people.
We have set a vision, one planet, one health, which means that the health of the planet and the health of people are interconnected.
Tackling climate change is essential to deliver the prize of a more prosperous, equitable, resilient, and sustainable world.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our staff.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Some of the NYSE most actives today will look awfully familiar. AMC, Nokia, BlackBerry, Pfizer, Express are on the list. For the moment, the S&P is holding higher for the month on this last day of January by about 15 points. Don't go away.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO. On Squawk Box, Chevron CEO Mike Wirth, earnings insight, new momentum in the energy sector, and the outlook for demand, what investors need to hear now.
Daybreak in the U.S.
Trade nerves all around. Tech stocks down again today.
Start on top of the news. Brian Sullivan, Worldwide Exchange on CNBC.
Good morning, everybody. I'm Sue Herrera. Here's your CNBC COVID update at this hour. Just minutes ago, word that European regulators have authorized the AstraZeneca vaccine for use in adults. There's an ongoing dispute between the company and the EU over AstraZeneca's inability to initially deliver as many doses as expected. For the sixth day this month, the U.S. has reported 4,000 or more COVID deaths. The total for the pandemic is now above 433,000. That's equivalent to the population of Oakland. The case count, however, stayed below 200,000 for a 13th consecutive day. Kaiser Health News looked at data from 23 states, finding that black residents are getting vaccinated at much lower rates than white residents. That has some lawmakers calling for action, citing higher COVID death rates for black Americans. And the NBA's Miami Heat team is using COVID-sniffing dogs to check fans before they come into the arena. Attendance is still being sharply limited, and masks, of course, are still required. You are up to date. I'll send it back to you, Morgan.
Sue Herrera, thank you. Let's go to Leslie Picker for a closer look at the business of Robinhood. Leslie.
Hey, Morgan. Robinhood now allowing its users to make limited buys in those stocks and options that were restricted on the platform yesterday. That hasn't done much to quell the heat on social media and, of course, in GameStop's stock. After Robinhood restricted purchases of certain securities on their platform, users became enraged and distrustful of the commission-free brokerage that promised to democratize finance for all. Robinhood says they made the move to protect their company. Now, a risk management necessity for them due to volatility in certain names that can cause a liquidity issue. Brokerages like Robinhood have to be able to post a certain amount of cash in order to meet SEC net capital obligations and clearinghouse deposits. CEO Vlad Tenev said on CNBC yesterday that there was not a liquidity issue, but it seems to certainly be pulling all the levers to get cash. We've heard from sources that they're drawing down hundreds of millions of dollars in credit lines from JP Morgan and Goldman Sachs to shore up the balance sheet. The company also raising an additional $1 billion from Sequoia and Ribbit, not to be confused with Reddit, the forum where these stock tips have been shared. Now, Robinhood CEO, he embarked on a media tour last night, starting with CNBC, in an effort to defend the company's recent moves.
I know how Clorox and Lysol felt in the pandemic when they were running out of hand sanitizer and supplies. We just haven't seen this level of concentrated interest market-wide in a small number of names before.
Now, David, we've talked about this before, but earlier this month, Robinhood deepened preparations for an IPO, a stock offering. And I've called around to sources on this. No surprise, those preparations have been deprioritized for the time being as Robinhood tries to put out fires on a multitude of fronts. David.
Yeah, I mean, Leslie, so glad for your reporting because they're fighting for their life in a way. I mean, given the volatility in these underlying shares in which, of course, so many of their clients are trading, they've got to be very careful. And to your point, they've obviously been successful in raising some new money that is going to help. But I've been making the point because others have made it to me that there's no guarantee that they don't find themselves in a similar position where they have to stop buying in certain securities again.
Oh, that's right. That's absolutely true. And that's part of the driving factor for why they're seeking to raise all that cash. And, you know, this thing isn't just limited to Robinhood. The solvency of Robinhood, the stability of Robinhood is important to the whole financial system. We don't actually know how interconnected this company is with the rest of the markets. And so, you know, it is certainly something to watch as you know, we look at just the interconnectivity with regard to the entire financial system right now.
Leslie, thanks. And thanks for your reporting. That extreme volatility we're seeing, of course, is, well, we'll start with our next panel. Chris Ailman's the Chief Investment Officer at CalSTRS, and Illinois State Treasurer Michael Frerichs joins us as well. Chris, let me start with you, a longtime participant in our capital markets. Let me just ask you the question of, given what you've seen this week, what are you thinking about? What is your sort of takeaway, if there is one to be had so far?
David, it's really that this is a symptom of the excess we're seeing in the markets. You've been around, talked to Art Cashin. It really feels like 1999 all over again. And this is really a symptom of the stay-at-home situation. I mean, this is excessive cabin fever. People have not been able to go on vacations, and so they're speculating and trading. And since it's commission-free, it's just kind of the excess that we're seeing in this frothy market.
And, you know, as somebody who makes allocations to hedge funds, what are your thoughts on that front in terms of perhaps some of the risks that at least some of them didn't see coming from this move to sort of gang up and really squeeze them when it comes to some of their shorts?
Yeah, I knew it was something when my son-in-law tweeted me this week and wanted to know what a short squeeze meant. I realized, okay, millennials are onto this. We only invest in two styles of hedge funds, so we're not involved in the people that really are market neutral or long short. And I think that it's a wake-up call that a crowd is okay, but a herd or a swarm is scary, and it can wipe out the markets. Short squeezes have always been a risk to these people. Shorting is a risky strategy. Hedge funds know that. This is incredibly unusual, and it has a lot to do with just the pandemic, that everybody's staying at home.
I mean, Treasurer's office actively manages about $35 billion. How are you thinking about your allocations as well in the midst of this?
Yeah, this doesn't change our approach. We don't currently invest our portfolio dollars in hedge funds. I serve on the board of the Illinois State Board of Investment, where we have over $20 billion. And when I came into office, we looked to get out of our hedge fund positions. And so this hasn't affected us. Actually, it's been fairly positive. But this serves as a great reminder that there is risk when you play in the market. These hedge funds should have known this as professionals.
Wait, why is it positive? I'm curious.
ExxonMobil, again, given the news flow this week, we haven't had a lot of chance to focus on it, but you're there, D.E. Shaw, a lot of conversations. You guys nominated a slate. Or at least engine one.
America. We've held them for 30 to 40 years. We're going to hold them for 30 years. We want these companies to think about the future, and I think Exxon's finally waking up. I'm optimistic. I think that shareholders are really excited about this change and a change at the top. And so that it hopefully will change the tone at the top of that company, and that they'll be more resilient and look into the future and pay more attention to how the future is going to be a low carbon future.
So
change is coming.
You do
and they
feel,
need to wake up.
Yeah, you do feel like, though, you're going to actually get results in terms of some of the things they do, whether it's capital allocation and or perhaps more effort, concrete effort in terms of carbon?
I absolutely do. I'm actually optimistic that our slate's going to win and take over their board and change that company from the top. That's what's got to happen. Oil companies have got to wake up and decide, do they want to be energy companies into the future? We're going to need hydrocarbons, even though a lot of people would love to get rid of them, but they're not going to need as much, and they've got to change the way they work and the way they operate. Climate change is now back in the forefront. Forget all this GameStop stuff. Climate change is real. It's in front of us in the next decade to two, and companies have to adapt, adjust, or die.
Yeah, I mean, as it stands right now, you do need hydrocarbons for a fair amount of manufacturing in some of those clean energy technologies, which I think is probably something we're going to see continue to evolve as well. Michael, I realize it's a down day for the market, and certainly one of the themes, one of the things that's being talked about is, I think, broader de-risking right now in the midst of GameStop. I mean, it's really a relatively small handful of smaller stocks that are heavily shorted that have really sucked the oxygen out of the room this week. But the fact that the major averages are still hovering pretty close to record highs right now, I mean, what is your outlook on the broader markets, and also, for that matter, rates while we're at it for 2021?
Well, I'd say we feel pretty good about the market in general. GameStop will pass. People will get out of their short positions. We'll move forward. But I think we need to take some time here to look at the SEC and how things are regulated. I think one of the big problems and a lot of the anger out there is because the little guy was treated differently than the institutional investors. And that's a problem, and that's something we need to look at here. If our markets are going to function properly, if they're going to fund our capital accumulation for our businesses so they can grow, we need to have transparency and rules that are followed to stop market manipulation. If the SEC can come in and work on those issues, we are bullish on the future.
Okay. Gentlemen, thanks to you both. Appreciate it.
Thank you.
Meanwhile, guys, keep an eye on some of those Reddit names. We're seeing some relative stability compared to earlier in the week on GameStop, which is trading in a pretty narrow range here, not quite back to the highs of earlier in this week when it hit 483. We'll take a break here. Be back in a minute.
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong, so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The brave ones, Blake Mykowski. CNBC.
trading platform Robinhood embroiled in controversy after suspending trading in some heavily shorted stocks yesterday. Of course, that includes GameStop, AMC, BlackBerry, Nokia. The company's CEO, Vlad Tenev, speaking to our Andrew Ross Sorkin last night, and here's what he had to say about the move.
I want to address some of the misinformation that's been out there because there's a lot of it. We absolutely did not do this at the direction of any market maker or hedge fund or anyone we route to or other market participants. The reason we did it was because Robinhood is a brokerage firm. We have lots of financial requirements, including SEC net capital requirements.
With a bang, energy and change came to every part of our universe. Seismic or small, it continues.
Change is all around us. Shaped by technology and human ingenuity. We can make it work for you and your business.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020 for $12 billion. Very attractive valuation. This provides tremendous value for our shareholder.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
Respect the role of regulatory agencies. They are closely monitoring the situation, but it's under their purview at this point in time. And I guess part of our education can be conveying to people that the SEC is the regulatory body that would oversee this and can speak to it further.
That was White House Press Secretary Jen Psaki on the GameStop retail trading frenzy just moments ago. The SEC releasing a statement earlier, in part saying that, quote, they will act to protect retail investors when the facts demonstrate abusive or manipulative trading activity that is prohibited by the federal securities laws. Let's discuss with Jacob Frenkel, former SEC Division of Enforcement Senior Counsel and partner at the law firm Dixon Wright. Thanks for being with us this morning. Can that case be made, that statement we just read from the SEC, can that be made here?
Well, the answer to whether it can be made is really going to be driven by the evidence. And that is, you're talking about what role the brokerage firms were playing in this process in terms of limiting the ability of individuals to trade. I actually tend to believe that was proper. And the reason that was proper was because we're forgetting that brokerage firm customers sign customer agreements, and those customer agreements enable the firms to do what is necessary to in terms of ensuring customer protection, but also what is in the best interest of the broader customer base at the firms. But more broadly, in terms of investor protection, we're also talking about what could come at the end of an enforcement investigation. And we really don't know what that actually means or will lead to. We know there will be an investigation. Will be an investigation on all sides. But the question is social media being used for discussion of issues, or is it being used for the purpose of propping up the price of stocks or depressing the price of stocks? The latter could well be stock manipulation. So I think there's a long way to go. My view with respect to the SEC is what it should have done several days ago is use its trading suspension authority. And it does not have to be for a 10-day period, as we see, as always the case with small cap stocks. It is, the statute says up to 10 days. I think the SEC had an ability and has an ability to create a more powerful pause as these companies blow through the circuit breakers. But that is the challenge of an agency that's still awaiting a permanent chairman, permanent enforcement director, permanent director of trading and markets.
Yeah, for sure. And the timing, given that fact, is certainly worth noting here. You just said a lot. There's a lot to unpack. I want to go back. I realize that if you're using a platform like Robinhood or one of the other platforms as well that made similar moves yesterday in terms of limiting certain types of trades in certain stocks, that is your prerogative as that company, and certainly you can debate what that meant in terms of a liquidity issue at a company like Robinhood and everything else. But I'm curious, I could understand accounts with options expiring today that you could freeze or limit, maybe have them be liquidated because of a concern of a capital requirement. Certainly we've seen things like that happen in the past. The fact that there was this blanket freeze, at least it's my understanding, there was this blanket freeze that anybody that was buying options, including further out in the future, or even trying to buy the underlying stock of some of these names in general, couldn't do it. How unusual is that?
This is all very unusual, but we really are in uncharted territory. And the other component I think we have to put into the mix is margin calls. In other words, you have a lot of investors who are approaching the trading, including we're talking about uncovered calls, uncovered puts. I mean, we really don't know what all of those underlying dynamics are. And there is an issue of solvency for these brokerage firms. If all of a sudden there are a lot of margin calls, which firms do need to make when people are not satisfying their margin requirements, and that could actually impair the financial well-being of these firms. These firms also have obligations to their, to all of their customers, not just the individual customers who are trading. And the only other thing I think that relates to all of this is, the focus is on long the effects on the customers. There's also a lot of discussion about, well, what about the short roll, and what about competing with the shorts? The fact is, I'm very much of the view that the shorts have a necessary role in the markets to ensure proper pricing. So there are a lot of factors that really come into play here, and it's a weighty decision that these firms were making.
All right, there's so much more we could dig into here, but unfortunately we're up against the end of the hour. Jacob, thank you for joining us.
Anytime, my pleasure.
Nice to see Jacob on our air again. Take a look at some of those Reddit names. Obviously, it's gotten the street's attention and will continue to do so. But in the meantime, Dow well off session lows, down 210. Squawk Alley starts in a moment.
Of all the companies on the Fortune 500 in the year 2000, more than half no longer exist. Digital transformation isn't just a good idea. It's a matter of corporate survival. Enterprise AI enables organizations to use artificial intelligence at enterprise scale, solving previously unsolvable business.
Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
The German Finance Minister Olaf Scholz has told CNBC that Europe did the right thing by coming together to forge a joint approach to fighting the fallout from coronavirus. However, speaking exclusively to Aneta, Scholz admitted the bloc was acting too slow in its COVID vaccine procurement.
We have to admit that there could have been a situation where Europe would have asked for more vaccines earlier in the last year, but now anyone is working very hard to do the best that we get enough vaccines.
Tyler Matheson, Melissa Lee, Kelly Evans, Our Lunch on CNBC.
Good morning. It is 8 a.m. at Robinhood headquarters in Menlo Park, California. It's 11 a.m. on Wall Street, and Squawk Alley is live.
Happy Friday and welcome to Squawk Alley. I'm John Fort with Carl Quintanilla and Deirdre Bosa. The Reddit rebellion is where we're going to start this morning. GameStop resuming its rally, now up 73+%. AMC also up 56. BlackBerry up about 10. Survey of the shorts. Our next guest is saying the recent Reddit trade is, quote, the messy middle of a revolution. Early Robinhood investor and Inside.com founder Jason Calacanis joins us now. Jason, what a story. What an investment for you, I'm sure. You say you were off skiing, but now you're back paying attention to this story. Now, first, there's a conspiracy theory advanced without evidence by Tyler Winklevoss on this show yesterday that political leaders forced Robinhood to stop the buying yesterday. Is that what happened?
Yeah, I have no information on that. And, you know, good luck with the Winklevoss twins and trading Bitcoin. They're total heroes to me. So I'm joking. I don't know that they know what they're talking about. So I would disregard whatever they say. But it is certainly an interesting turn of events. And yes, that's a blizzard behind me. And this is just actually tipped over into the consciousness of everybody. I mean, on the lift in front of me, people were talking about, should they buy GameStop? I kid you not. and this was like a 15-year-old kid and his parents, and they're talking about GameStop, and they're explaining shorts. And I was like, you know what? This is actually why I invested in Robinhood. This is why Robinhood was formed. Robinhood, and I don't speak for the company. I don't have any inside information. I did not talk to Vlad, although I did see the great hit that Andrew did last night. That was a good get. Congratulations on that. And, you know, when they pitched me this idea at Antonio's Nut House in Palo Alto before the product was launched, you know, Vlad said to me, we want to get millennials to trade stocks. And I said, these are the same people who are totally commitment phobic. They're YOLO. They're on their mom and dad's, you know, Netflix accounts. They don't buy cars. They take Ubers. How are you going to get them to do that? Like, what's the opportunity there? He goes, well, what if we do? What if we do get them to trade? Like, what would that look like? And I said, well, okay, great. I like that idea. It's a new market. And I said, you know, retail's gone. Like, there's no retail investors. He said, Jason, that's the opportunity. I said, okay, I like the way you're talking. Great. Keep going. What's the business model? He said, we're going to let them trade for free. And I said, I'm in. You know, this is like a great idea. Obviously, that will get people. I mean, this is what my life is. Like, the same pitch as Uber. Like we're going to, people are going to give up their cars and they're going to use an app.
But tell me,
these crazy ideas work. And
Jason,
and I think, go ahead, John.
Is this free to trade model as we see it now sustainable under these conditions? I mean, how much money is Robinhood going to need in reserve? It's going to have enough to operate when things like we've seen over the past few days happen.
Yeah, and that clearly is the issue here. Clearly, communication wasn't very good yesterday. I think Vlad owned that great. These are growing pains that these big companies go through. Facebook went through 12 of these. Uber went through 17 of these, and I talked to you about every single one of them. Sometimes when you have hyper growth, you have these kind of edge cases. And so they're going to obviously need to have more money on hand. Clearly, I'm not an expert on these regulations and what the covenants are and the coverage needs to be. But this is a great stress test of our financial system. And it's absolutely awesome that young people are on Wall Street bets getting this financial education, because the way to accumulate wealth in the United States is to own equity and equity participation. You cannot win just being, and you can't certainly change your strata in life and move up into another, level if you don't have equity participation. It's very hard to do that on income. And so it's great that this education is occurring, but you have to understand, when something hits #1 in the App Store, that is a large amount of downloads. So this is as if everybody in the country decided they're going to go to Las Vegas on the same weekend. This is unsustainable. It's unsustainable to onboard all these accounts, I am certain. And it's unsustainable, certainly, to have so many people either trading on margin or doing, puts and calls. But this is unprecedented, and I think they're going to need to digest it. And they're not the only ones, are they? Like, every single broker is having the same issue right now. There's too much participation, and that participation will take time to digest, and we'll get on the other side of it, I'm sure.
Jason, it's Deirdre. You mentioned the interviews that Vlad did last night, and he said in a number of them that Robinhood has restricted trading to protect their customer. Who is Robinhood's customer?
Yeah, I mean, I think ultimately it's those retail investors. If they lose those retail investors, there is no business.
The retail investors, Jason, a customer is someone who pays Robinhood. As you've mentioned a few times, the retail investor does not pay Robinhood. Those are commission-free trades. The customer is actually Wall Street, isn't it? It's the money, it's the market makers who pay for order flow. So how can the business model be let traders trade for free? It's actually making money off of order flow, is it not?
Well, of course, and they're very upfront about that now, and it's been very clear. But some businesses are based on having large audiences that trickle.
Are they? Like you said, they never talk about that. They talk about democratizing trading, and they talk about commission-free trades all the time. We rarely hear them talk about order flow.
I think people understand it. I think it's in all the terms of service, and they've been very clear about it. So, it's very similar to the Facebook situation where you get a free product. If those consumers don't use Facebook, the free product, or Instagram, or Twitter, the free product, or CNBC, the free product, you don't have the ability then to make the money off of that audience, if you will. And so,
but Jason, you just brought up
easy
Facebook.
To say that. Yeah, sure. Go ahead.
So there's been a lot of trust lost in Facebook over the last few years. Yeah. So why should traders trust Robinhood if they now know that they're turning around and selling their trades to market makers and perhaps not executing at the best price?
Okay, so number one, they've been clear about with the market makers that that's how they make money. Everybody understands that. The second piece is, should they trust them after having turned off trading yesterday? I think they have to rebuild that trust. So I think that these companies, when they go through crises like these, and every big company, whether it's Tesla, whether it's Facebook, whether it's Uber or Airbnb, when somebody trashes an apartment, these new platforms that get to scale, there's always going to be these crisis moments. And the way you can judge the founder is, do they communicate well? And I think Vlad's doing a better job of that. And I think he did a good job last night on CNBC. And I know he'll do a better job tomorrow. And then you ask me the question, let me give the answer, please. And the answer is, they need to earn that trust every day by having a stable, great product that delights users. And whether it was Uber, which took a lot of hits, or Facebook and Instagram, yes, all these platforms have taken hits. They have made mistakes. What I look at as an investor in them is, how do they respond to them? Do they learn from them? And do they get stronger?
Jason, what I'm hearing you say, basically, I mean, I'm less concerned about Robinhood and more concerned about the broader market.
Yeah.
Is that this is
that's the big
classic
issue.
cyclical... this is a classic cyclical flow of retail into the market, and that it will ebb out as it always does. I don't hear you talking about major structural change or some sort of end of centralized finance, as we know some people have tried to argue on our air.
Yeah, that's a little silly. I think that's those the crypto folks going down the crypto rabbit hole, and they think like nobody's going to be in charge of anything and the entire world's going to be on some immutable blockchain that's not controlled by anybody. That's super interesting and a great intellectual argument. It's not very realistic. Sometimes you do need to have central controls, and Bitcoin is a fantastic technology. It does not apply to everything. So they're a little drunk on the distributed finance and all that stuff. I know it's real, but you can't apply it to everything. And what we saw here was these shorts. I mean, I think that's the bigger issue. It's easy to gang up on Robinhood or whoever the lead company is, all due respect, Deirdre. But and they do have a responsibility as the lead company to be the best performing company, and I guarantee you they will be the best performing company. I've seen this movie before. Putting that aside, the big issue here is, you know, who is shorting this stock? How can you short 130% of a company? I still don't have a great answer for that. That makes no sense. And then have these shorts all covered their position? And then if people are buying the stock now at 20 billion or 30 billion or whatever they wind up buying it at, is there any chance that the company can live up to that? And has the company's fate changed? Have they done a secondary? Have they put $1 billion of this, you know, incredible acceleration in their enterprise value into their coffers? And is there some vision here for how GameStop becomes a $20 billion company? I could see betting on it becoming a $5 billion company,
right.
But
20
that's what I'm getting concerned about.
I'm concerned about that too, Jason. And something that I've raised this week is part of the potential, it seems to me, of not just Wall Street bets, but this whole surge that we've seen in consumer interest in finance is handling some of the nuts and bolts too. I mean, equity investing is great, but so is saving. So is budgeting, you know, so is getting those tools and tips together, getting good research together so that the individual retail investor has really deep insight into what's happening with these stocks. Do you think that's going to happen? Is that an angel investing opportunity? And when? How?
It's already happening. I mean, what you're seeing right now between, you know, is young people who have time on their hands, instead of gambling, instead of going to Vegas, instead of going to school and being on Zoom classes and playing video games, they've decided this is a more interesting video game. And you know what? They're learning by doing, and that is the best way to do it. If you don't understand, if you want to learn how to play poker, just get at a poker table and play the low-stakes game.
But that's what I worry about, Jason.
Don't play high stakes, though.
You're saying instead of gambling, and I hope it's instead of gambling, it's harder to do the research versus to be on a ski lift and talk about, should I buy GameStop? It's harder to download a PDF. 100%. Somebody spent, you know, and figure out a model for selling that, not just to 50 or 500 people, but to 500,000 people. How is this movement, or maybe the kinds of Silicon Valley innovators who brought us Robinhood, how are they going to get us there?
It's already happening. If you just go to Wall Street Bets and you start reading some of these threads, as my bestie Bestie C said on the air on Wednesday when he was going on his tirade on a halftime, I believe, you know, these folks are very sophisticated and they have time on their hands. And collectively, the internet can produce amazing things that individuals cannot. One example of that is the Wikipedia. There is no paid staff, yet they've built the biggest corpus of knowledge in the world ever created, and it's still growing every day, day in and day out.
They're always begging me for money, though.
Yeah, I know. Somebody's got to pay for this stuff, right?
Yeah.
Back to business models. So I think that's what's happening, and they're on Discord servers talking about it, and it's going to be amazing for society. But what they're also doing is they're stress testing all of these crazy hedge fund folks who short stocks and then do all the fear, uncertainty, and doubt, the FUD that they did to poor Tesla, betting against Tesla for years. And I had to come on the air here and say, listen, it's the greatest car in the world. The guy landed 2 rockets at the same time. Why are you shorting this stock? It's so stupid. Like, shorting Elon Musk is the stupidest thing you could do. Like, this is like shorting Apple, you know, and Steve Jobs.
Not to say that all shorting is bad, though. You know, Chanos shorted, right? Enron. We had shorts against the housing bubble. Sometimes the shorts are the heroes. I got questions about what happens when we end up in that situation. But, Jason, I think we got to leave it there.
Thank you for the time. I'm going to get out in that blizzard and hit some runs.
Enjoy those slopes. Jason Calacanis, always great to have you.
In the meantime, the debate continues over J&J's vaccine data, which we got earlier this morning. Meg Terrell is covering that all day. Hey, Meg.
Hey, Carl. So J&J with its single-shot vaccine reporting results from that phase 3 trial in 44,000 people across 3 continents. Now, in the United States, they saw efficacy of 72% against moderate to severe disease. Overall, globally, the efficacy was 66%, which included South Africa, where they saw a lot of that strain of B.1.351, which was thought to potentially evade the protections from vaccines. Importantly, they're focusing on this figure, 85% efficacy overall in preventing severe disease, actually keeping people out of the hospital and preventing potential death from COVID. Now, the company says it plans to file for emergency use authorization in the U.S. next week. And in addition to being a one-shot vaccine, this one can be stored in the fridge for 3 months at 36 to 46 degrees Fahrenheit. We talked with Chief Scientific Officer Dr. Paul Stoffels about that severe disease figure earlier. Here's what he said.
We got 85% protection against severe disease, 100% protection for death, and 100% protection for hospitalization. And when you look at the challenge of the pandemic at the moment, it's exactly that. It's people dying, people get to hospital, and people getting to intensive care. And so it showed that across the regions, including in South Africa, where 90% of the patients were with the South African strain, we got this very high protection, including protection for death and hospitalization. And that's where we think it's important.
Now, guys, Novavax also out last night with data from a trial in the UK and one in South Africa. They showed 96% efficacy against the prior strains, up there with the mRNA vaccines, 86% against the B.1.1.7 variant that is dominant in the UK, and 49 to 60% efficacy against that B.1.351 in South Africa. Now, these trial results were outside the U.S. They expect data, we've heard from Dr. Fauci, from a U.S. trial in March. However, I just talked with Stan Erck, the CEO of Novavax, who told me they're hoping they can use these data once they complete the trial to potentially file in the U.S. Here's what he said.
Our expectation is the first licensure will be in the UK, and what we hope to do, we'd like to do is take those data and those submissions and in parallel submit them to the EMA for Europe and talk to the FDA and see if they will accept those data for licensure, and other places that we've already talked to, like Canada and Australia. So I think MHRA is a well-respected regulatory agency, and so if they give us a blessing, and then I think a lot of other people will follow on very quickly.
So, guys, we have to see what the FDA would do with that here. They are going to be evaluating J&J's next, just because the data came from the U.S. The FDA did not accept AstraZeneca's data from overseas. They were waiting for AstraZeneca's U.S. results, but Novavax perhaps could be different. We'll have to see. Guys, back to you.
Yeah, we will. Meg Terrell, thank you very much for that. Big show still ahead on Squawk Alley. The former CEO of E-Trade joins us next with his take on the Reddit rally. Here you see some of those names surging again today. Don't go away. We're back in 2.
Change is all around us, shaped by technology and human ingenuity. We can make it work for you and your business.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Some of those restrictions and those highly shorted names have created an outcry among politicians and investors alike. Joining us this morning is the former E-Trade CEO, Karl Roessner, currently CEO of Lefteris Acquisition Corp., which is looking to acquire a company in the fintech space. Karl, thanks for being with us. Happy Friday. It's good to see you.
Good morning, Karl. Thank you. It's nice to be here.
I want to talk a bit about sort of Robinhood, reputational risk, and all of that. But it sounds like the most important thing you're trying to get across is the urgency of the SEC to start to draw some guidelines. Otherwise, we're going to continue to see interest and money continue to flow in and heat up the space.
So I think that, that's right, Karl. But I think it goes back to the first steps, and democratization of trading and investing is extremely important, right? It started a movement a long time ago when E-Trade dropped the first trade, over the internet. But you flash forward to today, and with the accelerated adoption of technology as a result of the pandemic, as well as the willingness and necessity really for folks to interact with their finances remotely. And you begin to see more and more, the leveling of the playing field that's being pulled forward for retail investors. So you take that and couple it with couple that availability, the access, the execution speeds, their willingness and ability to participate in these markets, and you couple that with social media, and you start to see, how we got to where we are. I mean, it's truly uncharted territory, and I believe we're, in unprecedented situations. So when I talk about, the SEC coming in, I say, okay, we definitely need more regulation and thoughtfulness around what's happened. But I do believe that it's great to see the playing field having been leveled to the point where the retail investor really matters and has a right and has the ability to participate in this marketplace. But when I talk about the SEC and rules and regulations coming on board, they can't just be focused on the retail investor and stopping trading or putting them in the penalty box. It has to be a system-wide situation, right? You have to find or make a solution for the entire thing.
Right. Now, that makes sense. I mean, give our viewers a sense of what's a good idea of a sample regulation that you think might make sense, that has sort of universal acceptance among lawmakers and regulators. What could we be looking at, say, 6 months or a year from now?
Well, I think one of the most important things is really to take a step back and look at the entirety of the situation. Social media and its use and adoption, when you couple that with retail investing or trading, I think that's here to stay. And I actually think it's important because I think that social media is a phenomenal way to get education out, teach investors about the market, share ideas, share thoughts about companies, right? That information sharing piece. So I don't think it's going anywhere quickly, but I do think piloting, right, some rules and regulations around the exact type of trading and situations we're seeing today on both sides, that's what the SEC really needs to focus on. Take a look at it, run a few pilots, take a few names, right? See how we can get to a point that you're not just moving the goalposts on the retail investor. That's what always have been done in the past, and that just has to stop.
Karl, what should happen with short selling? I mean, not a lot of tears being shed about Citron's pain for sure today, but I think about mortgage-backed securities, the big short. I think about Enron, times when the shorts were arguably the good guys. And I can imagine a scenario under today's conditions where those people could get taken out. What should happen there?
So I don't think you can look at just one trade or one type of trade, right, being a short position or other pieces. You need to look at all of the options that folks have to trade, right? All of the different ways that they can get involved with their finances and go into securities. I don't think it's really fair to just say, shorts aren't good or bad. As you just pointed out, in certain situations, they can be quite helpful at getting information out into the marketplace and alerting investors. Right? I think what's gone on today in the market is, it's completely unprecedented. And we just haven't ever seen this type of activity in the types of names that we're seeing. It's a movement, right? It's not necessarily just about valuation of companies. It's a movement, and the retail investor is staking their claim.
Hey, Karl, let's steer. We got into this conversation a little bit with Jason Calacanis earlier in the show, and that is the issue of Robinhood's business model. It relies on payment from order flow to pay for commission-free payments. And I just wonder, does that make it different from other brokerages? There's been a lot of talk over the last 24 hours that, yes, it wasn't just Robinhood restricting trading. Other brokerages did that as well. But Robinhood has its own clearinghouse, right? So does that make it different for them?
So, look, payment for order flow is a situation that's been around for a very long period of time. I know, when you look at payment for order flow and the way that trades get routed, you really need to look for the best execution and the best interest of your customer at all times. And I'm not going to get into, Robinhood's practices or any other firm's practices on the back end of that, but that is really a way to get your customers the best possible speed and pricing on a trade that you possibly can each and every time they press that trade button, right? That's the way that has to work. There is a payment involved because the market centers on the back end obviously want to interact with that flow coming from the retail trader. And that's a very competitive marketplace, right? In order to route your trades to those market centers, because they do have different ways of monetizing those. So it's a practice that you need to be extremely careful about, and you need to be almost religious in terms of your approach. It really matters to the investor how well you run that system, on the back end.
Finally, Carl, I wonder, do you see any of Robinhood's competitors using the scrutiny that's on Robinhood at the moment through a marketing effort to say, look, they're not treating you right, we will? Is there an edge for their rivals at this point?
Look, I think the Robinhood and others were faced with very difficult decisions in terms of what they had to do with their capital requirements, in terms of some of the positions that had been opened on their books, right, and how to respond. When I was at my former shop, I never took the approach of piling on or getting involved when others are having outages or issues, because it can very quickly be you. So I wish them well. I hope they work through this together. Get the kind of confusion if what I'm reading in the press today is right, and I wish them well in future endeavors.
All right, Karl Roessner, former E-Trade, currently with Lefteris. What a week! Thanks for helping us understand it a little bit better. We'll see you later.
Thank you all very much.
And still to come, early Robinhood investor Tim Draper, his take on the Reddit trade, Bitcoin's boom, a lot more. We'll be right back. Stay with us.
I think brands and companies need to reflect the current situation where consumers are living in. Be true and authentic, and that is something we need to reflect in all the communication, but also in our product offering. Our brand positioning is display greatness. People spend so much more time on the screen than they did before. We want to make sure that it keeps being comfortable to consume content or do your work or lesson in school, because TCL is manufacturing its own displays. We have invented a new display technology called Next Paper. But it doesn't have any harm to your eye because it just takes the environment light and reflects it. So you can watch videos, play games, and surf the internet. That is a concrete product which we have invented based on the pandemic situation.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Investment apps, including Robinhood and Interactive Brokers, have introduced trading restrictions after social media campaigns caused volatile movements in the prices of companies like GameStop and AMC. That story is on the website now. Retail investors have also sparked a rally for joke cryptocurrency Dogecoin. The currency added over $7 billion after users on Reddit talked about making it the crypto equivalent to GameStop. Head online for the full story. A global tax on tech giants is now highly likely, according to German Finance Minister Olaf Scholz, following a call with new U.S. Treasury Secretary Janet Yellen. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
Helping you navigate the new normal. Squawk Box on CNBC.
look at the Reddit trades as we head to another quick break. GameStop up more than 70% in today's session. AMC up 60%. BlackBerry up another 9.5%. They just keep going. Early Robinhood investor Tim Draper joins us after the break. We are back in 2.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our staff.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation, and startups from one place. CNBC.com/technology.
One key decision by Robinhood made 2 years ago is now being seen as that first domino that triggered the platform to restrict trading. Kate Rooney joins us on this. And Kate, this is wonky, but it needs to be broken down because this is such an important part of the story.
That's right, Deirdre. This is key. I talked to a ton of analysts and even some early Robinhood investors last night who say the decision in 2018 by Robinhood to get rid of a middleman, so they now clear and custody trades in-house, is really the crux of what's happening this week. It kicked off Robinhood's needing to restrict those trades of GameStop. So going back to 2018, this was a major investment. It was really seen as a money saver at the time. Vlad Tenev told me back in 2018 that this would help them expand quickly. He likened it to Apple deciding to build its own chips or Amazon investing in fulfillment centers. So instead of relying on a third party like most of those fintechs do, so think of Square, who use a middleman and another clearinghouse, Robinhood instead settles and clears customer trades. They provide custody for assets, and that in turn gives them a bigger slice of the revenue behind trading. But it also raises the bar for how much money Robinhood needs to have in-house to meet those capital requirements. They need to send cash every day to the Depository Trust Company, also known as the DTC, and that can really change on a dime based on trading volumes. I'm told that the DTC increased the amount that firms needed for margin calls, especially on GameStop. Robinhood, of course, told CNBC repeatedly that this was not a liquidity issue and these moves were preemptive. But remember, Robinhood raised $1 billion this morning from some existing investors. You had Sequoia and Ribbit in there. They had to tap their banks for a line of credit and told some customers that they might need to close some of those at-risk positions. Robinhood, of course, yesterday getting accused of sort of changing the game, changing the rules in the middle of the match But if you think about it, these are really the rules of the game. Robinhood has to comply with its regulators. It is the same thing that happens all the time at Schwab and Fidelity, who also clear trades in-house. What really complicates this, though, for Robinhood is that viral social investing. Robinhood really has been the face of it. People are piling into the same stocks, and they're using a lot of leverage. John, back to you.
All right, Kate Rooney, a lot to digest, and investors need to understand about exactly how all of this works. For more on the Reddit revolution and for his reaction to this boom that we're seeing in Bitcoin as well, Draper Ventures founder and early Robinhood investor, Tim Draper. Tim, great to have you. What's the lesson here about the way markets are changing from what we're seeing? And I know that besides being early in Robinhood, you were also early in Tesla. Tesla's been dogged by shorts in the past. I'm sure you're not crying any tears for the likes of Citron either. What's this new era that we're entering into?
Well, I think if the government locks people up in their house for long enough, those people figure out ways of gaming and then eventually breaking the system. This is really, I mean, to the that Reddit investor group, my hat's off to you. That is amazing what you've done to take a company that's clearly on its last legs and bolster it up with investment and send a ripple through the, or I don't know if a ripple's the right word, but through the
tidal
fear,
wave,
through the minds of these short sellers. And it's true, they're short sellers. I mean, they make money on, they're like the undertakers of the financial community. They make money on the harm of others. But
sometimes, I mean, I mentioned before, the mortgage-backed securities,
they do create liquidity.
The Big Short, Enron, sometimes the shorts will do investors a service, right?
They will highlight things that need to be highlighted, absolutely. And they create more liquidity in the market, and that is an absolute wonderful thing to do. On the other hand, I kind of love what's happened here. I mean, the Reddit investors have used Robinhood and other platforms, but mostly Robinhood, because it's so easy to use. They've made it so that there are no commissions on the trades. They've made the app so easy. It's as easy as ordering a burrito or something, and it's kind of allowed that small investor to get involved. I feel for the small investors who are getting caught in the middle of it, not really knowing what they're doing and jumping in and kind of getting stuck, because, I mean, when Robinhood hits these ratios, they have to stop trading. It's really interesting when you have a short position like that, or when these short guys have these short positions. I never go short. I don't recommend for anyone ever to go short, because your downside is unlimited. Your upside is limited. Your downside is unlimited.
Well, Tim.
But the short.
Hey,
yeah, go ahead.
Sorry, I just want to ask you something. It's Deirdre, by the way. Good to see you. As an early Robinhood investor, how was the business model pitched to you?
I asked how are they going to make money, and it was on selling the data, and that actually was a great model, and has been a great model, and they've grown, and that has allowed them to take more responsibility.
So, Tim, I just wonder, does that business model, though, incentivize Robinhood to act in the best interest of its traders, or to, allow market makers to pay for that order flow and thus incentivizing them to profit off these commission-free trades?
Well, they love their customer. They love the small investor who can participate in this global economy.
But are they getting the best executed trade? In this business model, is the retail investor getting the best executed trade, the best price for their trade?
Well, they're getting a lot better than they did from any other service. So, yeah, I guess that would be a yes.
Tim, let's talk about Bitcoin. It has been moving on. I'm not sure exactly why it has been moving. What is your take? How much of this has been about the sort of global and even U.S. domestic instability? How much of it has been concerns about the financial system and even the situation we were just talking about and whether it's rigged against the little guy? And how much of it is what you've been saying for just a long time, that Bitcoin is the future and it's going to go up and up and up?
Well, I do think that Bitcoin is just a better currency, and in all technology battles out there, the winner is the one with the best technology. Eventually, people see the light, and it's starting to happen. Bitcoin has been a marginalized currency for a long time, and all of a sudden it's gone mainstream because when the U.S. printed all that extra money, people said, oh, wow, there's an inflation risk. And they didn't want to go back to gold because that's kind of going back into the past. They decided they would want to go into the future and have some sort of a hedge. Now, actually, the financial institutions are saying it's a risk not to have Bitcoin in your portfolio because they've actually made calculations that that even 1% in your portfolio of Bitcoin hedges against inflation, but it also has a potential to make a 1%, like a real 1% return on the entire portfolio.
And you're a savvy investor, Tim,
really,
of course.
Time. I think so. It's gone from marginalized to mainstream, and the mainstream is starting to realize I got to have it on my balance sheet. I got to be a part of this.
Right.
And
how much have you sold?
If it is,
I mean, I know you're still holding. I assume you're still holding Bitcoin, but how much have you sold? Is this a hold on for deal life situation for you? Or do you kind of balance out your portfolio over time? Do you have a strategy where that's concerned with Bitcoin?
No, I'm actually just buying more. The thinking is that over time we're going to be able to spend it, and I have no interest in ever selling my Bitcoin for dollars. Why would I take the currency of the future and sell it for the currency of the past? I mean, do I want like Confederate dollars? No. So I'm looking to continue to build on my currency of the future, but long term, I'm in the venture capital business. I'd like to put this Bitcoin to work, and I think that the regulators are going to recognize that this is a valuable way for people to conduct business, and they get their tax dollars, they get their share. Okay. And with my business, I can actually raise money in Bitcoin, invest it into a bunch of companies in Bitcoin, have them pay their employees and suppliers in Bitcoin, and the whole thing keeps a perfect record of everybody's financials all the way through. So I can see how my portfolios are doing. I can identify
I love that. Hey,
possible risks.
I mean, whatever one might believe.
You can pay in Bitcoin too. Investors in Bitcoin on a smart contract that then filters through the waterfall on a smart contract. So I don't need to have a transfer agent. I don't need to have the audit. Gotcha. I don't have to have the accountants. I don't have to have the bookkeepers. It's all done right there on the blockchain. This is
you clearly believe in it, and the fact that you are just adding even as high as Bitcoin has gone speaks to that. Tim Draper, thank you.
Guys, we're watching a couple of different things. One is the Treasury Secretary briefing the president on the state of the economy. Got comments from President Biden a few moments ago. We'll get those to you after the break. In the meantime, despite the selling today, NASDAQ is hanging on to a gain of about 2% or more for the month, led by some of these gainers on the NAS 100. We're back in a minute.
Let me show you something.
What is this?
Every time we bought timber, I paid a little extra to regrow trees with my own money.
But why?
Why do you think?
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
Navigate the new normal. Squawk Box on CNBC.
The attack on short sellers continues, this time from CEOs, as Andrew Leff's Citron Research said it will no longer publish short reports and instead focus on long positions. Shopify CEO resurfacing an old tweet from Citron, betting against the stock back in 2019. Now, Tobias Lutke says that he will donate $200,000 to the Robinhood Fund, not the trading platform. There's also Box's Aaron Levy also tweeting at Citron saying, quote, "You did it, Reddit. Wow." We are going to take a quick break, much more ahead, so don't go anywhere.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020 for $12 billion. Very attractive valuation. This provides tremendous value for our shareholder.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
This story went from a dilapidated, rundown duplex all the way to the White House.
Mr. Haley was surprised at how easy it was to make an extraordinary amount of money by doing essentially nothing.
How far would you go?
You can smell the money. That's why the clients come here.
For money.
$40,000 would be paid for the killing of the judge and the prosecutor.
American Greed on CNBC.
GameStop was the big hedge fund squeeze. At least that's how many in the Reddit community framed it. So what is the view from within the long-short hedge funds? Brad Lemonsdorf, who runs the Active Alts hedge fund, had taken a position in one of these shorted names, BlackBerry. He joins us now. Brad, do you still have that short position in BlackBerry?
No. That's a mistake. We weren't short BlackBerry. We were long that stock in our long-short portfolios.
Okay, got it. And are you still long then?
We sold in the high teens. It certainly went a lot higher and lower, but we caught a nice piece of the move, and there's been plenty of them.
Okay, let's talk about this whole phenomenon more broadly. We just heard from some CEOs speaking out against Citron, abandoning its short selling. Do you think that this changes the industry, the way that hedge funds place short bets ultimately?
For the time being, they're going to certainly be more cautious. We do have a short-only ETF under the symbol of HTGE. I used to do this for the Bass Brothers as well in the mid-90s. It certainly was a robust rally period, as well as 99. I ran a long-short hedge fund as well. And I could just say that, experienced short sellers traditionally do not get into these crowded names. These crowded names, frankly, are extremely expensive to borrow from the banks. And it's just something that we really don't engage in. If we find a company that we think stinks and we think it may have a bankruptcy, but the fact is that 50 or 30% of the short is already the float is already short. There's really, you're telling Noah about the flood. Everyone's on it. Everyone knows about it. The idea of shorting is basically finding names that no one's heard about that are in trouble, and not the high-profile names that can get you in trouble, like what we've just seen.
That's interesting, Brad. I guess two questions would follow from that. One is, how do we explain Melvin? The other would be, it doesn't sound like you necessarily agree with this dark view that the short funds will be scared into shorting from now on. They'll delever on the long side. Spreads will widen. Markets become more brittle, and that's how crashes happen down the road. It doesn't sound like you see that sort of dark scenario taking place.
Well, I'm not saying that I don't think that things have gotten way overboard in the stock market over the last year. Many of the sentiment gauges, I have a research portal called lmtr.com that we put out a lot of this stuff, and all the sentiment gauges, the put-call ratios, any type of euphoric type of sentiment that you're looking at is very 1999, 2000-ish. The fact is there was a lot of money on the sidelines, people scared that didn't want to put money in during the year. We were very bullish at the lows. The HDG ETF actually went to 50% cash. We are certainly not there now. And I definitely think we need to pull back. And I frankly think that higher interest rates probably are going to be the catalyst, no matter if the Fed likes it or not.
So, Brad,
go ahead.
So, Brad, how should the rules change around the process of shorting and how much people are allowed to pile into these positions?
Yeah, I've always thought, like I told you, I think it's crazy that some of these guys gang up on some of these stocks at 40, 50, 80% because the winner is the stock lending departments that are lending you the stock at 30% interest a year. So when you think about that, if you think that you can make 50% on a stock, but you're paying the bank 30% a year in interest, that leaves you a very small profit left over. So to borrow securities at such a high interest rate just doesn't make any sense to us whatsoever.
Brad, why are hedge funds allowed to short up to 50% more than the float of a company? What's the economic benefit of that?
Well, there is no benefit except that they have obviously felt like they've done a lot of work. They've put a lot of time and effort into finding something that they think might go bankrupt. Maybe the positions, the company's so small that they continue to pile on even thereafter. Being over 100% is illegal. Like the security lending departments are certainly as much to blame as anybody else. You have to be able to secure the borrow before you lend a stock. And that's just a lackadaisical compliance officer as far as I'm concerned. I mean,
so if there's no economic benefit, then I wonder. Go ahead.
Well, there is no extra economic benefit except that they want to short more. I mean, there is none. For me, I run a group. I run a group called Active Alts. We have a strategy called Focus Momentum, and we could specifically go after stocks that are highly shorted. As you know, a few years ago, I came out with the SQZZ ETF, and I had a disagreement with the group that was running it for me, so I moved it into an SMA account. And we've caught many of these stocks all year long, and it's frankly, very puzzling to me why some of these managers pile into a name like, say, Workhorse, which we're still long, and it's 30-40% short float, like it's crazy. And it gives the longs a huge opportunity.
Right. Okay, well, Brad, thank you for coming on, explaining this to us. Brad Lemonsdorf.
Thank you.
As we go to break, take a look at the New York City. Governor Cuomo following through on a promise to open indoor dining at New York City restaurants on February 14th. Maybe in-person weddings by March 15th. We're going to watch that. And as we go to break, take a look at GameStop. Remains in a pretty narrow range relative to the price action of the last few days. We'll be right back.
I heard you guys have Workday now.
Yeah, they're a great partner. They're always there with insights and guidance. It's like having a business caddy. Who can run Detroit?
The VP there is well qualified.
We can staff Detroit from within.
You good for golf on Saturday?
Can't. Closing the books.
Team's already finished. Took half the time.
And I'm back in.
There's an opportunity in New York. Not this quarter.
Workday, a finance, HR, and planning partner like no other.
The German Finance Minister Olaf Scholz has told CNBC that Europe did the right thing by coming together to forge a joint approach to fighting the fallout from coronavirus. However, speaking exclusively to Aneta, Scholz admitted the bloc was acting too slow in its COVID vaccine procurement.
We have to admit that there could have been a situation where Europe would have asked for more vaccines earlier in the last year, but now anyone is working very hard to do the best that we get enough vaccines.
Keep up with the crisis. Squawk on the Street on CNBC.
Before we go, the information has a piece out this morning on the reactions of several Robinhood employees yesterday after the platform restricted buying of certain stocks like GameStop, saying the company, quote, lost its way in its decision to halt trading. Robinhood then, in response, gave everyone on staff, about 1,000 people, $40 DoorDash gift cards, a gesture, John, that the information says was largely seen as empty-handed. So they're not only dealing with blowback from their clients, often dealing with blowback from their staff.
Rough week in a lot of ways for Robinhood. I mean, we heard from Jason Calacanis earlier, Deirdre, about still believing in the company, in its mission. We'll see if some of these individual investors who were caught in this situation this week forgive them. But I got to think it's not everybody, probably, on Robinhood that was caught in this. And I guess if they raised $1 billion, they can afford to give away those $40 gift cards.
John, I think it's about this narrative that Robinhood has created over the last few years, empowering small investors. And as it turns out, as many people are finding out as we on the show, that they're just as much in bed with Wall Street as many others, Carl.
Yeah. Have a good weekend, everybody. We'll see you on Monday. Let's get to the judge.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the state of stocks and your money after this wild week and what lies ahead for it. We will discuss and debate with our investment committee. Joining me for the hour today, Jim Lebenthal, Steve Weiss, Pete Najarian, Kerry Firestone is the CEO of RES Asset Management. I'll take you first to the wall. Let's see where stocks are currently trading. Dow's down by about 400. S&P's off 1.25%. NASDAQ down 1. Russell 2000 flat. Worst week in about 3 months. I like to set the state of play. So we do have that. You got the month end for the markets. The S&P is flat. Wondering whether FANG did enough this week, at least the ones that have reported, along with Microsoft, to reignite that trade. You've got the J&J vaccine data we're all sort of poring over and trying to figure out what happens next there. So, Pete, where does this leave us?
Well, I think at some point in time, we've been talking about this for a while now, Scott. When are we going to see this pullback that everybody seems to be talking about, including myself, after we've had this run? It was just a couple days ago where we were still hitting all-time highs. So we've had this incredible run to the upside. Everybody's looking for some sort of a pullback, and maybe that's part of the problem. But I do think that at some point in time we will. As a matter of fact, I've tightened up a little bit of what I'm doing, but I probably need to ease back on some of the equities that I still do own. I've cut back some, but I've started to get a little bit more aggressive with what I do in terms of the calls that I sell against my long stock positions. As far as the option positions themselves, I will continue to just trade like a madman because we are in a frenzy of a market right now in that world. We traded 60 million contracts 2 days ago, 50 million contracts yesterday. The pace that we're on right now for January, which is just about over, is somewhere close to 45 million contracts a day. Just to put some perspective onto that, in previous years, we've averaged 20 million per day. Last year, we averaged 30 million per day. So we are really at extraordinary levels, and it's been a great opportunity in the derivatives markets, but you better be educated and understand all of the risks, because this is not a joke. This is something that's very, very serious, and you have to understand the risks when you put on some of these option positions.
Hey, Pete, give me an idea. When you say, you know, maybe you need to be a little more aggressive in taking down some of your equity exposure, give me an idea of some of the moves that you've made, or at least give our viewers an idea and what sort of that represents of your point of view right now.
Sure. Well, I've got quite a few different stocks that I am long, Scott, in my portfolio. And what I've decided to do to be a little bit more aggressive, because I haven't figured out which ones specifically that I need to lighten up on. I still like these stocks. I'm just wondering which ones might have the most pullback potential because of maybe the markets getting sold off like I would expect, which would be somewhere between a 5 and a 10% maybe pullback. So if we do see something like that, I want to be prepared for it. The only preparation that I've done is the aggressive nature of how I'm approaching selling calls on top of the option of the stocks. Normally, if I own a stock, for instance, that's trading at $50, I would normally be trading and selling an option maybe a month out that's the 55 strike call and trying to get enough of that I can. Now I'm going right on top of these stocks. I'm literally trading. If the stock's trading 50, I'm selling the 50s. If I'm looking, even in Apple's, great example. Even with Apple, when it was trading about $1.40, I was selling the 140 strike call. So I've been getting a little bit more aggressive. Normally, I'd be trading something further out of the money. So it's just a way to try to tighten things up, get a little bit more of juice, so to speak, so I have a little bit more room to the downside when if we see a pullback.
I hear you. And we'll go through some of the names specifically as we go through the show today. I want to try and get through a lot of names today for our viewers. Kerry, so where does this leave us? Kramer, calling in earlier said, don't read too much into the rest of the market from GameStop. The numbers have been very good. He's talking about earnings. Chris Ailman, the CalSTRS CIO, says it reminds him of '99 all over again. A wake-up call. A crowd is okay. A swarm is dangerous. Referring to how some of GameStop has been traded. Where does all this leave us now with earnings really going to get hot and heavy next week?
Yeah, well, it's interesting, Scott. we had seen a little shift back toward the growth stocks. So if you looked a week ago, it seemed as if Apple, Microsoft, Facebook, those names, Netflix, they were really gaining some traction. They reported excellent earnings. You know, if you look at the numbers, Microsoft, revenues up over 30%, Apple and Facebook in the 21-24% range, beat on estimates of earnings and on revenues in all sectors, really. So then what happened? We had this enormous short squeeze, and the FANGs, to some extent, are a source of funds. They become the virtual money market fund from which traders can get assets quickly. So I think they suffered this week, despite their good earnings, from liquidity pulls in order to cover the shorts.
Oh, you think that?
And, you know, we don't have enough evidence.
But you think that's why, yeah, you know, like, let's say an Apple absolutely knocks a cover off the ball with their earnings, right? The most profitable quarter ever. Facebook does the same for the most part. And then those stocks have traded down.
Right.
On the week, both are negative for the week. So you're suggesting there was a direct correlation to what we were witnessing with GameStop and how some of those other names have traded.
I think it's possible. I mean, I don't know that. But if you're looking at stocks that a few months ago were 25% of the S&P, I mean, there's still an enormous weight. Apple is up, yeah, I mean, it's 7+% of the S&P. So it makes sense to me that if you need something to cover, you just sell a few shares of Apple, Microsoft, Amazon, Google. You know, there's the way you cover it. That's where you get the $2 billion fast. So I was very pleased with those earnings. We thought that they were excellent. And by and large, what we've seen so far, even, you know, a name like Sherman-Williams, great numbers. And we think that that should continue. It's not as if we have no risks in the market. We're up at 22 times earnings, and we have to have good numbers. The market expects good numbers, but they've hit the numbers. They've raised estimates. And with the good vaccine news, I mean, that J&J number was good. Well, maybe talk about it later, but we're running toward the point where we can start to produce more vaccines for more Americans. And that's the only way that we get to the other side of the road. We can't, you know, I can't obviously reopen.
So what's the deal now, Weiss? I mean, where does all this leave us? You know, we're going to be questioning, did FANG, big tech, along with Microsoft, did it live up to the hype that it had to? Maybe Kerry's right. There was some source of funds coming from there to take care of some other issues. Does that trade get back going again? Alphabet is coming up. Amazon's coming up. There's some other names that are coming up next week that are going to be closely watched. What are you watching for most of all?
You know, I'm sticking to fundamentals. I haven't bought into GameStop being a revolution or anything like that. That's a bunch of crap. It's an isolated instance, and even the guy who started the so-called revolution was just looking for a cheap stock they've owned for a couple of years. So I'm focused on fundamentals, and guess what? The fundamentals have been good. So while you could say that the Apple price action and the Microsoft price action and the Netflix price action disappointed, that's not true. If you look at 1 day or 2 days after earnings, that may be true, but if you look to the buildup in advance of earnings, they actually acquitted themselves quite well.
Oh, yeah.
Just most of the juice was taken out early. So I'm continuing to look at fundamentals. I like the under-the-radar names in my portfolios. Skyworks, up 80%, blew out numbers. I mean, blew them out, up more than 50% above consensus and doing quite well in revenues, too, up by 50% versus what revenue projections were. So that's 17 times earnings versus a market that's 22. So you can still make a lot of money. What this is, it's a typical lull in an earnings reporting season where the market's trying to figure it out. There's some nervousness. As Pete mentioned, nobody would be surprised by a 5% pullback. I know I wouldn't, but I'm staying with growth, staying with the fundamentals. If you take a look at reporting up until today, you've got profit margins that we haven't seen on S&P companies since early in 2019 and late in 2018. So despite the pandemic, companies are doing well, and I think the market deserves to be where it is and go higher.
Oh, okay.
But you've got to pause. The pause refreshes at some point.
But so you know, Pete sounds like he's looking to de-risk a little bit some of his equity positions, and he's sort of rejiggering things through, you know, the options market in which he has made his living, his name, and certainly knows better than most people on planet Earth at this point. Jim, are you looking for a correction still, like you have been for, you know, I think fair to say the last many weeks?
Yes, I am, and I think we're in it right now. You know, when Steve said down 5%, we're down 4% on the S&P 500 from the intraday high just a few days ago, and I think we'll get to a full correction, 10%. I don't think you'll go much more than that, simply because, you know, you've got the power of the Fed and zero interest rates. But look, I think this correction's happening right now. I've got about 16% cash. I sold a little more this week, and I have to say, I look at margin lending, I look at the Reddit phenomenon, and it just seems these are all indications of a near-term top. So I think we're in it right now, Scott.
But let me see that. I look at the moves that you've made, Jim, and look, you correct me if I'm wrong. You know, I try and remember as much as I possibly can the moves that you guys made. If I do recall correctly, though, you've been a seller lately. You've been a cash raiser and a waiter for a move you expect, whether it's today selling Viacom CBS. I think the last couple of times, 2, 3, 4, 5 times you've been on, you've told me about stocks you've sold rather than things that you've bought. That's emblematic and representative of your point of view.
That's exactly right, Scott. You remember correctly. So Viacom today, which is simply, it's up 33% in a week. It's up 500% from the March lows. Great company, but I think it just got caught up in this Reddit thing, so I decided to take my money and sit on the sidelines for now. But I also sold Caterpillar, and they reported earnings today, really, really good earnings, and yet they're still below where I sold it, which is simply indicative that it was above fair value. It's just a simple portfolio manager's decision to sell a security that is above fair value. Same thing with Winnebago. So I've just raised cash because prices got too high. The flip side of that is I haven't bought anything. And that is, I will admit, a market call because I don't like this market right here. I don't like what I'm seeing, all this volatility, all this, you know, this mania that is Reddit. And I'd rather just sit on the sidelines and let the dust settle.
So, Kerry, you have bought recently, you bought more Facebook, which, you know, look, we're just talking about sort of where FANG emerges after this week, at least, let's say half of it. And now we look ahead. You bought more Facebook.
Yeah, well, we expected the quarter to be very strong and for them to beat and to raise guidance. And if you look at the numbers, they were incredibly strong on the ad side, you know, 30% increase. And that just shows that these platforms, and Facebook has, you know, billions of, 2.7 billion average daily users, that they have a way to reach for advertisers so many people, and it's become a much more attractive buy than most other forms of advertising. So we saw that, we expected that to be in the numbers and for this to continue to go forward. Also, in terms of the bickering that seems to be going on with Apple and Facebook, we think that's news, and that will somehow resolve itself. It's in the interest of both companies, for both Tim Cook and Mark Zuckerberg, to come to some resolution. We expect that to happen. And the regulatory push right now is a little off of these companies. There are other issues to deal with, such as what to do with Robinhood and this GameStop phenomenon and the COVID vaccines. There are other things for the government to be concerned about than regulating Facebook right now. And so we like the numbers, or what we thought was coming, and that's why we added to the position.
Weiss, are you at all, anybody you're talking to, worried about spillover in the broader market because of this, you know, as Jim says, the mania around GameStop? I ask you that because obviously Wall Street's talking about it. Barclays says, you know, bubble trouble or a storm in a teacup. That's their question. Quote, the ongoing short squeeze in a few stocks by retail investors has raised concerns of a broader contagion. The risk of a full-fledged contagion, though, remains low. There's another note from Wells Fargo today. We've heard various first-hand and second-hand views on hedge fund degrossing, de-risking. Some believe it's almost done. Our sense is that it's about 75% done. The implication, obviously, if you have to de-risk, you're selling, right, into a market that's a little volatile. How do you address that whole issue in and of itself?
Well, looking at some of the prime brokerage data from the big firms that handle most of the funds, you've seen de-risking. That means, as you said, taking down the gross, selling your longs, buying some shorts to the equivalent of what they did in March when COVID first started. So yeah, so that's I think is just about all behind us at this point. So that creates an opportunity. I don't see this spreading to the overall market. If you were bearish coming in, it gives you another reason. If you were bullish coming in, it gives you an opportunity. As Jim points out, we've already corrected. I'm up to, believe it or not, a similar cash level to Jim. But my plan is to add to things that had great quarters, like a Teradyne or so, that's not a max position for me. So, no, I don't see the spillover. I don't see any semblance of 99 when people that work for me were leaving to work at garage.com or toy.com. This is not it. This is a blip. This is like Occupy Wall Street. This is nothing that's going to impact the market. It's not going to create socialism. It's not going to bring in, massive legislation. I do think, and I have great ideas for how they can control the short story, but that's different. So, look, to me, it's just a pause. You got to come down at some point. I think we're going to do fine going forward. A little more downside, but I think you can buy here on research names. Don't play the speculative names. So,
well, let me ask you this, though. Let me just play off this sort of point you're making now, because I think it's an important one to address. I mean, there has been a retail renaissance in this market. The pandemic may have pushed that, from people who were looking to do something. I don't know. But there clearly has been more retail participation. The market has been more democratized through Robinhood, other venues. That's a good thing. That's a good thing. There's no suggestion. I don't think you talk about things being a blip. Are you suggesting that retail is here for back for a stated period of time, and then it's going to evaporate once market conditions change, which may not be for quite some time and may largely be controlled by what the Federal Reserve has done and may do sometime in the future?
No, that's not what I'm saying. I think you have to go into different segments. So I do think the retail renaissance continues, which, by the way, has been going on with index funds. They brought in a lot of retail money, still a lot on the sidelines. What's the blip is what we're seeing with Robinhood in terms of going after these stocks and running them up. It's going to end badly for them, very badly, which is why I own some GameStop puts. It's more of a lark, small position. I own the March 12, 20s, 25s, and 10s. I think I'm 25 as well. Definitely the 20s and the 10s. If it gets there, great. If it doesn't, they're already up. Why should a stock that's trading near 400 have puts at $10 that are up? $20 puts that are up. So it's all ridiculous. So that goes away. Retail stays here. Particularly, you can't make money anywhere else. 10 years still about 1%, right? You got to wait a whole year to get your 1%. So the market is, and I'm in favor of democratizing investing. But you also have to be careful. Like, why Robinhood? Because it's got a catchy, marketing theme. Go to a Schwab, go to a Fidelity, go to something that's got the capital that's not going to stop you trading. There are regulatory requirements for capital. There are requirements that DTC, that clears all the trades, puts out. They can raise them, they can lower them. Robinhood was underfunded, pure and simple, and that's what did it. It wasn't the system. It was, if you want to trade for free and you trade free at the others, then you got to get what you pay for. There's another side. And that's where the investor needs education as much as in shorting stocks or going long the AMCs.
So let me ask you guys this. Jim Lebenthal, as we note also that the Dow right now is down about 500 points. Does retail's participation, this, as I say, renaissance that we've all witnessed and we think is a good thing, what does that mean for the trajectory, if anything, of the overall market? That you have just a new class of people interested in the stock market and willing to put money to work?
I think it's very, very good. And I feel like most of 2020, we were lamenting that retail was on the sideline. And now here they are. It's positive for the stock market because on net, retail are buyers. That has been true through history. Now, Steve's pointing something out, and I'm going to phrase it a little bit differently. You can get a little too much of a good thing. And I certainly remember the late 90s. Go look at the E-Trade commercials from the late 90s. They lampoon how, retail can get carried away. I don't think we're there yet. I think this GameStop stuff is pretty narrowly focused, and I really don't think it's going to be contagious to the rest of the market. But to answer your question again, I think it's unequivocally good to have more participants, and on net, they are buyers.
Carrie?
Well, it's an interesting phenomenon. We've gone from 15% of the market was retail traders to, I would bet, close to 40% recently. I've written a couple of pieces for the CNBC website about this, and I've suggested that the only things that might change the participation of the retail investor would be a very sharp increase in interest rates, in which case there would be another place you might put your money or some of the money, or if the market were to go down significantly. Because since people have started to trade wholeheartedly, which is during COVID, so maybe they opened their account in March during the first of the lockdowns, the market has gone up. I mean, it's gone up 70% since the end of March. And that's a huge incentive to want to participate and be part of that phenomenon. I would say that on the topic of democratizing the market and this call that we've heard, by and large from people from Elon Musk to Chamath to Elizabeth Warren, it's got an amazing number of participants in this dialogue, that one of the ways I think needs to be addressed on democratizing is looking at the market makers at a place like Robinhood. So Citadel trades the majority of the shares. And while the investors or day traders think that they're doing this for free because there's no commission, so to speak, they are paying for every single share because the market makers and the platform take a cut of every share traded. And there may be incentives toward the selling side or the buying side. It's just unclear because the type of revenues and fees that are taken are opaque. And I would start with understanding and having everyone understand who's paying what, to whom, how much. Is it more for the short side or the long side? We don't know that. And that, to me, is where we really need to begin if we want to elicit some understanding and support to help democratize.
The structure of the market and the intricate nature of it and relationships between parties, counterparties, and things like that have been an eye-opener for many this week. Based on some of the events that we've witnessed and some of the people who weren't able to trade the way they wanted to yesterday. That's certainly an issue that needs to be looked at as we look further into the future. I guess the next question is, we've all been transfixed, Pete, by this week. Mm-hmm. Do we get back next week to focus on the things that matter most, which are earnings? I mentioned some of the companies that are ahead of us, Alphabet and Amazon, but more broadly, earnings are going to matter again, right? They didn't really matter this week because we were all talking about something else. Do we get back to that story?
My version of it's a little bit different. My version would be that the earnings did not disappoint. They hit pretty much the numbers people expected, right? I mean, when you just brought up Facebook and Apple and Microsoft and they absolutely crushed it, what did everybody think? That they were going to crush it. A week and a half ago, Apple was trading 127, jumped up to 144 into earnings, and they got those great numbers, but that was something that everybody kind of felt was a known, and so it makes some sense that maybe there's a little bit of pullback from there. You look at something like Microsoft, 212, gets up there towards 240, it pulls back a little bit as well. So I don't know that I would agree with you that the people aren't paying attention. I think that we're just seeing the kind of reactions because of what had happened in the previous weeks going into earnings for some of these names, and we haven't seen a whole lot of names that have extended past that after they've actually reported. But, to Steve's point earlier, Scott, by the way, he was talking about GameStop. He said it doesn't make sense that his puts would go up in value with the stock going up. I would actually shake my head and say, actually, you're wrong. If the volatility, the implied volatility of those options goes from 300 to 800, which is what's going on right now, of course those are going to go higher. And it's going to happen as the stock goes higher as well, because the implied volatilities in many of these names, and going into next week, to answer your question now, going into next week, Scott, I think when you're looking at all of these earnings, there's a long list, a lot of pharmaceutical names. It's going to be very interesting to see as we dissect through all of those. But the reality is we will still trade all of those names. Everybody still will be trading those names. it's not just a GameStop story. I think everybody's got this wrong if they think, because it's the focus, because it was such an unbelievable target. There's a lot more targets out there, Scott, especially when you know what the forensics really look like on where the targets are going, and it's very smart. It's really been a tactical, interesting thing to watch, and it's why I've participated, because there are opportunities out there, and I've been very conservative with how I've played it, but I'll tell you what, it is a crazy town when you look at what's going on there, and I talked about those volumes. Some of the volumes in some of these names in the stock, but also in the options, are 10, 20, 30, 40, 100 times normal. So this is not over just if GameStop was to start to pull back a little bit and everybody got relaxed. There are many other names out there that I think still exist.
Well, yeah, speaking of Boeing...
Scott, can I just...
Go quickly,
I'm sorry, can I just come back to the options 1 second? I mean, I agree, Pete, with the implied vol moving up. But when you're talking about a stock that's moving up nearly 50 or 100%, and it's 400 points away from the puts, they typically trade down, particularly when the delta is almost at zero. So I agree with you on the calls, but on the puts, and then time value, a week less, expiration today, no, they shouldn't be up 25% as they are today. And that's what they're up, the $10 puts, in March 19.
Pete, quickly?
Yeah, I would disagree with you again, but I would disagree again, and I'd also even point out, just go back to the financial crisis. When we had the financial crisis and we were looking at all those financials and banks, and we talked about names that no longer even exist, like Bear Stearns, obviously, that one always sticks out for me most, because that was the first in March, and then later, as we got later into the year, that's when the rest of this started to unfold. But they were buying things there, and the stock was going higher, and we were hearing from the CEO, and yet they're buying far out of the money puts, and those puts were going up in value. Why? Because the implied volatilities was spiking so much so that those actually started to gain with the stock as it was going through gains. So implied volatility is a very, very interesting thing to watch, especially if there's a little bit of time value involved. You're talking about March. It makes even more sense now to me.
Okay, let me do this. I do want to get...
There's no volatility there. There's no volatility here. It's just people going in and buying it. You would never see anybody buy a $10 put. Here you're seeing 5,000 contracts trade down there. That's why it's supply demand. Right. It's not the implied volatility.
To be continued. I'm going to take a quick break. I do want to get, before we get out of here today, Boeing we got to talk about, because Jim owns that, along with General Motors got its price target bumped. We're going to kick around that, along with some other names too. We're also going to speak to Skybridge founder Anthony Scaramucci. He'll join us to talk about all of this. We'll talk about Bitcoin too. And we'll do it next.
The pandemic has definitely changed how brands are communicating, and it is a difficult thing to find the right balance. Today I see lots of brands doing a great job reflecting this situation and try to show as well that they understand the consumer and situations they're living in and try to adapt their messaging. We have changed the way we communicate with our customers. We needed to shift into an online environment and find solutions on how you display and promote smartphones or mobile category products, because most of the users, once they touch a product or look at it and they see the design effects in the store, this is something where we put a lot of emphasis to get this haptic feeling on the products. We use more video assets to try to give the user a good feeling about the design of the products.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Brian Sullivan. Good morning. Worldwide Exchange on CNBC.
at this GameStop situation is the craziest I think I've ever seen. Usually you have a short squeeze and it goes up, but this one keeps going. So this really speaks to the changing demographics of investors in the market.
I think there is something obviously wrong, and it's the gamification of Wall Street.
I am not buying these stocks because that's where I think you can get burned. So people have to be at least educated enough to understand risk reward.
If interest rates go up, I think a lot of this game goes away.
If you want to go and address the solution, fix how risk-taking happens at the institutional level, fix the precondition, fix the ability for these stocks to be so massively shorted in the first place.
I think that when large, powerful Wall Street interests are put at risk, something usually happens that changes the rules of the game to allow people to escape.
I understand what's going on in the market. This is not going to end well when it ends. And the bigger question is, when does it end? I don't think it ends soon, but I think it will end, and it will end very badly for the public.
Been a big week here on The Half. Those are some of the names, our investment committee members, too. This week, weighing in on the Reddit-fueled short squeezes in the market. Let's bring in another voice into this conversation now. Anthony Scaramucci of Skybridge Capital joining us. Anthony, good to see you.
Good to be here, Scott.
An incredible week. Certainly, we've heard from a number of important voices on our program this week. I know that you've talked to a number in your own right. What's your big takeaway?
Well, listen, I mean, it was bound to happen. You have a full-on decentralization and democratization of trading. The trader now through the palm, the smartphone, is getting all the same information as, say, a Goldman Sachs prop trader in the mid to late 90s. And so this was bound to happen. These people are smarter than people think. I do believe that Leon Koopman is going to be right, though, that it ends in tears for many people. Because ultimately, as you know, what's happening, and this is what got Robinhood in trouble yesterday, is the pyramid scheme on the way up in terms of the leverage buying of those names that everyone on your show and most Wall Street professionals know that those names are likely fundamentally impaired. And so what I would say to people is we're in the age of decentralization. Somebody like a .72, a Steve Cohen, let's say, I would never bet against him. He's adapting right now to this new reality. And so, as you know, Skybridge has a lot of money with .72, but on the same side, we've taken a barbell approach where we've got money in Bitcoin, which I think is the epicenter of this democratization and this decentralization of finance. So I would say we have a leg on both sides, if you will, Scott.
I know why you're talking Bitcoin. It's your new product. I know you want to talk about that. We'll get to that in a second. You, in your own right, helped democratize a part of the market, that being the hedge fund business, right? I mean, that's essentially what the fund of funds industry did. It allowed more average Joes, if you will, who don't have quite the amount of capital to get into a hedge fund itself, per se, to at least have access to some of the better and most well-known managers out there. So how do you think that industry changes, if at all, as a result of what we've witnessed this week?
Well, I think it's definitely going to change. The best players in that space, whether it's the Steve Cohens or the Dan Loebs, the Josh Friedmans of that space, they adapt and they pivot to the new reality of what they're dealing with. So will their short exposures change? Will they look at their risk management tools differently? Will they make assumptions differently about these sort of bee swarms that could potentially attack their positions? Sure, all of that stuff is going to happen. But at the end of the day, the hedge fund industry is alive and well and thriving, $3.6 trillion and counting. When I came on the show last year and we were talking about the debacle during the pandemic, I predicted those adaptations. And look how the hedge fund industry did at the back half of the year. And so for Skybridge Capital in the fund that you're referencing, Series G, we have a $25,000 minimum to $50,000 minimum, depending on the platform. And that gives people an access point, and then they can get exposure to some of these fantastic money managers. And so that industry is not going away, Scott. If anything, this type of activity will make that industry more needed for people that are looking for a source of increasing returns and reducing long-term volatility.
I'm trying to think of sort of what all of this is a product of. some suggest that this is all a product of a frothy market that we're currently in, and you see things like this in those instances. You know, retail getting incredibly excited about the state of the market. You know, respectfully, launching a Bitcoin fund at this particular time when Bitcoin, you know, has run up a lot. Do you subscribe at all to that current state of the market?
Well, listen, I would bifurcate the two. I would say, yes, there's a lot of foam in the market. There's easy money in the market, and the leverage is cheap right now, and that is driving a lot of this stuff. I think it's antithetical what the people are doing through the Reddit strategy, though. I get that they're trying to squeeze the shorts, and I understand that whole idea behind it, but I just think long-term it's a very bad strategy, and you could get caught in the vortex of that. If those names drop 50, 60%, which is not impossible given the run-up, and you're on the wrong side of it, and you've got that in your margin account, you could wipe out your account. So I would caution people that are doing that to just be super, super careful. But on the Bitcoin things, Scott, I think that's a different thing. That's an evolving monetary network, and I recognize the price movement. But what I would suggest, if you look at Amazon, which is a retail network, or even Facebook or Google, these other things being social networks or a search network, in the case of Bitcoin, that is an emerging, growing, still in the early adoption phase monetary network. And I just take you back to Amazon when it was 12 years old after its initial public offering. It looked like it was very expensive. But if you bought Amazon then, you've had a 64-to-1 move in Amazon over the ensuing 12 years. And so what we see in Bitcoin is something totally different. This is a monetary network that is institutionalizing before us. And again, to that democratization issue, we at Skybridge tried to make the fund accessible, low fees at 75 basis points, $25,000 to $50,000 minimums again, just so people could get a toe in the water.
Right.
I'm certainly not recommending large allocations, however, because the stuff is volatile, but a 1% to 3% allocation could really help somebody's portfolio.
Sure. You know, it does come with Bitcoin up, you know, at 36,000. I think that's our only point. What we've tried to, you know, do this week, I think, too, even though it's been somewhat misconstrued and purposefully warped, is give people an understanding of the risk, the underlying risk that exists in the marketplace in a lot of this stuff. Carrie Firestone has a question for you, Anthony.
Hi, Anthony.
Carrie.
So here's the question. For decades, the hedge fund industry has maintained that your risk is reduced because of the ability to short as well as go long. And this has been a marketing effort, to some extent extremely successful in selling across the platform to institutional investors, pension funds, state plans, teachers unions, etc. So now we've got a situation where perhaps there's a new risk that no one had foreseen. And I'm wondering how the industry is going to address it if, in fact, they have to adjust whatever they suggest is their beta or correlation or market risk that the investor is taking.
Well, listen, I think that's the best question out there, and I think they're already assessing that. You know, what you've got, and not to get overly complicated, is gamma risk here, an unforeseen event where there's effectively a bee swarm on your short position, and so now you have to sort of you have to widen out the standard deviation of outcomes that you think are going to happen in those positions. So perhaps you'll have more shorts on that will be less concentrated, and then you'll have stop outs on your shorts to prevent yourself from getting into the situation that happened with GameStop. But I think if you're making the point that hedge funds have been successful at explaining their strategy, where they have this ambidexterity in the markets, they can go long and short, they can do capital structure arbitrage, mezzanine arbitrage in the fixed income space, things like that. That's what's made the industry successful. And the better managers actually have the track record to back it up net of their fees. And so this is the reason why I always tell people, be cautious, sure, have money in stocks, have it in bonds, but you should have some in the alternative asset space. And we now believe a very small amount, but certainly some in things like Bitcoin.
Yeah.
But yes, they will make those changes, Carrie. That's happening right now as we speak, literally.
And you're certainly not the only one recommending a strategy like that, as we're learning. Certainly some tried and true and extraordinarily successful people in the investment world are recommending the same. Enjoyed it. We'll talk to you again soon, I hope.
Okay. Thanks, guys. Have a great week.
All right, you as well. That's Anthony Scaramucci joining us there. We'll take a break. We'll come back. Big call on Boeing, as I mentioned earlier. We'll talk about General Motors, too. We'll do it next.
Enterprise Artificial Intelligence has the power to transform the most complex organizations and the world, delivering medical supplies where they're needed, keeping our armed forces at the ready, cleaner, safer energy, all thanks to 1 billion predictions per day. C3.ai is AI at a global scale, harnessing the power of data to build a better future. C3.ai. This is Enterprise AI.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level. And that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our stakeholders.
Welcome back, everybody. I'm Sue Herrera. Here's what's happening at this hour. The World Health Organization saying it is working on quick emergency use approval for AstraZeneca's COVID vaccine. The group's top scientist says she expects a decision within 2 weeks. Back here at home in Texas, investigators are looking into why 11 soldiers fell ill during field training at Fort Bliss. Officials say it happened after they ingested an unknown substance. In Washington, a big fight over putting up permanent fencing around the Capitol. Capitol Hill police say it's needed to improve security. Some lawmakers and city officials disagree, saying the barriers would be a costly overreaction to the riot. 2 people have spent some very big money on those. Those are the mittens made by the same school teacher who knitted the ones that Bernie Sanders wore to the inauguration. Blue striped ones were auctioned off for $3,800, and a rainbow pair went for $6,100. And someone's offered more than $7,600 for this pair, which basically less than 5 hours left to bid. And it goes to charity, just so you know. Halftime is back after a quick break.
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
First week in about 3 months. Show you where the major averages are currently trading. Dow is down. Everything's down, except for the Russell is not down quite 2%. But you see the Dow, S&P, NASDAQ all down at least 2%. There's only one Dow component today in the green. That is McDonald's. You get your Big Mac, but everything else looks like the Big Mick, if you will. Everything else is in the red. All right, we do want to hit a few of the calls today. Boeing, all right, Jim Lebenthal. Boeing today got double upgraded to overweight at Morgan Stanley. You own it. What do you think about this call?
Yeah. So double upgrade is a big move. He is more optimistic than I am on airplane deliveries and free cash flow. And yet his year-end target is about 10% below mine. And what that tells me is what we know about this stock is there is so much that is unknown. We don't know how many planes they're going to deliver. We don't know what these planes are being sold for these days, particularly the MAX. But that's what I like about this, Scott. And you and I spoke about this a few days ago. There are so many moving parts, so many unknown, and it's coming together in negative investor sentiment. I think the investor sentiment is way too negative. If this analyst is correct and he exceeds my estimations, this is going to be a great year for Boeing. Jury's still out. It's down today with the markets, but I think this is Boeing's year. I really do.
Okay. How about General Motors? That call today, price target goes up. Reiterate overweight Morgan Stanley. That's Adam Jonas, right? Well-known analyst. Bumps the price target to $80 from 57. And Ford goes to underweight, by the way.
Yeah, it's really interesting. Adam Jonas is a terrific analyst, and he really believes in GM. So do I. You know, yesterday GM announced they're going to be all electric. All of their vehicles going to be electric by 2035, and they're going to be carbon neutral in all of their operations by 2030. That's a really big deal. Okay, so I see why he's positive on it. So am I. The thing I question Adam about is Ford. I don't think this is a winner-take-all. I don't think Ford needs to go to underweight. I think Ford will do fine. I just think General Motors will do a heck of a lot better. Maybe he just had to put it underweight, you know, just to keep things even out there.
Barbelled. The analyst barbell.
You know, you got it. You got. you got to have some underweights out there. It can't all be I love stocks.
All right, coming up, how futures traders are setting up for the big week ahead. We'll talk to them next. Back in 2 minutes.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC. Seth's new with Gillian Anderson and Kate Flannery. Plus a closer look at Tampa Bay's Tom Brady will be the oldest player in the Super Bowl.
Though he will still be the youngest person in Tampa.
New Seth this weekend.
It's time now for the Futures Outlook, a look at the week ahead. For that, Brian Stutland preparing for the convergence of Reddit, Bitcoin, inflation, and silver. If that's not enough, explain.
Yeah, Scott, thanks. So when I'm looking at things right now in the futures market, silver caught my eye yesterday. A lot of Reddit chatter, upside call buying, huge in some of the silver ETFs out there. So to me, this is a case where silver has lagged a lot of the metals or cryptocurrency. And when I'm looking at an inflationary environment, I buy stocks and I buy volatility in my funds that I manage. But if those things are stagnant, what other asset class appreciates? Right now, silver contract, that's the one I think takes off. It really has lagged since the election when you look at it in terms of that versus Bitcoin. And I think it has some catching up to do. When I'm looking to buy the silver futures contract, the March contract, remember, folks, this is 5,000 troy ounces per contract. So that means if the futures contract goes from 2650 to 2750, let's say, in the March contract, that's $5,000. So I'm playing that to the upside. I have a tight stop, a couple bucks lower here, but I really think the upside's there. I think it's got catching up to do. And we're not in a deflationary environment. I'm underweight bonds right now, overweight the metals, and silver's one way to play.
Good stuff, Brian Stutland. Thank you. We'll see how that all plays out with a ton of economic data coming in next week as well. We'll step away again, come back. We'll do final trades and unusual.
The German Finance Minister Olaf Scholz has told CNBC that Europe did the right thing by coming together to forge a joint approach to fighting the fallout from coronavirus. However, speaking exclusively to Aneta, Scholz admitted the bloc was acting too slow in its COVID vaccine procurement.
We have to admit that there could have been a situation where Europe would have asked for more vaccines earlier in the last year. But now anyone is working very hard to do the best that we get enough vaccines.
The stories and opportunities driving Wall Street and investors. Tyler Matheson, Melissa Lee, Kelly Evans. Power Lunch. Weeknights on CNBC.
Can a recovery be equal, green and united?
There is a direct link between vaccine and economic recovery.
The journey seems to be a little bit delayed
but should not be derailed.
We do need some more fiscal stimulus to continue to bridge the gap. There's still an enormous amount of uncertainty.
New targets of climate change is an opportunity for innovation.
That's all coming up on CNBC's virtual Davos debate, Restoring Growth.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The lens
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
We'll get you caught on the market before we do final trade. 630, that's the loss for the Dow Jones Industrial Average, below 30,000 right now. That's a loss of better than 2%. Same with the S&P 500, which is down nearly 82 points. NASDAQ also under some serious pressure today. So everything at least at this moment is down 2%. Pete, we got 45 seconds total for everything here. Give me quick, unusual, which is your final?
Promise to be quick. I'm going to have both. So Walgreens, I already own the stock, Scott. They're buying the March 57.5 calls pretty aggressively. About 10,000 of those were bought. I bought those as well. I own the stock and the calls at this time.
Carrie, final.
Blackstone, what's bad for hedge funds is good for private equity.
Steve Weiss.
Qualcomm report next week should be a blowout.
You still in Jumia, Steve?
Oh, I am. Love it. Stock's unbelievable.
Twitter wanted
Amazon of Africa.
Twitter wanted me to ask you. That's why I did. Farmer Jim.
Marathon Petroleum earnings Tuesday. We'll talk about it then.
All right. Good weekend, everybody. Take a deep breath. Enjoy the weekend. The exchanges now.
Well, it is not the weekend just yet, but hello, everybody, and Scott's right. Take a deep breath. I am Brian Sullivan, and this is an incredibly busy Friday, capping off a wild week of trading, not showing signs of slowing down today. The Reddit rally rolls on, but for only some stocks. But even a double dose of positive vaccine news can't keep the overall markets higher. Has the fiscal sheriff come for Robinhood? It's forced to raise capital. Too many big bets on GameStop, sending it scrambling for more money. Does it put the entire company at risk? And New York City Mayor Bill de Blasio says that companies need to do this to really ramp up the vaccine rollout. We'll talk about that with the mayor and ask him about when the Big Apple can really reopen. That's all ahead. There is so much going on right now on this busy Friday. Markets are down in a big way. Dom Chu and his smart board of stocks to watch. And Dom, it's up 500 one day, down the next. It seems like this is, at least this week, the new normal.
The new normal for this week is right, because there's continuing chatter among trading desks about a gross down or a taking down of risk on the short and the long side. For many folks out there, it's something to keep an eye on. But what it's leading to right now is the Dow down 657 points. At the lows, we were down roughly 707. That just happened in the last 15 minutes or so here. The S&P 500 down about 2%, 82 points. Down 91 was the session lows, again, just in the last 10 to 15 minutes or so. And the NASDAQ composite down 2 1/3%. Again, the underperformer here. The reason why the Dow Industrials are now going to be on pace for their worst drop since October 28th. Big technology. It's part of the NASDAQ, it's part of the S&P, it's also part of the Dow. But Apple down 5% almost. Microsoft down 3%. Amazon down 1%. Alphabet down almost 2.5% as well. These four stocks and the next 6 to 7 biggest in the S&P 500 are all in the red. That is what's driving things. Mega cap stocks, especially technology oriented, all to the downside. And then check out this one. This is a stock we haven't talked about during the short squeeze phenomenon with Wall Street bets and everything else. This is Macerich. It's one of the biggest mall owners in America and operators in America. It's a real estate investment trust. Those shares are down 11% right now, $17 per share. The reason why I want to highlight this, Brian, is this particular stock's biggest shareholder is the Ontario Teachers Pension Plan. They had about a 16-odd% stake in the company. In the span of one day, on the 27th, they got rid of their entire 24.5 million share stake on that surge up in the stock. So if you are caught in a short squeeze, other people will sell into it, including sometimes the single largest shareholder in any one company. Back over to you, Bri.
All right. No, we're not done with you, Dom. I got two quick things, a comment and a question. Number one, by the way, there was a mall outside of Vegas, which I read today just sold for $1.5 million. It was recently assessed at $28 million, a 90% price drop on a mall out in the desert. That kind of shows you how people think about malls. But let me ask you this. Like, if you're a big hedge fund that's got its teeth kicked in by the Reddit rebellion or whatever you want to call it, and you need to raise money for margin calls, you're probably going to sell what you can. Do you think some of this macro weakness in the names like Apple, easily transactable, do you think margin calls may be having something to do with the macro moves?
It's certainly a factor. I mean, and that's what this idea of a gross down is, or a flattening of positions. What you're looking to do is close out those losing shorts in order to kind of subsidize and take down risk. You're also selling some of those longs. It's also a risk management tool for a lot of these funds. If you have a risk model, a quantitative measure for how much you have at risk in the market at any given time, if those models get too far out of whack with regard to how much you have at risk, sometimes you got to take them down. You got to flatten out to some cash. That may be what's happening, especially with the hedge fund world. That's one of the reasons why we're talking about that gross down phenomenon so much, Brian.
That's why I love you. By the way, I tweeted last night that VAR, value at risk, might be a wonky term we heard today. I didn't even tell you that, and now you brought it up. That's why we love you. Dominic Chu, thank you very much. Well, it certainly has been a wild week with populist investing shocking the markets. The Dow, the S&P 500, and NASDAQ are on pace for their largest weekly losses in about 3 months. It's also the Dow's first monthly loss since October. Joining us now with the reaction to these moves and where we go from here, our friends Kim Forrest, Chief Investment Officer at Boca Capital Partners, and Mark Smith, Vice President and Portfolio Manager at UBS Wealth Management. Kim, starting with you. I mean, what a week, right? Up 500, down 500, down, whatever it is. How much of this, same question to you as I gave to Dom, do you think is just people selling to raise money in the face of either needing to or simply a little bit nervous about where these markets may be right now?
I absolutely agree with that. And actually, in talking with some of my peers on Wednesday, we figured it out because your super winners were being sold, which makes no sense because the ones that have reported, like Apple, they are doing really well. And looking into the future, and if you're a fundamental analyst like I am, you say, why are you selling this? And it's because, especially in the semis really got sold down earlier this week, and it's not because there's suddenly not a shortage for them, but it's because those were the winners, and if you had to shove some of the money towards the other side of the balance sheet there.
Yeah. You know, Mark, you're going to be sitting around the dinner table tonight, and you're going to be like, I thought I was going on to talk about healthcare, and the doggone anchor asked me about GameStop. Well, the doggone anchor is going to ask you about GameStop. And I guess the question, how do you make sense, or do you have to make sense of what's going on right now? And do you think it's a phenomenon which kind of came out of nowhere that can continue, or does it really just affect a smaller group of stocks that are heavily shorted, low liquidity, and easy to kind of muscle around?
Brian, I think you got it right. This is the cryptoization of Wall Street, and you're seeing that with a few names. It's not the whole. It's not all of the markets, but when you have cryptocurrencies going up and down 10, 20% for no reason at all, is it to wonder why you have these millennials going in stocks that have no customers, no revenue, not going to beat guidance anytime soon, and the stock's up 100% in a day. So this is what you're seeing. All the proliferation of cryptocurrencies, we don't know why it goes up or down. No one can explain to me on this broadcast why it does, and now you're seeing it leak into names that we all know. And a lot of the reason is because folks are following momentum, not fundamentals.
Well, and Mark, a follow-up to you before I go back to Kim, but there's nothing wrong with that. It's what hedge funds do all the time. And here's the thing. A couple people who then got followed by others, they figured it out. They figured out that hedge funds, which, to be frank, probably acted stupidly, all piled in on shorts on the same names. They left the stock vulnerable to this incredible squeeze, and good for them. They figured it out.
They figured it out for now, but this is going to end bad. There's no way you're going to have the tulip. I don't know if you remember about 150 years ago, we had tulips going for $20,000 a tulip bud. Well, this is very similar to that, based on no fundamentals. This is going to end badly, and that's why you have these companies saying we don't want to touch it because they're afraid of arbitration. They're afraid of getting sued by all these investors saying, wait a minute, I shouldn't have had my entire retirement account in a stock that has no customers. And in the middle of a pandemic, no one's visiting us, no one's traveling, all these different stocks that are having huge run-ups. There's absolutely no fundamentals, and you best believe it's going to end badly for the average investor. Right now, it looks like the big guy lost, but stay tuned. The little guy's going to lose too.
Oh, well, not everyone. A lot of people made a lot of money. I wish somebody would say, hey, Sullivan, we put all your money in GameStop a few weeks ago. I hope you don't mind. But alas, Kim, that did not happen. In this weakness, are you picking up any bargains out there outside of these names we keep talking about? Give us a different name.
Right. Well, I did look at the semiconductor complex, and some are down for good reason, and some are down for no visible reason. So, Micron has sold off from its recent high, and that is an area there that we're looking at, as well as, and I know this is not going to make people happy, but Intel. Intel has had some stumbles, and their biggest competitor seems to be gaining on them. That's AMD. But there's been a change at the top, and it could be that, you know, the company is going to go in a different direction. And it's very much like, and I'm not saying the outcome will be the same. Let's make this perfectly clear. But it kind of rhymes with Microsoft in 2012 when Satya Nadella came in. And he was an insider and did things that the street didn't really like because they wanted them to break the company apart. And he had a better idea. So I'm looking at the new CEO, thinking he probably has a better idea. And I'm sticking with that name. Plus, it helps that there seems to be a severe shortage for semis, right?
Some new names there. And Mark, I promise the next time you get on, we'll talk about why you're here, which is healthcare. But we appreciate your all's flexibility. A big story. Mark Smith, Kim Forrest. Thank you both. Have a great weekend.
Thank you.
You too,
All right,
Brian.
well, if you haven't noticed, thank you. The Reddit squeeze continues today as Robinhood reopens trading in GameStop and others. Now, Robinhood CEO Vlad Tenev telling CNBC last night its move to stop trading in certain stocks was in the best interests of the company.
I want to address some of the misinformation that's been out there because there's a lot of it. We absolutely did not do this at the direction of any market maker or hedge fund or anyone we route to or other market participants. The reason we did it was because Robinhood is a brokerage firm. We have lots of financial requirements, including SEC net capital requirements.
But here's the problem. Robinhood is not just a broker. It's a clearinghouse as well. And without getting into the weeds, pretty much what it means on a very basic level is that it's got a lot of money at risk, and it had to go begging to some venture capital partners last night to try to shore up its books. Let's bring in our friend, former colleague Kate Kelly, crack New York Times reporter, who has the latest on Robinhood's emergency money situation. And I know, without getting into the weeds again, Kate, they're not just an app or a front-facing brokerage, right? They are subject to a lot of the same rules as the big names they are trying to displace, and it burned them yesterday.
Yeah, Brian, it's a really interesting story because a part of the value proposition of Robinhood and the reason they've become so popular is that they're just this simple, democratically accessible trading app where you pay no fees and you presumably get a swift and attractive execution on your stock trades. And people were taking full advantage of it, as you know, in the last few days, certainly, and weeks. And it's become an immensely popular app in the recent past. But the thing is, they're dealing with people's money here, of course. And in a T+2 or 3 scenario, meaning you get a trade done and then 2 to 3 days go by before the money associated with that trade is wired either in or out of your account and into another account. You're dealing with real cash here. And when volume and volatility spike tremendously, when the flat price of a stock like GameStop is going up to $400 or $500 in some sort of stratospheric rise, and your traders are really active in that. Now, I understand a lot of people are trading options, which is a much cheaper way to go, but still, that means that the cash you need to have on hand in order to settle trades and make customers whole is much greater, not to mention the regulatory requirements that Vlad was alluding to, whether it's the SEC or their member organization, their clearing organization, the Depository Trust and Clearing Corporation, which is really what triggered yesterday, I think.
Yeah, and it was also just the jamming up into one stock, for the most part, GameStop, right? I mean, they never anticipated, I think, that kind of volume, value at risk, dollars at risk, et cetera. Do we have any idea if you've got to go to Sequoia or Ribbit Capital or some of these other partners and say, we need a couple $100 million bucks? Is there any kind of indication about, and I want to be careful with my language here, Robinhood's financial situation overall? Was this kind of an on-the-brink type moment? I'm trying to be, listen, you and I did this in 08 and 07, right? You got to be careful with the language.
Yeah, absolutely you do. I'm the first to agree. You don't want to call fire in a crowded theater, as it were. I think in this case, it's fair to say it was an emergency and quick turnaround capital raise. That's the language that we used in our story. And I think the key is that they have roughly 100 investors, and they went to their existing investors, people who already have skin in the game, and said, look, we'd like you to provide us with a quick cash infusion. We're going to make the terms attractive for you. We talk about those in our story. And this needs to happen quickly. I mean, they did it essentially within a day. Now, I think that Robinhood would argue the issue for them yesterday, in addition to the unexpected volatility and their obligations under financial regulations, was that the DTCC had increased their margin requirements. So the cash cushion effectively that they needed to have on hand. Now, separate conversation to be had somewhere about whether they should have known about that in advance, and they should have had a liquidity risk management strategy ahead of this to where they didn't get into this position. But nonetheless,
that's it. They seem, Kate, that's the point. They seem immature about it. I mean, I guess I'm not trying to insult them or their team. I'm just saying, you know, maybe they could never have anticipated this level of interest. I get that. But it makes you wonder, do you not have some kind of cash cushion? Did you not have some kind of strategy? This is what we worry about. Companies that are, you know, unable to handle these black swan type events. That's exactly the point.
Yeah, no, I think that should be a concern for everybody. And actually, speaking of an earlier event in the saga we're talking about, the teetering Melvin Capital hedge fund that had lost money on its GameStop short, which played some role in Steve Cohen's fund, Point72, being down nearly 15% year to date earlier this week. I mean, you saw contagion in the hedge fund world that appears, for the moment anyway, to have been contained. And there could have potentially been contagion in the brokerage and clearing and counterparty world if this hadn't been addressed yesterday. That doesn't mean we're out of the woods either. So I do think these are systemic concerns. Yeah. I think it's laudable what Robinhood seems to want to do, which is sort of democratize trading. And there's clearly a market that's very eager for it. So that's important to acknowledge. On the other hand, they're part of the broker-dealer, highly regulated and rightly so system in the United States. And they need to take certain steps in order to trade smoothly and to make sure that their customers' money is protected.
Yeah. They are the big boys. Listen, we got to go,
so
Kate. They are. The two founders are or were billionaires. We'll see. They're partnered with billionaires. Ken Griffin, a man you and I both know, and Citadel. So they are in the big leagues now, and they may be free, but they're still big players. Kate Kelly, we'll check out your story at NewYorkTimes.com with our colleague Andrew Ross Sorkin. Kate, thank you very much.
Thanks, Sully.
All right, take care. On deck, the push for mass production. We will speak with New York City Mayor Bill de Blasio about his call to pharma companies to stand down some of their vaccine patents to make the rollout go faster. We'll talk about schools a bit, opening up safely, as well as restaurants being able to reopen. Plus, the frenzy of trading in certain stocks now getting the attention of some members of Congress who are calling for hearings, potentially investigations. All right, as we head to break, let's get a quick look at the Dow 30 heat map. J&J, despite vaccine results that most consider positive, stock is down. 3M, Chevron, and Apple also. Many of your big laggards. The Dow is now down at a session low, 730 points, 2.5%. We're back right after this.
This is The Exchange on CNBC.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our stakeholders.
Divided by distance, united by business.
This is the new reality we're all
helping you navigate the new normal. Squawk Box on CNBC.
Whether that is on the foreign investment front, whether it's on the national security front, as well as whether it's on the human rights front. And we'll continue to advocate and speak up for Australia's national interest, but that shouldn't preclude, strong relationships in the region, and historically we've had a very good partnership with China, and would like to see that continue.
right, welcome back. Well, moments ago, the Dow was down more than 700 points, pretty much right at that mark right now, off 695, 2.3%. A lot of broad market contagion, either caused by this Reddit rebellion, probably some of those margin calls that we talked about as well. So markets down 700. And also, by the way, the VIX is soaring. Now, we call the VIX the, quote, fear gauge because it generally measures option spreads. But today, I don't think is a measure of fear. Today, it may actually be measuring action in the options market. Either way, the VIX is up 7% or 22%, 7 points on the VIX. It is up big this week. Of course, you've got these huge spreads in some of these options as well, which is really what the VIX is designed to mention and measure, despite the fact that we call it the fear gauge. I don't know if it's fear or volatility, but either way, the VIX is up 22%. Well, though Robinhood and Reddit and GameStop are grabbing most of the business headlines, maybe they shouldn't be. There's been a double dose of good news on the vaccine front in just the last 24 hours, which is incredibly important. J&J out with trial results of its one-shot COVID vaccine. This is the pace of vaccinations yesterday was more than 1.5 million per day. Let's bring in Meg Terrell. Meg, welcome. All right, there seems to be some confusion over J&J's vaccine effectiveness. The data points seem more positive than some of the headlines in that 66% number may suggest. No?
Yes, absolutely, Brian. And part of the confusion is this was a massive trial run across 3 continents, 44,000 people. And because it was run on 3 different continents, it captured the effect of these variants that we're so worried about, like B1351 in South Africa. And so when we're seeing in the United States 72% efficacy, we actually don't know because J&J hasn't sequenced every case in the trial if that's picking up any variants. But globally, because they definitely have those variants in South Africa, 66% overall efficacy against moderate to severe COVID-19. Importantly, though, the vaccine prevented severe COVID and death at 85%. So they kept people out of the hospital at that really high rate with just a single shot. In addition, this vaccine can be stored in the fridge at temperatures of 36 to 46 degrees Fahrenheit for 3 months. So that makes it a lot easier for the distribution of a vaccine like this. Of course, we are worried about these variants like B1351. 2 cases were just announced yesterday in South Carolina, not related to one another, no travel history, suggesting that there is potential community transmission here in the U.S. We talked with J&J's Chief Scientific Officer, Dr. Paul Stoffels, about what this variant means for us in the pandemic here in the U.S. and for vaccines. Here's what he said.
We need to be very careful that we need to take very strong action and fast to make sure that we reduce the burden of transmission very quickly so that mutations cannot continue to take place. We need to be very vigilant on eventually adapting the vaccines if that's needed. And also we didn't know these results until a few days ago. We started working on the South African variant as an additional booster. But we'll see now whether that will be needed with the clinical results we have.
So, Brian, people are looking at these results, comparing them to the 94-95% efficacy we saw with Pfizer and Moderna. That's why you're seeing J&J down. Novavax, which had some results from the UK and South Africa last night, up 62%. But Dr. Fauci this morning saying in the absence of that comparison to the mRNA vaccines, he called the J&J result spectacular. Brian?
Yeah, and we should mention, by the way, Meg, that J&J's CEO, Alex Gorsky, a man you know well, by the way, will be at CNBC's Healthy Returns event on February 9th. That is perfect timing for that. You can register at cnbcevents.com/Healthy Returns. Meg, back to you now that we got the promo out of the way. Novavax, you mentioned it, up more than 60%. Pretty good interim trial data on their COVID-19 vaccine. What exactly do we know about Novavax? Is this an mRNA or is this more of a, quote, traditional vaccine like a J&J?
Well, actually, it is more of a traditional vaccine, but it's not like J&J's vaccine. It's a protein vaccine, which is a more tried and true technology than any of the other ones we've talked about so far. And they ran their trial in the UK and South Africa. They have an ongoing trial here in the United States. We're expecting data from that in March. But what they found is against the prior strains of the virus, 96% efficacy. Against the B117 variant in the UK, 86% efficacy. But against B1351, 49 to 60% efficacy. efficacy. So that South African variant is very concerning. But they are talking about once they get the final data from the UK, filing there, and maybe even trying to use that data, the CEO told me this morning, to file it in the United States. But we're going to see what the FDA says about that. Brian?
Yeah, and by the way, Meg, it's Friday, right? Even earlier this week, we had pretty good treatment data out of Eli Lilly, 1.6 million vaccines in the arm over the last 24 hours. There's some good news on this fight this week overall, right?
There is, Brian, but with these variants, you know, here in the United States and the specter that they could lead to increased spread, we've got to be so careful. And I love the optimism, but I just talked to so many people in public health who are more worried now than they've ever been, and that is scary.
I know, but that's good. That is their job to worry, and they'll help keep us safe. Certainly, public health is key, and you know.
About 2,000 additional vaccinators. But right now we have a really ready supply of folks who are trained, who are able to do it. As you know, it's not that different from when you administer it. It's not that different from a flu shot. We got the refrigeration issues we have to deal with. Yeah. But we have the sites right now in this city, hundreds and hundreds of sites. We could open a lot more if we had supply. I am telling you, this is the key for this whole country. Places like New York City could be doing 500,000 a week, but can't get anywhere near the supply. Let's change the terms of engagement here. Just get the full might of these industries on one page to get the supply to jump forward.
Is this very quickly, Mr. Mayor, is this one of the reasons that restaurants will start to reopen February 14th at 25% capacity indoor? And why not tomorrow? Why wait until February 14th?
You know, Brian, I heard you say earlier, schools, and I'll make the parallel. Our schools are open in New York City because we are able to take all the precautions needed to keep them safe, to do the testing and the PPE, everything we needed. Restaurants, it's going to take some work to get ready to really make sure they're going to be safe. The state of New York decided February 14th. I think it's great that our restaurants will come back, but we need tight protocols, regular inspections to make sure people are safe.
Mayor Bill de Blasio of New York calling for more open production of the COVID vaccine. The faster we go, the faster the Big Apple can start to come back. Mr. Mayor, thank you very much for joining us. Have a good weekend, sir.
Thank you, Brian.
All right, take care. All right, coming up. So, what does Stoffels CEO think about this retail trading rebellion? We're going to find out because we're going to ask him next. Ron Krzyzewski is on. Plus, our Friday find, an under-the-radar stock not named GameStop. That is up 21% this week, and it has nothing to do with internet forums. We are back in 2 minutes.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Investment apps, including Robinhood and Interactive Brokers, have introduced trading restrictions after social media campaigns caused volatile movements in the prices of companies like GameStop and AMC. That story is on the website now. Retail investors have also sparked a rally for joke cryptocurrency Dogecoin. The currency added over $7 billion after users on Reddit talked about making it the crypto equivalent to GameStop. Head online for the full story. A global tax on tech giants is now highly likely, according to German Finance Minister Olaf Scholz, following a call with new U.S. Treasury Secretary Janet Yellen. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Welcome back to the exchange. Well, the markets have come back just a little bit. I'm not going to sugarcoat it. The markets are still down big, 591 in the Dow, but they were down 747 points at one point. And by the way, all the major averages are on pace now for their largest weekly loss in 3 months. And as I just learned, and this is, dare I say, random but interesting, this would be our first 2% down Friday, if we land under 2% down, since all the way back in June. There you go. All right, let's check the sectors. As you might imagine, with a market like this, all the 11 major sectors, they are in the red. Energy, materials, and technology leading the declines. You got the original FANG, Diamondback Energy, Occidental, and Chevron. So the biggest laggards on the energy side as well. Utilities and healthcare are holding up the best. They're down, but they're down less than others, with Biogen and Hologic leading the way. And take a look at Bitcoin. Remember, Bitcoin got all the attention until this week. up double digits, crossing 38,000 earlier. It's now at 35,300. Maybe it's just because Elon Musk added the hashtag Bitcoin to his Twitter bio. At this point, your guess is as good as mine. All right, let's get now a news update outside of all of this. For that, welcome in. Who else? Let's Sue Herrera.
Good to see you, Brian. Thanks so much. Here's what's happening at this hour, everyone. The FBI has raised its reward to $100,000 for information on who placed pipe bombs at the Republican and Democratic National Committee offices. The explosives were found just before the Capitol Hill riots, but the FBI now says those bombs were actually placed the night before. A former FBI lawyer has been sentenced to a year of probation for his actions during the investigation of possible ties between Russia and President Trump's 2016 campaign. Kevin Kleinsmith pled guilty to altering an email used in that probe. Prosecutors had sought prison time. And some good news for one of the most endangered species on the planet. Researchers have produced 2 more embryos of northern white rhinos, even though the last known male of the species died in 2018. The 2 remaining known females are infertile, but scientists hope to deliver a baby in about 3 years with the help of a surrogate mother from a closely related species. And we certainly hope they are successful. That was Nanjin and Fatu that you saw in that video. Brian, back to you.
We'd like our kids and grandkids to be able to see these animals, maybe not in person, obviously, probably only be a couple of them, but still just have them around. Sue Herrera, Sue, thank you very much. All right. All right, time now for your Friday find. Not quite as rare as a white rhino, but hey, it's a name that has been really seen a rally this week without a lot of fanfare or really probably a lot of mentions on Reddit. Today, that is Canopy Growth. The stock hitting a 52-week high earlier today, up 20% of the past week. Announcing it has partnered with Martha Stewart, Queen of All Cannabis, to launch a CBD line of products for pets. The product portfolio will include everything from oil drops to chews. Stock has come a long way, up 74% in a year, traded as low as $9 in March 2020 during the market panic lows. It is now just under $41. Canopy Growth, CGC, your Friday find. All right, up next, brokerage and investment banking firm Stifel reporting a huge record-breaking quarter and a banner year overall. Stifel stock outpacing the rest of the financials. The CEO will join us next with a view from Wall Street and his insights on exactly what's going on right now. Stick around.
I heard you guys have Workday now.
Yeah, they're a great partner. They're always there with insights.
Not this quarter.
Workday, a finance, HR, and planning partner like no other.
On Squawk Box, Chevron CEO Mike Wirth, earnings insight, new momentum in the energy sector, and the outlook for demand. What investors need to hear now.
Oh, welcome back to the exchange. Stoffels Financial reporting a big earnings beat today. Net revenues hitting a record for the 25th year in a row, but the stock is down slightly today, perhaps getting caught up in the rest of the market contagion. Still, it's been a good run. Stoffels up 56% in the past 6 months. Joining us now with a first on CNBC interview is Ron Kruszewski, CEO of Stoffels Financial. And yet, investment banking revenues up 18%. Almost every division posting better than expected results. Everybody seems to love the quarter. The stock is down, though, Ron. What are you just getting caught up in all the market contagion today?
Yeah, I think so. I mean, we had a great quarter. Importantly, our outlook for 2021 is every bit as optimistic. So, look at the markets are going to do what the markets are going to do. I'm very pleased with our results. You said it, 25 consecutive years of record revenue. Not very many investment banks can say that. And we just had a great quarter, records across the board. So great and optimistic.
Talk to us. You have a retail brokerage, so talk to us about what you are and your team is seeing, Ron. Is this sort of Reddit rebellion or whatever you want to call it this week? It's really centered around 20 stocks. GameStop getting the most attention, but it's a small number of stocks, generally with low float, high short interest. Are you seeing any knock-on effects to other equities because of this?
I think that, sure. I mean, there's a lot of interest by investors and so-called retail investors. But I think this thing that's going on, the real question is, what are we telling our clients? And there's a lot of, as if this is a new phenomenon. Short squeezes have been going on for over 100 years. It happened in railroads. And what I find, what people aren't talking about is that, when this happens, the stock will go to a level, in this case, GameStop, $300 to $400. That's not sustainable. That is the clearing mechanism for shorts to get out. And once that's done, this stock will revert back to where it was. And so we're talking about how much the hedge funds are losing, and they're losing a lot. But there are a lot of longs that are going to lose a lot of money when this trade unwinds. And I think that's where I'm a little concerned that people do not understand the risk of playing in what is effectively a casino.
Well, I mean, Ron, how do you know that a financially distressed, mall-based, brick-and-mortar video game company that is widely hated by every analyst on the street isn't worth $21 billion?
Okay, I will say that, as Warren Buffett said at one time, the stock market is a voting machine for a long time, and so the votes are coming in, but eventually it turns into a weighing machine. And unless they completely change their model or do something, that stock's not worth $21 billion. I pretty well confidently can say that. Now, maybe they bought some land and there's some huge I can't say oil reserves because it may not be worth anything, but they're sitting on some gold mine, and so the value will be there. But I don't think there's anyone that believes that this company's worth $21 to $25 billion. It is a phenomenon of a short squeeze, and there are people coming into this game that have no idea the risks that they're taking, and there is going to be that, and that speaks nothing about what's going on in the options market. I mean, I think there's 9 million shares that settled today in the options market on calls that people have paid, and there's big premiums being paid. All I'm saying to you, Brian, is that when the book is written on this trade, it isn't going to be just the shorts that got hammered. There are going to be a lot of longs that are going to lose a lot of money.
Yeah. Do you think it calls into question Robinhood's business model?
No, I think that one of the things is that I think people should understand is that the same reason that the shorts have to cover their positions is because they have margin requirements, and so the old adage that a short, the market can be irrational longer than you can be liquid applies to the shorts in this case. But I think in Robinhood, in these cases, to the extent that you're doing a lot of trades on the long side, your margin requirements are going up significantly. and because the market requires that we keep some stability. So they've got huge margin requirements to continue to trade. I do think that one of the things that will come out of this, and some of my friends are going to get mad at me for saying this, payment for order flow is going to get a lot of focus here, because these trades are not free. They're not. Every one of these trades, there's a transfer of value, and I think that is going to come under the microscope.
Well, maybe it should. Listen, if something is free, you are the product. By the way, we got to leave it there. But I got a text from one of your investors who said investment banking rocked this quarter. A direct text. Ron Krashevsky, thank you very much for joining us. Stifel, big quarter there.
Good to see you. Have a great day. Okay. Yeah.
Thank you. You too, Ron. Appreciate that. Best to you and your team. All right, coming up, overall, a big sell-off in the markets today. Stocks on pace for their biggest one-day drop since all the way back on October 28th. We've got a lot more to get to. Dow, down big, 595. We're back after this.
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong, so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
You've got a Dow that it's off its lows, but not by much right now. We are headed right now for the worst Friday since all the way back in June. We have not had a down more than 2% Friday since all the way back in early June, and sort of coming out of that pandemic haze from the market perspective. Dow down 629. All Dow 30 stocks are lower, seeing a big drop on the S&P 500 as well. Volatility, though, the VIX, that is up 15%. A lot of this whole macro story has been about options. The VIX measures option spreads in many ways. And we are seeing the VIX up 15%, and we are back right after this.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020 for $12 billion. Very attractive valuation. This provides tremendous value for our shareholder.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
All right, welcome back. Well, the COVID pandemic has driven something of a municipal bond boom as borrowing reached a 10-year high in 2020. Bonds for a new project reached $250 billion last year, driving total muni debt below $4 trillion for the first time since 2013. But do low rates and narrow credit spreads make a risky environment for investors? Joining us now is Chris Johns, Aquila Family Funds portfolio manager. Chris, it's nice to talk about something other than game stonk for once. Let's talk about this. Listen, we got the prospect of potentially higher taxes in many forms coming. Munis should be really attractive, but I know a lot of people are scared of some of the risk because of, tax. Everything is down, right? Tax funds are down. Where are some good investments in the municipal bond market right now?
Right. Well, I think the one thing that we've learned in this current environment is that it's kind of reinforced the notion that it's very important to know what you own. The pandemic has had a very wide variety of effects from state to state and from municipal bond sector to a municipal bond sector. So credit research is really, really important these days to handle that. One of the things I think that's important to know about municipal bonds is that they're a lot different than corporates in the sense that the way they borrow money is really different. They borrow money over a long period of time, say 20 to 30 years, with a level debt service schedule because they have to balance their budget every year. So even though there has been a big supply of municipal bonds, it's done fairly responsibly, especially when you include the fact that in the last 7 years, roughly somewhere between 20 and 50% of total issuance has been refinancing of higher interest rate debt, which you could argue is responsible behavior by muni issuers. So it's real important to understand those things. Many times the issuers need voter approval too.
Well, the 10-year is going to give me less than 1%, negative with, of course, inflation, real rates. Chris, what would be the median tax-free or almost tax-free return on sort of a, quote, average muni bond?
Well, right now, if you looked at say a 10-year AA rated muni bond, the yield on a bond like that would be about 85 basis points. So as you would expect, slightly below the Treasury security. But the taxable equivalent is still an attractive rate. So, if you try and compare it to a taxable bond, the rates on tax exempts are still pretty attractive. In our world, we manage single state municipal bond funds, which makes it even more so because you get the advantage of exempt from both federal and state income tax. So although the number may seem small, the taxable equivalent is still quite attractive.
Chris, do you believe that the muni bond market could actually be the subject of a movement like what we're seeing in some of these heavily shorted stocks, going after a, municipality which is not doing well?
Yeah, it's a great segue from all this volatility that we see in the stock market here in the last couple of days to talk about an asset class here, municipal bonds, which is relatively sedate. So the short answer to your question is not really. You have to remember that municipal bonds, are financed in many different ways. And if you look at, for instance, state general obligation bonds or even local general obligation bonds that are backed by the taxing authority of the issuer and also backed by, say, residential property taxes, that's a relatively stable revenue stream. So we won't see that kind of volatility anywhere near that kind of volatility in the muni market.
Chris Johns of Aquila Family Funds. Chris, good conversation there. We appreciate it. Something different, a little new and fresh. Chris Johns, thank you very much. Have a great day. All right, folks, that does it for us here on The Exchange. With the markets are down big. By the way, I will see you tonight for a special 2-hour Fast Money, 5 to 7 p.m. Eastern Time. Obviously, a huge amount to talk about with the trader gang, the options market, and everything in between. 5 to 7, I'll see you tonight. Meantime, Power Lunch, picking up coverage of the market sell-off after this quick break. Dow off 627. See you in 3 hours.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Brian Sullivan. Good morning. Worldwide Exchange on CNBC.
Well, we got a big market sell-off on Wall Street to end the week. Check out the major averages, all down a little more than 2% right now. Stocks on track for their worst week in 3 months, and all of the sectors are lower, both energy and technology leading those declines. Energy down 3%, tech down more than 2%. Plus, GameStop and Bitcoin, they are bucking that trend today. GameStop just below $300 a share, while Bitcoin is up 7%, in part thanks to Elon Musk. More on that in a minute. But let's get now to Bob Pisani for more on this market action. Bob.
4-to-1 declining to advancing stocks. The good news, take a look at the S&P 500. The good news is that we're off the lows. We were below 3,700, 3,695, and that's the lowest level since early January that we've had. Right now, if we closed here, the S&P would be down 1.3% for the month. So, you know, of course, that's important for the January indicator overall, but we're off of the lows right now here. In terms of what's up with the markets, there seems to be this inverse correlation with the GameStop short squeeze story overall. As the GameStop gets more traction or play and the short squeezes, the market moves down. We seem to be taking down overall exposure. What we've been talking about, Dom and I have been talking about this degrossing thing where you just reduce overall exposure to the market. That certainly looks like it's happening today. There's some vague concerns out there about potentially higher margin requirements as well that may be coming down the road. I think that's certainly in the market as well here. I don't sense this is fundamental or economic issues. The vaccine story is intact. The stimulus story is intact. Earnings have been very, very good. Credit seems to be holding up pretty well. So it's not like there's a macro issue going on. It seems to be idiosyncratic around this whole short squeeze story, as you can see. Now, take a look at these shorts here today here. GameStop, 265 to maybe 414 or so. It's been all over the place throughout the day, but some of the other shorts also working as well today. Bed Bath & Beyond, AMC, Express, even costs, as you see down here. Remember something here. This is a weekly stocks expiration day. Individual stocks have been trading on a weekly basis for several years now. Normally, it's not an issue. Nobody talks about it. It could be today, given how much money in the money GameStop options have had. Remember, this was a $40 stock a week ago. So if you bought a $50 option at this point, a call option, it's worth a lot of money. And that could cause a lot of money to move around at the end of the day. These options expire at the end of trading today. We'll keep an eye on all of that. Of course, guys, back to you.
Wow. Look at those percentages, Bob. I mean, GameStop, we just had them on the screen, but so many, not only double digits, but high double-digit percentages. You know, GameStop up 51%, AMC up 45, Express 21, costs 78. Wow. Okay, let's bring in Lindsay Bell.
And remember,
go ahead, Bob.
It was a $40 stock last week, John. $40 GameStop a week ago.
I remember. So, you know, individual investors, be careful. Things go up, things come down. We've seen a lot of both this week, and it's probably not over. Let's bring in Lindsay Bell from Ally Invest. Thank you, Bob, for her thoughts on today's sell-off. Bob Pisani, you know, talking about the linkage between what we're seeing in this short squeeze and the overall markets. But wow, 2% on all the major indices. You think that's what this is?
Yeah, I mean, what we're seeing today is a big move, and it got deeper into the afternoon here. And so I think what it is it's the end of the week, it's the end of the month. Investors have been looking and searching since we came into the new year for a reason to de-risk or just, you know, see a pullback in the market. When we came going into this week, actually, what we saw was the S&P 500 was up about 17.5% since the beginning of November. So that's a big, fast move for the market. We also saw that it got a little stretched from its 200-day moving average on a technical perspective. And so at 15% off of its 200-day moving average, that is a far distance. And then people, of course, are starting to talk about valuations getting stretched. The PEs at 23 times. Sure, that's higher than historical standards, but it's not, you know, we've been in that realm for many months now. So I just think that people are using this speculation as a reason to take some money off the table right now, wait for things to digest, and perhaps wait until we have more clarity about what the future of the economic recovery looks like, because there is still a little bit of uncertainty with that South African virus coming into the U.S., the J&J news today. People are using it as a reason to take the VIX up above 35, I think we got to today. And so we're back to November levels. There's just a lot of nervousness in the market right now, John.
Nervousness in the market. So is it two different and granted very different things going on? You've got we don't know to what degree it's retail investors, but you've got some people, it started off retail investors that are squeezing shorts on one side. You think it's an entirely different, you know, large cohort of people on the other side reacting to that?
You know, it very well could be. I mean, it seems like at least the sentiment from the retail investors going into this week was pretty positive. They were feeling good about the speculative trades that they were making, that you've been talking about all week here. And so I think you got to see some of the big money on the other side to really see these bigger moves that we're seeing in some of these stocks, too. And you have to remember, too, earnings season has been very good. So because of that, it might be a reason for the big boys to de-risk and take that money off the table right now. And the retail investor might not quite understand that dynamic, and they're just sitting there watching these speculative stocks or these penny stocks that have done really well over the course of the past month, and they feel like they're in a good position too. So I think only time is really going to tell to see whose hands are being shaken out at this point in time.
Yeah, can't forget we got a $111 billion quarter from Apple this week, above expectations on the top and bottom line. Stocks down 5% for the week. Now, let us bring in our guest to talk about the crowdsourcing power of social media, the race to zero for trading commissions, faster technology, all created this perfect storm this week. So is the selling we're seeing today a symptom of that? We've been asking that question. We're going to talk more about it with David Brown, CEO and chairman of Victory Capital. Dave, what's your read on what the market is doing on a Friday? We haven't seen this kind of a move to end the week in quite a while. And what, if anything, does it have to do with the volatility that we've seen in heavily shorted stocks?
First, thank you for having me on the show. Look, it's one day. I think you have to pull the charts back and really go back and take a longer-term view. The market has had a really, really strong run-up over the last year, over the last few quarters. And as your guests have said earlier, there is a lot of good news out there.
Sorry, Dave, got to cut you off. Moments ago, we heard from the president. Here it is. Okay, we don't have audio here with the president, but he is speaking outside the White House before heading to Walter Reed to visit with wounded service members. We can see him there outside the White House with his mask on. I don't believe we're going to get audio on this tape. That is the president. Kayla Tausche, I believe, from Washington, we have with us. What can you tell us about the president?
Well, he's going to visit wounded service members who are at Walter Reed. It is a special place to the Biden family. His late son, Beau, underwent treatment there toward the end of his life before passing away from brain cancer. And Biden, in that video, was talking about how his family spent every Christmas day there visiting with the families and children who are being treated at Walter Reed. He did answer a question from the press pool before that departure about the prospects for the COVID relief bill, the $1.9 trillion package that his administration has floated, and the prospects for a bipartisan bill versus one that goes it alone with simply Democratic support. He said that it needs to pass no ifs, ands, or buts. It is still his preference to pass a bipartisan package, but next week Congress is going to be starting the early steps to pass a package that would only require Democratic support and would get around needing Republicans to vote for it. But certainly he is keeping his options open, but says the #1 priority is to pass something and pass it soon. John?
Kayla, what's the carrot here for bipartisanship? The incentive for Republicans to participate on this one? I've been hearing quite a bit of disappointment on the GOP side in the way that the Biden administration and Democrats have been pursuing this thus far.
Well, I think the carrot is just the consideration of where the virus is right now. Certainly there is a light at the end of the tunnel with regards to several vaccines on the market, coming to market. But the administration is suggesting, hey, you had full bipartisan support back in March when the virus was a fraction of the number of cases, hospitalizations, and deaths that it is now. And so we need to pass another bill to try to get this under control, and that the economy is only going to worsen if they don't put some money in people's pockets and fund things like schools, small businesses, and frontline workers. Now, that being said, many Republicans have made the argument this money is not yet in the economy from the last package that we passed at the end of last year. Wait until that trickles through, and then we'll see what we need. And further, John, one of the complicating factors is I was talking to someone with a line of sight into the PPP process who said that demand for those small business loans that are forgivable is lower than expected, about 30% lower than expected. And so if people are saying, hey, there is not the same rush of demand that there was last spring, perhaps there's less demand for this money overall. But certainly the administration is making the argument that the economy needs this money. It needs to get back onto strong footing before they can move on to other policy priorities.
Okay, we'll see how that shelf life looks on bipartisanship. We're just shy of 10 days into the Biden administration. Kayla, thank you. Dave Brown, we were talking about the markets, and I've got to ask, COVID and COVID relief has played a role in market action in the past. Is the market going forward going to take a signal from whether we get bipartisan agreement in Washington on this or not?
Well, look, I think first, you are going to get something put in the market by the administration. And I think it's going to be positive for the market. The vaccine or versions of the vaccine are coming. And, my opinion is there is a lot of pent-up demand. People want to get out. They want to spend money. If the stimulus is passed, people will have money in their pockets. So I think this is going to be all positive for the market. And today's action is really about people pulling money off the table because they've made a lot of money over the last year. I think you have to roll back the charts and look at some of the stocks that, are down today and the market that's down today. I mean, it's close to an all-time high.
True.
And so, I'm really bullish on the market. And I think that, there will be something that's done, whether it's the full 1.9, whether it's $1,400 of stimulus for each person. Something will get done. It'll be a positive for the market.
Well, one area where we have seen this week potential for bipartisanship is in dealing with the markets. And what we saw happen, particularly with Robinhood, we had Representative Alexandria Ocasio-Cortez and Ted Cruz agreeing that they ought to look into this. Do you expect action there that's going to affect perhaps the retail investor in the way the markets work at all?
Well, who would have figured those two would have agreed, right? I think you were going to see an evaluation by regulators, by the SEC. They're going to look at short selling. They're going to look at all of the actions that have happened. They're going to look at social media platforms. And there'll be an investigation. There'll be hearings. What will come of it will probably be very little, and it'll be very little in the longer term impact of the market. Our markets today are functioning. Our markets are healthy. What's happening in a dozen stocks is, in 25 years of being in this industry, I've never seen anything like it, but it's a very small portion of the stock market. And I think longer term, this will be a point in time. And I think, if there is regulation that comes of this, I hope it's around transparency. But the thing people are not talking about is, a great thing has happened. We have more people interested in the equity markets. We have young people interested in the equity markets. We have people that, are teenagers and, 10 and 11-year-olds looking at social media, wondering, how do I invest? This is all healthy for the market longer term. They need to be educated. They need to have transparency. It needs to be a fair platform. But getting more people into the market, that's a real positive.
Hey, it's Lindsay here, John. I'm just wondering, what do you think about how companies are going to react to this going forward? Because we have seen in the past year some big stock splits like Apple and Tesla, for example, but we haven't really seen a lot of them over a longer period of time. And so I'm wondering how you think corporations are going to react to retail investors getting into the market. We've also seen a huge uptick in trading in small cap stocks in general. And I'm just wondering how the retail investors' participation is going to impact the way different corporate finance and CFOs and management teams think about the way they look at their capital structure.
I think it's too early to tell how it will impact CFOs and capital management policies. I think when you evaluate what has happened over a week or 2 weeks, it's hard to say that has run its course. We don't know how, if you will, this is going to end. What you do know is there are a lot more retail investors in the market. Their access today is better than it's ever been. The available education today is better than it's ever been. And I think, the more retail investors that are in the market, the healthier the market will be. And I think, the CFOs and the corporations will adjust. I have great faith, in a healthy market. Short sellers, retail investors, corporations, they will figure it out. It's really what makes a market. There are people with different opinions, and somebody buys, somebody sells. Somebody thinks the organization or the corporation is well positioned. Short sellers don't. So I think it's too early to tell how to exactly impact, the capital management policy of the CFO's mindset. But I'm not concerned longer term about that.
Well, Dave Brown, thank you for that insight. Dave Brown from Victory Capital. Coming up, we're going to have more on this market sell-off. Bitcoin climbing higher after Elon Musk fuels the crypto flames. We've got those details next. Plus, hedge funds have been taking a beating this week. We will dive into some of the Wall Street damage the GameStop phenomenon has done. More Power Lunch is ahead.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen.
Street and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
While electrification is going on, it's not going to happen overnight. It's going to be a process. It's going to take time for this nation to really go electric. Huge nation, huge population, a lot of infrastructure has to be set up, the charging infrastructure and a whole lot of other stuff. Tesla is a very welcome step. It will give a big boost to electrification in the country, and all of us are electric ready.
Welcome back. Bitcoin rocketing higher today after Elon Musk added hashtag Bitcoin to his Twitter bio, and that's despite Robinhood temporarily restricting crypto trading. And take a look at Dogecoin, the fake meme coin Reddit users are piling into. Is everything just a meme these days? Joining me to discuss the moves in Bitcoin is Mike Buchela, partner at Hightower. Mike, I ask a lot of people, and maybe you can tell me about your strategy and insight around Bitcoin, how it trades, when and why you buy it. Like, I've heard the argument it just inexorably goes higher, but there are these moments when it does move. It moves down. It does, why does it do that? Why is it doing what it's doing now, and what's your strategy around it?
Sure. And one quick correction, Block Tower, not iTower, but
Block Tower. I'm sorry.
No worries. So with Elon, so for example, the move in Bitcoin overnight with Elon adding Bitcoin to his profile on Twitter, it could have been fundamental buying on the back of people assuming he's going to be announcing a personal purchase or of his company's balance sheet purchases. The reality is it may have also been algorithms that are scraping social media and market bidding anytime something like Bitcoin shows up on someone as well represented as Elon Musk's profile. So, you can't really take these moves and kind of take them for granted. You have to understand that a lot of these kind of hyper volatile moves on particularly catalysts like Elon Musk adding Bitcoin to his profile are likely short-lived or at least unsustainable. And so you need to see a rebasing before you can actually get comfortable getting longer. Now, the other point to make is that CIOs and leaders, corporate leaders like Elon, are still very much engaged in the space. And so this all seems like one big distraction from what's actually happening in the market, which is very much, if you think about Bitcoin, for example, it's evolving as its own financial asset, and corporate leaders everywhere, CIOs everywhere are engaging with the asset itself. Things like Dogecoin, I mean, listen, I suppose they're fine trading vehicles. There's very little fundamental value long-term in these things. I think the financial market warfare we've seen in the last week is more a distraction than anything else.
So when it goes down, why is that typically, do you think, and what's your strategy around either buying more or not during those periods of time?
Yeah, and so the drawdowns, in many instances, they're unsurprising. So what you want to see is a sustainable spot bid in the market, because that typically dictates allocations versus trades. In significant run-ups, and if you're pulling market data from particular exchanges, you can see levered bids in the market, and you can see where they're coming from. So in traditional finance, when I was at Goldman, you're kind of looking for flows, and if you knew a particular broker-dealer was trading an asset, you knew it was more retail flow than institutional flow. Same thing happens here. You can see where levered retail exchanges are bidding up a price, and you may have crypto or Bitcoin, for example, gap like we saw in January, from 30,000 to 42,000. But if most of that is derivatives-led, and derivatives kind of lead us through these levels that you would have otherwise kind of sold looking at a technical level on a chart, you know that move may be less sustainable than one where you just saw a TWAP bid take us through that level and kind of strengthen higher. So you can reposition your portfolio in those moments to perhaps take some capital off the table or replace Bitcoin's spot market or one delta with options where you can actually take some cash off the table but still maintain that exposure in case that move continues.
Hey, Mike, how do you view regulation on Bitcoin and the crypto market in general? We're already starting to see some commentary come out from the OCC, FinCEN, and I'm just wondering how you think that's going to impact the pricing of these cryptocurrencies in the future, as well as the involvement in the financial system within the crypto space. How are you viewing that?
So long-term, all substantially positive. I think what we've seen thus far has been reasonably well thought out. In the instances it hasn't been well thought out, the crypto community has really kind of banded together and has had constructive dialogue with regulators. The interesting parts of the market, so obviously we've seen a lot of regulatory clarity around things like Bitcoin. We're getting the Ethereum CME futures launched February 8th. That's a big step for the Ethereum community. And then when you talk about things like decentralized finance, which I think, you know, if Occupy Wall Street was the grounding moment for Bitcoin, and I remember walking out the Goldman building, the building at Goldman, and saying, this is a very interesting movement, and then a year later you saw Bitcoin emerge. So this Wall Street bets moment is the grounding moment for, I think, what will become a movement in decentralized financial infrastructure. And so the battle shouldn't be Robinhood. The battle shouldn't be GameStop. The battle should be innovation and evolving the financial infrastructure to become more decentralized. But also alongside that, I think financial literacy becomes a lot more important. So there's a lot of things happening. There's a lot of balls in the air. You know, we're in this, you know, Block Tower's in this 24 hours a day, 7 days a week. And, you know, even for us, sometimes it's a bit much to take in.
Yeah, that could be the tagline for the week for sure. Thank you, Mike Buchela. Block Tower, as in blockchain. Black Tower Capital. Now we've got a news alert on United. Let's go to Phil LeBeau for those details. Phil?
John, take a look at shares of United Airlines. It has announced that it has sent out about 14,000 warn layoff notices to its employees. That's because those notices have to go out at least 60 days in advance of when somebody may be laid off. And remember, the current payroll support for all the airlines ends on March 31st. Well, it doesn't take a rocket scientist to figure out that the airline business is as bad right now as it was in the fourth quarter, maybe even worse, and that if business does not improve come March 31st, well, then United and other airlines are going to have to make some tough decisions when it comes to whether or not to once again lay off employees, unless there's another federal payroll support program that is passed. So United is letting, and has let, a little over 14,000 workers know that they could be laid off again come March 31st. Also, take a look at shares of American Airlines. We've checked with American. They have not set out warn notices yet, but don't be surprised if that's a decision they have to make in the next week. In fact, CEO Doug Parker was asked about this on the conference call after earnings yesterday, and he said, yeah, that's a decision they're going to have to be making in terms of what they do with all of their employees, given the fact that this business has not improved, guys. We're still looking at passenger levels down 60 to 70%. Guys, back to you.
Phil, thanks. Yeah, consequences perhaps of what's not yet happening in Washington. Still ahead, stocks are lower across the board. Utilities and healthcare holding up the best in this sea of red as the market's on track for its worst week since October. We will have more right after a quick break.
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Welcome back. We've got a significant sell-off on Wall Street right now. The Dow is down 550 points. And checking the individual components, only McDonald's is higher, not by much. The big decliners, pretty broad. Chevron, Johnson & Johnson, 3M, and Apple are among the big drags. And Lindsay, I'm looking along this bottom row. I mentioned Apple. I also see Home Depot, Microsoft. Apple and Microsoft, titans that had really strong earnings in recent days. Is this sell the winners? Is this sell the titans?
It feels like it might be sell the titans because it is a little confusing, because what I've noticed over the last several months is when we do have red days like this, you usually see some of those tech names hold up a lot better, simply because they became defensive over the course of the pandemic and the recovery period. So it is interesting to see those down the most within the Dow today. It could also be related to their size. And so the tech sector in general has been out of favor for a little while now. But I also wonder, too, when I look at today's action, you saw inflation come in just slightly, the PCE, inflation indicator with which the Fed watches. You saw that come in a little bit hotter than what expectations were at 1.5% on the core side. I'm wondering if investors are clinging to that as a reason for risk off right now, or if it's simply the speculation that is really has been driving the market crazy all month.
I wonder the big picture. And I'm in my other seat now. Big picture, does this tell you anything about the market when you have a name like an Apple that has this amazing quarter at the size that it is and yet ends the week down? Well, we don't know how exactly it's going to end up, but right now it's down 4%.
Yeah, no, it definitely catches your eye for sure. It's a huge component of the S&P 500, which is a market cap weighted index. But what I would also say is if you look at the S&P 500 equal weight index over the course of the past 3 months or so, it has outperformed the S&P 500 by 7 percentage points. So to me, there's a rotation going on in the market. So underneath of the hood, you are seeing some good trends occur. And so that's a healthy rotation that we're seeing in the marketplace today. Of course, we're seeing a move towards defensive. Consumer staples is one area that I have actually been looking at more recently, simply because of the underperformance on a price basis, but also on a valuation basis. These are companies that can do well if you do think that inflation number, which I just mentioned, is going to get a little bit hot for a little while. They're going to be able to push prices up without having a big dent to volume. So it could benefit those guys.
Yeah. I'm looking at Disney, also down more than 2% right here. We're going to continue, of course, to keep our eye there, but also on viral stocks that continue their rally today despite this sell-off in the overall market. After the break, we're going to take a look at who exactly is driving this Reddit revolt on Wall Street. Also get the traders' take on what this means for stocks going forward. Be right back.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020 for $12 billion. Very attractive valuation. This provides tremendous value for our shareholder.
Missed the show? Don't sweat it. The Halftime Report now has a podcast. Market-moving interviews, call of the day, unusual activity, and, of course, Ask Halftime. Look for us on Apple Podcast or your favorite podcasting app and subscribe to the Halftime Pod today.
Welcome back, everybody. I'm Sue Herrera. Here's your CNBC COVID update at this hour. California's governor has signed legislation extending that state's eviction moratorium through the end of June and providing financial assistance to small property landlords so they can make mortgage payments. To limit the spread of new COVID variants, travelers arriving in Canada will now be required to quarantine in a government-approved hotel at their own expense for up to 3 days as they wait for a negative COVID test. Those who test positive will need to finish that quarantine in a government facility. And Prime Minister Justin Trudeau is also trying to encourage residents to stay home by making it harder to escape that country's cold winter weather.
The government and Canada's main airlines have agreed to suspend service to sun destinations right away. Air Canada, WestJet, Sunwing, and Air Transat are canceling air service to all Caribbean destinations and Mexico starting this Sunday up until April 30th.
They're going to have to bundle up north of the border here. John, back to you.
They know how to do that, Sue.
Yep, they do.
All right, the gains continue today for the stocks at the core of the Reddit rebellion. GameStop, AMC, and others high once again, while the broader market sits in the red. But who and what is actually behind this retail surge? New York Times culture reporter Taylor Lawrence did some digging on who is at the heart of the movement. And Taylor, I know that this is anecdotal, of course, but I love the cultural look that you took here. And there have been so many people on CNBC's air saying this is good. This is retail investors getting involved, getting invested. Do you think they're in this based on your conversations for the long term?
I mean, look, they're definitely in trading in the long term. You know, whether or not they're in GameStop for the long term, I think remains to be seen. It's definitely a meme stock, but absolutely. I mean, these are people that it's an incredibly impassioned community, and you know, they're definitely not. They're trading stocks for fun, some of them for sure, but a lot of them are pretty serious about it.
Over the past 12 months, I've seen two moments that caught my eye. One was back around March when stocks absolutely tanked. To me, there seemed to be a bit of retail investor interest there. I had, friends on Facebook saying, oh, should I buy Disney at these levels? What about the airlines? This is different, right?
Yeah, this is different. I mean, this is definitely, it's sort of similar in the sense that I do think it's a lot of people with expendable income putting small amounts of money towards these trades, feeling like maybe there's an opportunity in the market right now. But I think what happened, especially with GameStop this week, has been, it's been something broader, and it's part of this sort of burgeoning retail class of investors that's largely come into trading, in recent years through apps like Robinhood. And I think we're just starting to see their power in the market.
What I wonder, too, though, is that this started off as at least the justification was backlash against hedge funds. Toward the end of the week, it kind of morphed into backlash against Robinhood. Is this cohort of new or newer or more excited retail traders and investors going to trust anybody?
Well, I mean, I think they're certainly not going to trust Robinhood after what happened this week. I think that, the company has basically shattered all hope that they were on the side of these retail traders. There's this famous, there's this Robinhood tweet that I saw going around from 2016 that's kind of well known now that said, let the people trade. And I think, that's exactly what they weren't doing for a time. And I do think it shook confidence in the company. And there's a huge amount of anger. I saw a lot of people, recommending other apps saying that, this is just further proof that the market is favored towards, these big guys on Wall Street.
All right, we'll see. Robinhood's still the #1 top free app on the App Store. Thanks, Taylor Lorenz. But speaking of, we've got some breaking news on Robinhood. Let's get to our Kate Rooney for that. Kate.
Hey, John, Robinhood once again reducing the amount of securities that customers can buy on the platform. This morning, they reopened trading of names like GameStop. They are reducing the amount of shares you can buy from 5 shares to just 1 share for a list of stocks here. That includes AMC, GameStop, COS, Bed Bath & Beyond, American Airlines, and a few others here. Robinhood just updated their blog post that to update customers here. Again, reducing the amount of shares you could buy for some of the stocks that were banned yesterday. They did open that up again today. We'll keep you posted if we hear anything else. John, back to you.
You did say AMC, correct?
AMC, that's right.
All right, yeah, we had AMD up on the screen. I wanted to make sure people know it's AMC, not AMD. AMC, one of those stocks heavily shorted that, yes, indeed, Robinhood traders were piling into. And it makes one wonder, Lindsay, especially after the mea culpa that we heard from Robinhood's CEO last night, the talk about opening trading back up. You wondered if they were going to mend fences. We were just talking to Taylor about this. How are the Robinhood traders going to take this?
Yeah, I mean, I think any trader that is stuck in this type of situation is going to certainly be frustrated, and understandably so. But at the same time, some of these newer brokerages or smaller brokerages is where we're seeing that a lot of customers want to go to start trading because they're offering them an experience that is different than what they're getting from the old brokerages or the old guys. So for Taylor to say that Robinhood is down and out, I don't know if that's necessarily going to be the case. There are certainly a lot of other options for customers to consider, including Ally Invest. But it's something that the retail trader is going to have to take into consideration when they're moving forward and when they're thinking about also trading in stocks that are this heavily trafficked in.
Yeah, and I'm going to be watching the levels on GameStop and AMC particularly. Last time we saw real restrictions from Robinhood, they were affected. So far, it doesn't look like they have been intraday. All right, moving on. If you have been paying attention at all this week, you don't need the VIX to tell you that we've seen a lot of volatility, but it will tell you. So is this spike a warning sign about what's to come? Our traders will break it down next on Power Lunch.
German Finance Minister Olaf Scholz has told CNBC that Europe did the right thing by coming together to forge a joint approach to fighting the fallout from coronavirus. However, speaking exclusively to Aneta, Scholz admitted the bloc was acting too slow in its COVID vaccine procurement.
We have to admit that there could have been a situation where Europe would have asked for more vaccines earlier in the last year, but now anyone is working very hard to do the best that we get enough vaccines.
Real money.
Heat map right now, pretty good day for stocks.
Real debate.
Purchase volume was up 20%.
Halftime report on CNBC.
Welcome back to Power Lunch. I'm Seema Modi. As we watch the GameStop short squeeze, take a look at the market's volatility gauge on the rise above 34 and on pace for its biggest weekly gain since last June. Remember, the volatility index is a forward-looking barometer of investor expectations for future moves. So is this fear gauge flashing a warning sign? Let's bring in the Trading Nation team. Craig Johnson of Piper Sandler, Boris Schlossberg of BK Asset Management. Craig, you've been taking a look at the charts. Such patterns have come next to big turning points in the market. So what does the VIX above 34 tell you about where the equity market is headed?
Seema, we need to heed the warning of what we're seeing here with the VIX. I mean, if you look at the move we've seen in the VIX since Wednesday, it's up 62%. And if you go back to the history of this entire index, that is the third highest surge we've seen in the VIX. And anytime we've seen kind of a shorter term indicator for us has been when you see the VIX above its 200-day moving average, has been sort of a pretty strong risk-off signal. But if you put this VIX together, Seema, with the fact that you've had a very big breath thrust already happen in the market, you've also have got a lot of speculation happening in the market. There's a lot of reasons why we should be heeding this warning and at least tactically sort of, raising some cash and tactically rotating the portfolios to be a little bit more cautious here in the near term.
Boris, I find the VIX a little wonky. I mean, is there a way to play this, though, if volatility is, in fact, on the rise, similar to what we saw back in March of 2020? I mean, do you buy a name like Virtue Financial, a high-speed trader, trading platform that actually did pretty well when volatility was on the rise last year?
Absolutely. Volatility equals volume. So when volatility spikes, volume is going to increase, which means market makers, brokers, CME, I've contributed my fair share of profits to them this month for sure, are all going to do, I think, very, very well. So yes, those are going to be the names that are going to trade well. But I actually agree very much with Greg that the VIX now is an important signal, not just because of itself, but when you look at the surrounding data. Today was the first day in a long time I've seen bond yields up, equity prices down. That's a signal that the market is getting concerned about credit risk to me. And I think that's an important warning. So yes, I think certainly we may be setting up ourselves for at least a 5% correction, maybe even a little bit more, especially as we go into a very bad seasonal time in February, which is typically tends to be a big sell-off time in the market.
Buckle up. Boris and Craig, thank you. And for more on GameStop and the short squeeze and how social media could adapt to this shifting investor landscape, check out our website. We just had that discussion on tradingnation.cnbc.com. John, back to you.
Thanks, Seema. Well, we want to show you this now as an example of what's happening in the markets. Apple and Microsoft, huge market caps, around $2 trillion, each of them getting hit, dragging down the broader market indices. But so-called meme stocks, they are back today. GameStop, AMC, soaring. We're all over these markets. Stay with us.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
If you can keep your head when all about you are losing theirs, if you can meet with triumph and disaster and treat those two imposters just the same, the world is yours to trade and invest. See it. IG it.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
Tyler Matheson, Melissa Lee, Kelly Evans, Power Lunch on CNBC.
Well, the major market indices continue to sell off while the retail viral stocks continue to rally. Here now to break down market action is Fast Money's Tim Seymour. Tim, tell me, when you see names especially like Apple and Microsoft, market stalwarts, their theses intact after the earnings they just reported, blowout earnings arguably, and the market's not moving higher at the end of the week. Does that tell you anything about the market overall?
Hey, John. Yeah, first of all, you're emphasizing the right thing. I mean, these are stalwarts for a reason. We had reaffirmation of that this week. And they're also very, very crowded trades. They're also very much market proxy trades. So when you think about some concern, whether this is a retail community or a professional community, what folks should be doing during periods of stress and volatility in the market is simplifying and taking down gross. Now, you have to be careful not to be selling, cutting your flowers and keeping your weeds, as they say. And clearly Microsoft and Apple are flowers, but as a hedge fund manager, if you're covering some shorts, you're also taking down longs, but you're also taking down your overall gross. So, to me, it's not surprising to see the broader market collateral damage. And also at a time when people are using this moment to question some very, very frothy trades. And I don't mean the AMCs and the GameStops. I think that's a linchpin and a catalytic moment for the market overall.
What kind of decline are you looking for, Tim, here for investors to get more comfortable? Is it a certain number, a certain spot in the index that you're looking for specifically, or is it something more related to vaccines, economic data, earnings?
Right. Well, I think, Lindsay, first of all, people are looking at the S&P. They're looking at 2712 or so, which is right around where we are today is the 50-day. We traded through there for a few days in October. I think the underlying principles that are supporting the market here, and I think this is the moment to take a little bit of a breath. Markets were certainly doing some frothy things. We've talked about SPACs. We've talked about the IPO calendar. We've talked about high multiple stocks. But three things. First of all, equity positioning in a historic sense is still relatively low. I think there's a lot of institutional buying that's going to come into this market overall, and I don't think we're over our skis in terms of overall equity positioning. I think the second dynamic is you have a case here where COVID, I realize headlines have not been great, but look, we are nearer to the end of this than we are to, I think, the peak. And I think that I'm not going to put calendar months on it, and obviously a painful time for our country and the world. But that's a tailwind. It's a tailwind for markets. And then finally, policy. Look, the Fed's not going anywhere. And I think the fiscal dynamics, whether it's less than what we expected or in line or more so, are things that investors should be very focused on.
Yeah, well, Tim, we certainly are focused on that, as well as the degree to which it's bipartisan. All of that probably signals something for the market. Tim Seymour, thank you. And we have got just about an hour left of trading in one of the wildest weeks we've seen on Wall Street in recent memory. The broader market's getting slammed today, down about 2%, while Reddit users continue to push up stocks like AMC and GameStop. Much more on these markets coming up.
What we are doing after the reconstruction of the bank is in terms of improving the corporate governance at both board level as well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our stakeholders.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Checking on the markets right now, still lower, though not quite as bad off as they were when we started the hour. Still down roughly 2%. The Dow down about 558 points. The S&P down nearly 2%. The NASDAQ faring the worst. It is down 2%, Lindsay. But next week is another week. What are you looking forward to?
Yeah, it's another big earnings week, too. 106 S&P 500 companies reporting. Two of the big ones I'm going to be watching are going to be Alphabet and Amazon. They haven't done too much over the past 2 months, I'd say. But the report that we got from Facebook showed strong ad spending, so I'm looking forward to seeing what they say in Google there, Alphabet. And then Amazon with the online selling season, the holiday season, too. Really looking forward to seeing what kind of growth they had there. And, of course, the cloud wars will play in that conversation too, but also healthcare too. There's a lot of healthcare stocks reporting.
We'll see if earnings and fundamentals actually move the stocks. You mentioned Facebook and its strong report. It's down 2.5% today, along with Apple and Microsoft, which we were just talking about. Boy, you never know when the rules apply. Lindsay, thank you. That'll do it for Power Lunch. Closing bell starts right now.
It certainly does. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. Stocks falling to close out the week on what's become a very volatile few days of trading. Let's have a look at what's driving the action today. We've got to start with the short squeezes and the retail frenzy, which continues to set the narrative. Momentum plays like GameStop, AMC, Bitcoin are rallying while the rest of the market falls. COVID headlines are also driving sentiment. J&J and Novavax had promising updates, but it's the overall efficacy of the vaccines and new variants that's worrying investors. And earnings have remained on solid footing, and yet the market's setting a very high bar. Visa, Cat, Honeywell all beat expectations, all trading lower today. 59 minutes left of the session. The Dow's down 530. It was down nearly 750 at one point, Sarah.
Coming up on today's show, we've got some great guests for you, including former Goldman Sachs CFO Marty Chavez joins us to discuss the rise of retail trading, the role of social media, and how the regulators should be looking at all of this, what's going to become of the markets. Plus, two crucially important data sets surrounding coronavirus vaccines have come out in the last 24 hours. We're going to discuss the key takeaways, what you need to know about all of it with former FDA Commissioner Dr. Scott Gottlieb. First up, though, let's get straight to the big story of the day and the week. GameStop, Reddit, and the short squeeze that took Wall Street by storm. Joining us are reporters on the subject. Mike Santoli watching the broader market and some of the key players in this week's drama. Kate Rooney has a look at the role of the clearinghouse middlemen in everything that's happened. And Leslie Picker is covering the repercussions for Robinhood. Mike, though, start us off with the broader market today.
Yeah, obviously still a little bit of unstable footing out there. The S&P 500 did bounce off its lows around 1 p.m. Actually, twice was below 3,700. Found its footing there for a while. We have had a modest bounce since then. But what it did with this little pullback, it got to about a 4% decline off the highs, is it took us all the way back to really early December levels. I mean, it's surprising that you could have swept away that much of this grinding rally in that short amount of time. But that's how this usually goes. The prospect for a pullback builds and builds, and then you finally get it. So far, we're still challenging this 50-day moving average. We cracked through the 20. So it's still one of these checks in terms of, is the uptrend intact? It seems intermediate term, yes, it is, but it wouldn't be surprising to see things kind of chop around a little bit more. We definitely have big portfolios trying to react to this idiosyncratic source of volatility from a lot of these story stocks. They want to take a look at the bond market because I do think it's relevant. Right here in white is the high yield bond ETF. Really not a lot of volatility here at all. It's been pretty steady around the zero line all week. This is the price of intermediate term treasuries. That has declined, which means treasury yields are higher. This is not turning into a macro stress event. This is not disturbing assumptions about credit risk or the economic environment, at least not by the bond market's estimation. That's probably a supportive factor for equities as well. Take a look here at some of the stocks right at the center of what's been going on. The publicly traded retail brokerage stocks have had a rough time of it. This is just for this month. And so you see Interactive Brokers, Charles Schwab, This is Broadridge. This is a middleman. They do clearing, and they sort of also have come off the boil. So it's not as if there's dramatic moves, but you would think with very high volumes, these companies should be doing much better, especially Broadridge. It's unclear if it's related to this. I did put Virtu in there as well. That is now up 10% this month. Had a big run the last couple of weeks. Electronic market maker, high-frequency trader, very much a competitor to Citadel and these other electronic market-making firms we've been talking about that handle a lot of the retail order flow. Obviously, things are good for them, guys.
Mike, thanks for that. Stick around. The role of clearinghouses in the week's frenzied action being closely examined amid backlash towards brokers for limiting some types of trading. And Kate Rooney's got the details of that part of the story for us. Kate.
Hey, Will, Robinhood made the decision 2 years ago to get rid of the middleman and clear and custody those trades in-house. I'm told this was really the first domino and what's key to watch in restricting trades this week. This, at the time, was a major investment. CEO Vlad Tenev told me a couple years ago that it would help them expand quickly. He likened it to Apple deciding to build its own chips or Amazon investing in fulfillment centers. So instead of relying on a third party, Robinhood settles and clears customer trades and provides custody for assets. That also, of course, gives them a bigger slice of the revenue behind trading. But it also raises the bar for how much money Robinhood needs to have in-house to meet those capital requirements. They need to send cash daily to the Depository Trust Company Corporation, or the DTCC. And that, of course, can change on a dime based on trading volumes. I'm told the DTCC significantly increased the amount firms needed for margin calls, especially on GameStop. Robinhood told CNBC repeatedly that this was not a liquidity issue. The moves, they said, were preemptive. Reminder, though, this did include a $1 billion fundraise this morning from Sequoia and Ribbit, who were existing investors. They also had to tap their banks for a line of credit and told some customers that they may need to close at-risk positions. Guys, back to you.
Kate Rooney, stick around. We also want to get to Leslie Picker for another angle on the story. Leslie, the intense backlash that Robinhood is facing as a result of all of its actions this week. What's the latest?
Yeah, intense indeed, Sarah. Of course, Robinhood putting ticker restrictions on a host of names once again after freeing some of those names for trading with limitations earlier. And when Robinhood first did this yesterday, users became enraged. They became distrustful of the commission-free brokerage that promised to democratize finance. And Robinhood says they made this move as a risk management necessity due to volatility in certain names. Brokerages like Robinhood have to be able to post a certain amount of cash to meet SEC net capital obligations and clearinghouse deposits, as Kate was just outlining. Now, CEO Vlad Tenev said on CNBC yesterday he assured the market that there was no liquidity issue here, but it really does seem to be pulling all levers to get cash. We've heard from sources they're drawing down hundreds of millions of dollars in credit lines from JP Morgan and Goldman Sachs to shore up the balance sheet. Company raising an additional $1 billion from Sequoia and Ribbit, not to be confused with Reddit, the forum where these stock tips have been shared. And now, earlier this month, Robinhood was deep in preparations for an IPO. I've checked with sources on this, and no surprise, those preparations have been deprioritized for the time being as Robinhood tries to put out fires on a multitude of fronts, guys.
At the same time, Leslie, the regulators are saying we're paying attention. The lawmakers are starting to talk about holding hearings. I mean, everyone is jumping on this. Where does this go? Is it about regulating firms like Robinhood more closely, maybe making them put up more capital, about finding market manipulation? What are they after here?
Yeah, you're right. And there's also a class action suit that's been filed against Robinhood as well. So clearly not a good time to be going public, or unless you want an S1 that's 1,000 pages long. But to your point, where do they go from here? I've been talking to people about what needs to take place in terms of regulation. What are people looking for? What are people calling for? Part of it could be related to margin and leverage that's allowed on their platforms in order to ensure that they don't need to seek this kind of rescue financing in the future, in order to make sure that they have a fortress of a balance sheet to you know, kind of minimize the potential risk to the system. So that's one thing to consider, although I don't know if it's going to take place. It all depends on how these things really work out over the next weeks and months and maybe even years.
Kate, is there any sign of what the next set of targets might be for the Wall Street Bets chat group? I mean, clearly over the last couple of weeks, it's been squeezing the shorts. Before that, it may well have just been going long some key names like Tesla and Bitcoin. But even if we don't see losses materialize, which some expect will be the case in the likes of GameStop, what happens in the next couple of months when all of the sort of high-focus shorts have been squeezed? What are they talking about their next target investments being?
It tends to be some of these consumer names. You have things like AMC on there and whatever's getting a lot of buzz in these chat rooms. So regardless of the fundamentals, you might have something that attracts a lot of attention through a meme and it kind of goes viral, and it really is tough to say who the next target is if it's not a highly shorted stock, which has been the target in the past few weeks. But you've seen names like Virgin Galactic. Tesla has been huge on that forum, NEO. So even some just companies that have attracted consumer interest and retail interest have become huge, and they do see this sort of momentum. Peloton's another big one, names that people know and want to trade. So in some sense, it is sort of the Peter Lynch school of thought that, you know, buy what you know. That is definitely happening right now on Reddit.
Well, if the retail traders walk away now, Mike, they can say, we won, look, we changed the game, we made the stocks go up, but they're obviously holding on, and these stocks continue to surge. When does that stop? It can't go on forever, right? Is it when the options expire? Is it when these companies report earnings, I think, in the next week, which are not expected to be blowout numbers? This is obviously not about the fundamentals.
Right.
When does the music stop?
There's no real way to handicap that, but I do think it's important to recognize just exactly how much constant new fresh buying would be required to keep these things going in the stocks that they have been playing. Just as an example, the average price paid for GameStop shares today is like $320. The average price paid 2 days ago before the halt was over $300. In aggregate, anybody who bought in the last couple of days is underwater. You know, I said in aggregate. So in total, this community, whoever the buyers were, it takes a lot to stay with that, and it takes a lot of additional follow-on buying to satisfy that process to make it seem like a good bet. So usually that's why these things burn themselves out when they've gone up this much. So I don't think it's a matter of they're going to go away. I think this is a feature of this market, new public enthusiasm using new tools. One of the aspects that we're grappling with is the volume of it, and the volatility of the stocks that are being played so heavily has just overwhelmed the plumbing of the market for now. I actually think that the most plausible and maybe least satisfying and least popular position is that there are no heroes, there are no villains. This is just a phenomenon that has played out in a very high friction way, and probably we're going to have to create new parameters around it.
Well said. Guys, thank you. Mike, Leslie, and Kate. We're going to all stay on it. After the break, we're going to continue this conversation about the short squeeze frenzy, the rise of the retail trader, and today's big sell-off when we are joined by former Goldman Sachs CFO Marty Chavez. You're watching Closing Bell here on CNBC. Dow's down a little less than 500 right now.
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong, so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
Divided by distance, united by business.
This is the new reality we're all
Helping you navigate the new normal. Squawk Box on CNBC.
As President Biden stated in his inaugural speech yesterday, he wants to rebuild alliances and also then to further strengthen NATO. And we are faced with so many challenges. I don't believe in America alone. I don't believe in Europe alone. I believe in Europe and North America together in NATO. And that's exactly what I'm looking forward to work with President Biden and his team on.
Heavily shorted names that have become the darlings of retail investors and social media this week, like GameStop and AMC, continue to climb today, even as the broader market sells off. Joining us now for a CNBC exclusive interview, Marty Chavez, former Goldman Sachs CFO. Marty, very good afternoon to you.
Pleased to be here, Will. How are you?
Very well, thank you. And we mentioned former CFO there. We should really mention also former head of trading, former head of technology, also played a big role in launching Goldman's tech-driven consumer-faced businesses. So very well placed to talk about these crazy market dynamics. And Marty, my first question on it is a broad one, which is, as and when we see unwinds, we sort of started to see that on the hedge fund side for those that were squeezed, and we may well see it in a few weeks' time for the retail side who are still long some of these names. Can that bring down the entire market?
Well, anything can happen. There's no probability 0 or 1, as you know. I don't see that happening. The crucial point here is that the clearinghouse, DTCC, is following its playbook and doing its job to make sure that all those trades clear and settle.
So you're not that fearful overall, then, it seems like, of a broader market pullback. On the point about the clearinghouses, on the point about some of the brokerages from Robinhood to Interactive Brokers, both of whom's CEOs have been on our air in the last 24 hours. Can you understand their decision to restrict trading? Was that just a sensible risk management decision on their part?
Well, so I'll start by saying I'm not in these markets today and not inside all of those decisions. But as a market professional for many years, I know how the market works. It's important to step back and look at this and see that short squeezes have been with us since the beginning of capitalism. What is different this time is that now we have the viral amplification, multiplication, propagation of memes, thoughts, feelings through social media, through social trading platforms. And that, it seems, is exacerbating, it's speeding up the short squeeze, making them more violent. And so really important that all the market participants, and I mean all, be properly capitalized for this kind of thing. Because otherwise, with these business models that maximize user engagement, because they're selling the aggregate user attention to somebody else, those models, if untrammeled, if left unrestricted, can rapidly erode through capital. The people who run the models have the benefits. Society is left with the downside. So crucial importance for regulators and politicians to work together as they have done in the financial crisis. In the financial crisis afterwards, banks were required to run stress tests and to hold a lot more capital. And we saw during the pandemic that the banks continued to lend, provide liquidity, do what they were supposed to do. That kind of approach absolutely needs to be extended to big tech and people who have these kind of social trading business models.
I'm glad you brought up the societal question. That's sort of where I wanted to go, Marty. For so long, there were calls to get more retail investors and traders into the market, to have them join in and also reap the benefits of a rising market over years after the financial crisis. Is this a healthy way to do it? Are we going to look back on this week and decide that this was better or worse on that front?
Well, Sarah, I've been talking with some of my friends, one of my favorite people, Jim Espo, about the parallels between political populism and capitalistic populism, right? And so it's really important to intervene here in some way because we have entered into a really different regime from the one that we were used to. And they're just, as we're seeing in these risk management decisions, there needs to be capital in the system to count for these kind of extreme events. I am all in favor of the democratization of finance. My whole career was all about, as you know, extending data, analytics, market access, and broadening that out. But while I support everybody's right to day trade stocks, I don't. I rebalance 7 ETFs 3 or 4 times a year, and that's what I recommend to everybody. So let's not call it investing, it's gambling, and with gambling come the downsides, the losses, the potential for addiction. And so we need education. We need a lot to go on here to fix this.
When you take a snapshot, Marty, at all that's happened at Goldman, both when you were still there in a full-time role to now, and engaging with the consumer and the great tech platforms that exist. Is there an obvious next step here to do something like Robinhood as well with the Goldman backing, or the points you just made with the risks and the gambling aspect? Is it something that meaningfully the company has purposefully not taken a step towards?
Well, I'll only talk about the strategy that I know from when I was at Goldman. As you know, I've been away for a little bit more than a year, but it's part of something that we're seeing very broadly in finance, which I will call the API economy. So there are people who are producing products and services. They're wrapping them in APIs so that other computers can access those APIs. That's all part of this great broadening, this great democratization, and Goldman Sachs has been a leader in that. What is so important to keep in mind is that there needs to be regulation. The people who are producing some of these APIs have submitted themselves to tight regulation, and the regulation is important because it curtails the excesses, and it also makes sure that there's enough capital in the system so that society and the system are safe when these extreme events happen. That is the whole point of the capital regulation. The problem that we're seeing really today is a symptom of the fact that that framework hasn't been extended broadly enough to social media and social trading.
Beyond that, Marty, is it also a symptom of what's been going on in the market lately, these areas of real disconnect with economic and fundamentals? We've seen it in the SPAC craze, the IPO voraciousness, and now this retail trading frenzy. What does that tell you about this kind of market that we're in?
Well, this seems to be something that happens in capitalism, right? It goes back to the South Sea bubble. Right? It seems to be a feature of capitalism, and this is why I am a huge proponent of the kind of smart, thoughtful regulation that has been extremely effective post the financial crisis. And as the world changes, as technology changes, as these new tools and platforms create this potential for viral propagation of ideas that didn't exist before, the regulatory regime needs to extend as well. But the same theme, I am highly confident, will work, which is we have to require the market participants to simulate, to imagine these stress situations as the world changes, and continue to make sure that they have the capital to pay for it when things go pear-shaped.
And Marty, just to round things off, given a lot of the work I know you're doing now, how optimistic are you about the way that the digital world can be applied to improve results, whether it's in other areas like education and healthcare?
Well, as you know, all my life I've been fascinated by the idea of, can we build a piece of software that is such a high-fidelity mirror of the real world that we can start to ask questions about that software, and we can perform what might be dangerous experiments, but instead of doing them in the real world, where the downside is extreme, we can do them in a software simulation. I think you could describe everything I worked on Wall Street in that way. I'm still continuing to do that, now applying it in the world of private capital. But the same theme I'm also interested in applying, as you mentioned, healthcare, life sciences. The future of biology and the life sciences is computational. This intersection where we can start to answer questions like, how will this drug affect a human cell? How it would affect a human being or a population? To the extent that we can do that in software, we're going to have unbelievable possibilities, and I'm a tremendous optimist here.
Marty, thanks so much for joining us, and please come back with some more updates as and when you reach those goals that you're optimistic about heading at some point soon.
Anytime. Pleasure to be with you.
Marty Chavez, thanks so much for joining us. Still to come, Novavax and Johnson & Johnson both out with important new data on their coronavirus vaccines. We'll bring you the latest, and we'll discuss today's key developments with former FDA Commissioner Dr. Scott Gottlieb. We're back in a couple minutes.
The Bond Report is brought to you by PIMCO. The Bond Bond Report is brought to you by PIMCO.
I'm Juliana Tattlebaum, and these are the stories you should be checking out on CNBC.com. Investment apps, including Robinhood and Interactive Brokers, have introduced trading restrictions after social media campaigns caused volatile movements in the prices of companies like GameStop and AMC. That story is on the website now. Retail investors have also sparked a rally for joke cryptocurrency Dogecoin. The currency added over $7 billion to German Finance Minister Olaf Scholz following a call with new U.S. Treasury Secretary Janet Yellen. Check out that and all the top trending stories on CNBC.com. And remember, you can follow us on Twitter at CNBCI.
Keep up with the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
Welcome back. Dow's down over 400 points. All sectors are red. Novavax and Johnson & Johnson both out in the last 24 hours with new data about their coronavirus vaccines. Meg Terrell with all the details. And Meg, broadly, it all seems like good news, right?
Yeah, 2 more vaccines showing promising results against the coronavirus. And both of these vaccines were tested in areas that are seeing large numbers of these new concerning variants, and particularly South Africa. Let's start with the J&J results. This is the one-shot vaccine, and they showed variability across regions where they tested it. In the U.S., 72% efficacy with one shot, preventing moderate to severe COVID-19. Now, that declined to 57% in South Africa, giving you an overall global efficacy rate of 66%. But what J&J is really focusing on today, and what experts are pointing to externally as well, is how much they can prevent severe disease, keep you out of the hospital, prevent deaths from COVID. They had 85% efficacy globally against severe disease, and that included in South Africa. We talked with Paul Stoffels, the chief scientific officer from J&J, about comparisons of their figures to the previous mRNA vaccines of 94 to 95% efficacy. Here's what he said.
This study was done at the height of the epidemic across 3 different continents when a lot of transmissions are going and a lot of variants are circulating. So we have been able to show that across that, we got 85% protection against severe disease, 100% protection for death, and 100% protection for hospitalization. And when you look at the challenge of the pandemic at the moment, it's exactly that.
And what you are seeing, though, guys, is Johnson & Johnson trading down there 3.4%. Novavax absolutely soaring today, up 65%. We also talked with Novavax's CEO this morning, Stan Erck, about how their data, which was run in the UK and South Africa, differed from other companies. Here's what he said.
What we have is data that nobody else has. We're the first company to actually have efficacy data against 3 strains.
Now, when he's talking about 3 strains, he's including the prior strain, the B117 strain from the UK, where they saw 86% efficacy, 96% against the prior strain. That dropped down to 49% to 60% in South Africa. So you guys, we are seeing an impact of these vaccines designed around the original coronavirus in South Africa, but still seeing protection and, importantly, against severe disease. Guys?
Just speaks to the fact that we need to get more vaccines to more people to beat these variants spreading. Meg, how quickly can these 2 vaccines get approval so that they can get into people's arms?
Johnson & Johnson plans to file with the FDA next week for emergency use authorization, so we'll see how quickly the FDA then can get together to evaluate this vaccine. In terms of Novavax, those trials were both from outside the U.S. They were interim data, so they need 100 cases in the U.K. to file. They have 62, so a few more weeks till they get that. And then they're talking about trying to potentially use that data to also file with the FDA in the U.S. Typically, the FDA hasn't gone for that. They do have a U.S. trial ongoing. They told me they think not before the end of the first quarter would they get on the market here in the U.S. Guys.
Meg, as always, thanks so much. Time now for a CNBC News update. Sue Herrera's got it for us. Hi, Sue.
I do indeed. Good to see you, Wilf. Here's what's happening at this hour, everyone. In Washington, this year's March for Life was mostly virtual due to the pandemic. About 75 pro-life demonstrators walked to the Supreme Court on the anniversary of the Roe v. Wade decision that legalized abortion in the U.S. In Galveston, authorities have found the body of a Texas A&M student who went missing on Wednesday. Searchers also found the body of a second student who had called to be checked on because he didn't feel well. The cause of his death has not been determined, but officials say there is no evidence of foul play or suicide, and the two deaths so far not connected. The Labor Department has issued enhanced guidelines on preventing the spread of the coronavirus in the workplace. The guidance contains recommendations but does not create any new legal obligations. And Russian President Putin has signed a 5-year extension of the New START nuclear arms treaty with the U.S. The current agreement expires next Friday. President Biden has indicated he would like that treaty to continue. You're up to date, Sarah. I'll see you in an hour. Back to you.
See you then, Sue. Thank you. Still ahead, the memification of the market. We're going to discuss social media's role in all of the crazy trading action and whether this week's moves are just the tip of the iceberg with Vanity Fair's Nick Bilton and Kevin Roos from the New York Times. But as we head to break, check on bonds for you. Yields are mostly higher to end the week. The 10-year yielding around 1.09%, so not seeing the kind of stress that we have seen, say, in the broader equity market. Stocks heading for their worst week since the end of October. We'll be right back.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020 for $12 billion. Very attractive valuation. This provides tremendous value for our shareholder.
Brian Sullivan.
Good morning.
Worldwide Exchange on CNBC.
The first 100 days may be an effective political campaign slogan, but is it a benchmark that matters? Political analysts argue that the first 100 days is still a presidential honeymoon, during which they wield extra influence. According to data from the second half of the 20th century, US presidents fared better with Congress earlier rather than later in their inaugural year. With the exception of Lyndon Johnson and George H.W. Bush, bills that were supported by presidents passed more often than those considered later in their tenure. The percentage of votes from Congress in favor of the president's position on bills, motions, and amendments during that time were on average significantly higher in the first 100 days than the rest of the year. One reason for this, according to political analysts, is that US presidents tend to be strategic in their support for bills likely to pass Congress, partly accounting for the perception of early-term success.
Dow's down over 400 points. Financial stocks getting hit hard today, along with the broader market. Also down sharply for the week. Josh Lipton with a closer look at the names in today's Sectornomics report. Josh.
So, Sarah, even with the pullback today, the financials have been an outperformer in recent months, with several of the big banks making notable gains here. Among them, Citi, Morgan Stanley, and Wells Fargo. They're all up around 40% in the past 3 months. But how's that performance compared to the bank's book values? That ratio, one of the main metrics investors can use to look for relative valuations among the banks. Take a look at Morgan Stanley and JP Morgan, for example, both trading at a value more than 1.5 times their book value. Wells Fargo and Citi, on the other hand, though, have a price-to-book ratio of less than 1, perhaps a more attractive level for traders looking to find some more value. Back to you all.
Yes, Josh, pulled back, haven't they, since their earnings reports because of that strong 3-month performance. Josh, thanks very much. Up next, we'll speak with former hedge fund manager Neely Gilbert about this week's volatile market action and her initiative to promote climate-friendly investing.
To build a power plant is to light up a civilization. To purify a waterhead is to last a hope. To build a trackway is to facilitate connectivity. To develop an algorithm is to offer one more possibility to the world. Shanghai Electric. Beyond Shanghai. Beyond electric.
The German Finance Minister Olaf Scholz has told CNBC that Europe did the right thing by coming together to forge a joint approach to fighting the fallout from coronavirus. However, speaking exclusively to Aneta, Scholz admitted the bloc was acting too slow in its COVID vaccine procurement.
We have to admit that there could have been a situation where Europe would have asked for more vaccines earlier in the last year, but now anyone is working very hard to do the best that we get enough vaccines.
Taking a dive today, the Dow falling below 30,000 earlier in the session. We were down 747 points at one point, still down a little more than 500. McDonald's is the only bright spot in the Dow Jones Industrial. Chevron, Dow, and 3M bringing up the rear. Joining us now, Neely Gilbert, who chairs the David Rockefeller Fund Investment Committee, is also co-founder of the Net Zero Plus Investment Collaborative. Neely, it's great to see you. Before we dive into Net Zero Plus portfolios, just wanted to get your take on the broader market here. The fact that we're looking at the worst week in a few months. We've had this retail trading frenzy. Does it make you question valuations and the overall stability of this market?
Well,
Well, thank you so much for having me back on the show. It's great to be here. 2 points to make about the markets right now. One tactical, one strategic. From a tactical perspective, I'm still positive on the stock markets, but before this pullback, it looked like they were getting pretty frothy. A lot of positive sentiment. The fact that this is the biggest pullback we've had in months when the market's not even down 2% right now, it's healthy for us to sometimes have corrections and to remember that markets can go up and down. So I'm actually even more positive as we pull back here than I was just before. But the point is really longer term. And this is about ESG materiality. And particularly social materiality. Years ago, when economists would talk about income inequality affecting the economy, it was kind of theoretical. But now we're starting to see how social issues really can affect our economy and our markets in serious ways.
I want to talk about how you invest around that. But first, Neil, you did say that you're seeing areas that looked very frothy and that looked ripe for a correction. One of those areas could be places in ESG world. EV SPACs, for instance, have become a hot craze. Did any of those areas that you're looking at in some of your climate initiatives get bubblicious?
I'm really thinking about long-term plays in this space, and I think that we're still in early innings. Think about right now you have the market, private sector in the U.S. setting up for a change, but in a way we're expecting a strong tailwind to come from the public sector and drive these trades forward. Like anything else, there are going to be winners and losers. There's going to be a lot of money lost as we go through this climate transition, but also a lot of money made. And I think that identifying the good portfolio managers, the good investors who can find and price the right deals will matter as much as it ever has.
Nearly 5 or 10 years ago, ESG investing meant launching a specific ESG fund, and that fund would not have exposure to, for example, oil and gas companies. Whereas today there seems to be a slight shift, which is to say all asset managers are all investing in an ESG lens, and that just means engaging with an oil and gas company, for example, to try and get them to change. Where do you stand on that debate? If someone is professing to be investing with an ESG lens, should they be owning an oil and gas company?
Well, when you first think about it from a fiduciary perspective, when it comes to oil and gas, I think we have to ask serious questions about what's going to be the long-term role of fossil fuels in our economy and society. And there are serious questions there that I think have already been priced in the markets. But you're right, there has been a change in the way that investors are approaching this, which is really wanting to identify the companies that are willing to be a part of the transition, to make the changes that we know need to be made, and to offer those companies long-term capital to invest in being a part of the change, and to really give them engagement, proxy voting support, and other things to move forward. We can't just step away from the changes that we need to make in the real economy. Today, a lot of the game is going to be about active ownership. And it's not just for social or environmental reasons. It's because that's how we're going to unlock the returns that come from the innovation that will power us through this transition.
You mentioned that you're really focused on social investing, and obviously this past year has been a wake-up call for things that companies need to do and have pledged to do when it comes to equality and equal opportunity. What's the investment case there? What sort of names do you like when you think about those changes that need to happen?
Well, when you think about social investing, I think a lot of lessons came to us from the COVID economy, where companies that had been paying attention to issues like workforce protection, supply chain management, that companies that were thinking about what were traditionally considered S or social issues tended to outperform because they were prepared for the realities that came to them. And so rather than looking name by name, I think it's very interesting to think on a thematic basis about what are the social issues that will drive returns. And as I said, right now in the markets, I'm really thinking a lot about the role that inequality and social unrest will play in volatility in our economy going forward.
Neely, thanks so much for joining us.
Thank you. It's great to be here.
After the break, what Robinhood's CEO said about the decision to curb some trading this week, plus a look at the biggest tech movers in today's sell-off. Those stories and many more will take you inside the market zone next.
Interactive Brokers charges 1.59% for a $100,000 margin loan. Do you know how much your broker charges? Upwards from 6.82% at Fidelity or Schwab to as high as 7.45 to 7.75% at E-Trade or Ameritrade. Move your account to Interactive Brokers and save at least $5,200 or much more if you're trading big bucks.
We expect the level of activity to go back. Quality of the economic growth will be quite different. The landscape will be quite different. So we are not going back to the pre-COVID world in terms of quality, while we may get back there in terms of quantity by the end of this year.
After becoming a free agent, Shaquille O'Neal signed to the LA Lakers for a 7-year contract worth $121 million. Shaq was at the peak of his career, helping the Lakers to win 3 championships, and in the 1999-2000 season, he was named NBA's MVP, Most Valuable Player.
It was a lot of hard work, a lot of, ups and downs, but I think if you put high limits on yourself, no one could ever cause you to underachieve those high limits. I always said I gotta make it no matter what.
You played alongside the late Kobe Bryant. What was that experience like for you?
We pushed each other to the brink that we both performed at high levels and we was able to achieve great success. Sometimes we either have to focus on the task or focus on the relationship. I was very much task driven, was able to win 3 championships.
Commercial-free coverage of all the action going into the close. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. And today we've also got Capital 2 Markets' Keith Bliss back as well. Welcome, Keith. We'll kick it off with the broader market. Stocks are selling off today, but are currently off their worst levels of the session. We were down almost 750 at one point on the Dow, currently down 583. Still major averages on track for their worst monthly performance worst weekly performance since October. The S&P right now is down 1.8%. Mike, the narrative continues to be driven by the retail mania, GameStop, and some of the other names, which are higher today after Robinhood is letting people trade them. Is that the weight on the broader market? Is that what's causing the declines we've seen this week, today, and the rest of the week?
I would say it's certainly one of the trigger points for what was already a market that was, riding at a high, that seemed like it had fully allocated, long positioning across the board and probably needed a readjustment. So you do have this new source of unpredictable volatility that's coming out of these stocks. A tremendous, tremendous amount of the daily volume has been in a couple of dozen of these story stocks that are moving, 40, 50, 60% a day. That just causes, I think, professional investors to reassess general risk tolerances, and they're selling off some of the easy stuff, the big caps that can, essentially curtail their risk exposures that way. That seems to be most of what's going on. It's hard to derive much of a macro message out of the action this week because it's not following along with a theme, whether it's reopening, whether it's flight to quality, whether it's safety. It really does just seem big cap stuff that we had profits in that seems to be kind of over-owned has been cut back.
Keith, what's your take on all the kind of craziness of this past week, and does it explain and does it justify the broader markets pulling back as they have done today and earlier in the week?
Well, there is some of that, in underscoring what Michael just said, is that you've got the big institutional investors who are riding portfolios with most of their holdings at all-time highs or near all-time highs. So this was a good week. Once the craziness started in earnest in Wednesday, this was a good week for them to just kind of get out of the way and maybe trim around the edges, take a look at some of the valuations within their portfolios, dump out some of the stocks that they've had nice gains on. We're into a new tax year, so that gives them a little bit more flexibility than it would in December or into the end of the year last year. So that's some of it. Again, I don't see, and in conversations around the street, any kind of macro events that are pushing this. The pandemic is still with us. We're still wrestling with vaccine rollout. The economic data was okay this week. And earnings have been broadly good in the S&P 500 relative to expectations. So this is really just, oh my gosh, things are a little nuts. Let me just stand on the sidelines and let all this clear out.
Robinhood, of course, drawing ire from retail traders after halting trades on heavily shorted names like GameStop and AMC yesterday. The trading app has reopened trading on these stocks with some heavy restrictions. Robinhood CEO Vlad Tenev joined CNBC yesterday and refuted claims that the restrictions were imposed for improper reasons, saying it was a regulatory concern.
We made decisions based on the financial requirements, including SEC net capital obligations and clearinghouse deposits that brokers have to comply with. And Robinhood was not the only broker that restricted buying of these securities. This has been unprecedented activity concentrated in a few names. And it's really the first time that I've seen where social media and financial services have intersected in this way.
Interactive Brokers Chairman Thomas Petterfy also echoed that sentiment when he joined us on Closing Bell yesterday. Here he is on why Interactive Brokers also made the move to limit trading.
Partly to protect ourselves, but mostly to protect, of course, to protect our customers, but most of all to protect the marketplace, to protect the clearinghouse. So if there are $10 to $15 billion of losses in there, somebody has to pay them. Will they be able to pay it? It's the big question.
Keith, my question for you on this is not so much about the rationale for why they made these moves, but whether you believe they were seriously under pressure and still might well be seriously under pressure and facing liquidity issues, and how much worse or different the problem might be for those platforms if what all of their customers were trying to do was head for the exits as opposed to buy more of a certain asset.
Yeah, well, Robinhood, just like Interactive Brokers and Thomas Petterfy, what they had to do is they had to balance the regulatory requirements versus the moral requirements of actually shutting down trading, especially when so many of those traders, Robinhood traders, probably came in and got long GameStop up in the 320, 330 range. But they do have regulatory requirements from their capital position. And as Mr. Petterfy correctly pointed out, when you are a self-clearing firm, if all of a sudden you have massive losses in there, the clearing broker, which Robinhood is now self-clearing, they've got to take on the losses. So that's why they really had no choice to shut it down. Of course, it angered most of their constituents and their traders, and they've now severely limited it where you can only buy one share of GameStop to open a position if you want to go long. But it really was a matter of balancing survival versus moral obligation. And the other thing that people need to remember, even if Robinhood still was clearing through their old clearing firm, that clearing broker would have called them up and said, shut it down right now. Take those stocks off of your list, because they just wouldn't have the capital requirements. Actually, being self-clearing gave them a little bit more flexibility, because they were able to go out and quickly raise $1 billion of capital to open up trading somewhat. But, as long as the tsunami continues, they're still going to be under continued pressure, and they're going to have no choice but to limit trading in those names.
Do you see any opportunity here as a trader yourself, Keith? Would you short these names here? It's obviously not being driven by a fundamental case, or just stay as far away as you can.
Well, listen, a stock like GameStop, it's not a $320 stock. I mean, when you look at the actual fundamental business that they're in, often referred to as, the blockbuster of the 21st century, just from their business model. I'm not making any kind of statements about, management or what they're doing. They still have cash on the balance sheet, so they can still survive and maybe redirect their business model. But shorting these names, first off, if you can even get a borrower locate, which is the rules and the regulations of what's supposed to happen, and then the expense of actually borrowing the shares probably doesn't make it, worthwhile. In addition to the fact is that it appears, for me reading the Reddit threads, this is not going to stop anytime soon. So I'm not sure going in here and shorting right here would be the wisest thing. Again, I kind of let the dust settle, let the tsunami pull back out to sea. And then if there's an opportunity, I would go in, because I do not believe the share price of GameStop is worth anywhere near where it's trading right now.
Yeah, or maybe don't say it out loud, because then the mob will go after you. Keith, hang on. We're going to talk big cap tech right now, because those stocks are getting hit hard in today's sell-off. Despite Josh Lipton, some better than expected earnings this week. What's going on?
Yeah, so, Sarah, let's start with FANG under some pressure here. And that, as you mentioned, despite some strong earnings reports from some of these names, like Apple, for example, in the red, that's even after blowing past the street's expectations, still on pace for its worst week here since October. Microsoft under pressure as well. Again, even after posting those strong results, threatening to snap an 8-day winning streak. Turning to the semis, hit hard today and the week. The SMH, the ETF that tracks the chips, on pace for its worst week since March. AMD, Taiwan Semi, and Texas Instruments among the hardest hit in today's trade. Back to you all.
Josh Lipton. Josh, thank you. Mike, what do you make of it? Especially, let's take a stock like Apple after the quarter that it put up and the week that it's had, down another 3%. It's been a rough week.
Yeah, the only real common thread running through these is that they are extremely popular. If you look at any list of the most kind of crowded names in mutual and hedge funds, it pretty much gets you to large cap growth stuff. So beyond that, it's not, to me, a reaction to the numbers. If you look at stocks like Amazon, it actually down 2.3% this week. It's actually firmed up. So I don't think that it's kind of an across the board skimming, but it is trimming back, and it's kind of a what's my next catalyst after Apple had that nice run. It's still 8% off the high. So it's not, to me, telling you that much of anything except what we've been talking about, which is this general repositioning, this idea that we're bracing perhaps for a more choppy period. February is sometimes a rough month. You see the volatility indicators are all telling you, don't relax just yet. And so it's just an easy place to raise a little bit of cash.
Two big industrial stocks weighing on the Dow today after reporting earnings. Seema Modi's got the details on those two names for us. Seema.
Hey, Wilfred, let's start with Caterpillar, which did manage to beat Q4 expectations, but revenue did decline across all segments: construction, mining, energy, transportation. But as CEO Jim Appleby said on the call, it's all about the 2021 turnaround. Bullish comments on China, where it's seeing increased demand for its new excavator despite competition from local players. It's also anticipating a rebound in mining activity. On to Honeywell. Despite falling sales, it did manage to grow its fourth quarter earnings, but aerospace, that's its main revenue driver. It's still a drag, and analysts don't see a recovery till the second half of this year. Both of these industrial stocks have had a big past 3 months as part of this rotation into value, but that has certainly shifted the conversation, guys, to valuation. When you take a look at a name like Caterpillar, which is trading at 34, 33 times forward earnings, and Honeywell at 29 times, Sarah, that's really hinges on this 2021 recovery coming into play. Yeah, the setups are what matters here going into this earnings season. Seema, thank you.
Just under 2 minutes to go in the trading day. Every sector is lower. Mike, what do you see in the market internals?
Yeah, there's certainly negative breath under the surface, as you would expect, with the indexes down as much as they are. About a 3-to-1 down versus up split on the New York Stock Exchange. The volume split is also just a hash right now because you have those story stocks like AMC trading 500,000 shares a day and the stock's up. So don't look at the volumes. It's really much more about other stuff. GameStop itself, take a look at the weekly chart. It's all over the place. As I said, tremendous amount of volumes. It's happened in the 300s. So it really is a lot of people having a high cost basis in this stock, but it is resilient. No chaos into the close at this point. The VIX, very agitated. We're back up, into the 30s. You see the VIX futures, they're also sloping down. A lot of people saying that says just stay on guard because the market feels like there's some kind of untrustworthy vibrations in it, Wolf.
20 seconds left, down 1.9% on the S&P, so we are sliding a little bit into the close of the low. The session on the Dow was down 750. We're back down more than 600 or so, or more than 2% on the Dow. At the close, Sarah, the Dow is down 2% or 630 points. The Nasdaq is down 2% itself, and the S&P just shy of 2%. As you said already, all 11 sectors lower and comfortably so at the bottom of the pile. Energy down 3.4% and tech down 2.5%.
And that'll make it down for the day, for the week, and for the month of January, and for the year. Welcome back, everyone, to Closing Bell. If you are just joining us, I'm Sarah Eisen, here with Wilfred Frost and Mike Santoli, as always, CNBC Senior Markets Commentator. Take a look at how we finished up the day on Wall Street, down 622 points on the Dow. Took another dip lower there into the close. Could have been worse. We were down 747. That is for the bulls. 6 negative day in the last 7, down 3% for the week. Worst week for stocks, the Dow, S&P, and Nasdaq since back in the end of October. There's the S&P down 2%. And for the week, also down about 3%. For the month, down a little less than 1%. First negative month, though, since October as well. There's the Nasdaq down 2%. Technology, as Josh Lipton highlighted, getting hit hard despite better earnings this week from Apple and Facebook. The Russell 2000 index of small caps also closed lower by a little more than 1.5%. For the week, down 4%, so got hit harder than the worst. And we're up about 5.3% in January, bucking the overall negative trend that we saw for the rest of the market. Small caps attracting a lot of attention and love lately. Some of the biggest short squeeze stocks are bouncing back today. Coming up, we're going to discuss whether this reckoning for Wall Street will have a long-lasting impact on investing. First up, let's talk about the market today. Keith Bliss from Capital 2 Markets still with us. Elena Hernandez from Gen Trust and Victor Jones from Doe join the conversation. Welcome, everyone. First, though, I'll turn it to you, Mike, on the action that we saw this week and today, which took us negative for the year. What drove it?
It did. Well, look, I think on the face of it, you don't even necessarily have to resort to a lot of the wild activity that's been happening and all the stocks we've been talking about and the closures and the Robinhood frenzy, all of that. You could say that a fully valued market that was very well loved, that was up 18% from October 30th through earlier this week, was due for some kind of a shakeout, pullback, repositioning hit, and that's what we've gotten. Now, the upshot is you have the S&P 500 down 4% off its highs, down for January. Some people think that's significant for the rest of the year. The stats don't really bear that out. But then you have it hitting this 50-day moving average, which it does in bull markets with some frequency. So you don't necessarily have a good verdict on this, but it's not really out of character for a market that has been running the way it is. Also doesn't mean that this bout is over just because the month ended.
Victor, what's your take on this past week's craziness?
Well, look, we had sent out a note to our customers early in the week saying that we would expect a lot of volatility here. And I believe Mike is spot on. I think there was a better chance, pot odds would say, it's a better chance we hit 30 in the VIX this week than getting down to 15. I do think long term, like for the last 10 years, every single year we've been trading sub 15. That has not happened, obviously, since early part of last year. But the odds sort of favor the idea at rich valuations and earnings reports where you already have high expectations that you could see some profit taken. And I think you saw that. I don't know that anyone could have guessed the catalyst for a lot of this. I think many people thought there would be inflation readings. The number you got this morning from the core PCE number was relatively hot and in line with people's expectations as we go forward. So that certainly added some pressure. You saw the Russell outperform the Nasdaq, and I think that has a lot to do with the higher interest rates. You've seen a positive correlation with the Russell to higher interest rates.
Victor, we were really curious in getting your take on the amazing action that we've seen in GameStop and ANC and some of these stocks that retail traders are piling into and crushing the short sellers. You run a platform like
Yep.
Robinhood, right, that caters to the retail trader. What are you seeing, and what do you make of it all?
Look, it was a pivotal moment for us. It was a very difficult decision. But what we ultimately decided is that believing in market access is not a marketing slogan. It's a principle. And we believe in market access, and we chose to stand on those principles. So we allowed trading in these underlying names. Our clearing firm, though, yesterday notified us midday that they were setting them briefly to closing only, or they notified us they were going to closing only. They reversed that decision. And by the end of the day, we were offering access to the markets. And I want to be really clear. We're not endorsing participation in these names, but we also knew the message it would send to our customer base. We know how they're feeling. Look, this is a generation of people. We share everything. We share our cars, we share our houses, we share our capital, and now they share their strategies. And I think they feel like they're interacting with a group of institutions who are not willing to share the wealth. And we wanted them to know that we were an ally. And for that, they rewarded us with their business. We've done a month worth of account openings in a single day.
But Victor, I think I'm also right in saying that you didn't have to handle anywhere near the same amount of volume in some of these stocks as the likes of Robinhood had to. Can you understand that Robinhood perhaps was forced into making that decision? Or are you saying right here and now that Vlad took a different decision, which he had different options, different paths he could have gone down?
What I'm saying is I understand the risks at play here. I understand that there are very difficult factors at play for these decisions, and they're different for every individual brokerage firm. What I mean by that is, look, going self-clearing in the first couple of years of the business has benefits, but it also has some risks. And I think the growing pains that they found out over the last couple of weeks are the risks of being a self-clearing business. We've partnered with Apex Clearing, the same as our sister brokerage firm, Tastyworks, which allowed us to concentrate on our customers' needs, on their desires, on what they wanted us to do, while also protecting risk to the firm. So the way we've managed our business, we're proud of, and we're proud of the decisions that we made this week.
What are you telling new customers when it comes to trading options? And is that where you're seeing a bulk of the activity, as we've seen around some of these names?
It's actually not. No, 90% of the activity in these Reddit names has actually been stock. And so what we've been doing is concentrating on education. I don't believe restrictions are the answer here. It's informing a new generation of enthused participants. This is a teachable moment here. You know, talking about the fact that these stocks have 600% implied volatility, what that means is to not think about upside possibility, people, because when's the last time you actually walked into the store or GameStop yourself? When's the last time you went to a movie theater instead of turning on Netflix or Disney Plus? The point is, at 600% implied volatility, it means the risk is it could just as easily touch 55 as it could touch 50 on the upside. And we chose to use this as a teachable moment to introduce risk concepts and quantifiable finance and strategies to people. And I think they are appreciating it. We don't know how this story ends, but we are managing the risk as best as we can. And at the end of the day, what we found is people actually responded to not being able to get access to these instruments. They were more upset about that than they actually had the desire to participate in these names. We are talking about managing in our systems 1,000 orders over the last couple of days, each individual day. So the risk to us is minimal, but the opportunity on the upside to inspire a new generation is immense.
Elena, you think this, the action of the last couple of weeks will have a lasting impact on capital markets? In what way?
I think, what's important, it's like you said, Will, the ramifications this is going to have in the markets. I think it brings risk and risk management up front. To Victor's point, that volatility goes both ways, and that it's important that we price risk the right way. I think it's going to keep us with risk, price being elevated, right? We've seen the VIX hit 35 twice this week, intraday. We've had a tough time with the VIX coming down below 20, post and in the COVID world. And I expect that to continue. I also think that you're going to have, now risk parameters to a certain extent change and incorporate this kind of non-fundamental investors that can push, right, the market in one direction. But I think the key of all the things that I think might change going forward is that you might have some struggling companies or struggling business models quote unquote live for longer, because then you have these non-fundamental investors that are, pushing these stocks to levels that, again, when we look at the fundamentals, and I like Victor's analogy to when was the last time you went into a GameStop shop, you realize that they're, overvalued and not at the right place.
Mike, the other angle to this that could impact the market, and something we've been talking around, is who's losing, the pain that's happening out there from the hedge funds. There's been some stories on that already, and will it continue? What's the GameStop short interest at this point? Is it still like more than 80%?
Well,
of the float?
Unfortunately, we only get that data officially every 2 weeks with a 2-week lag. So there's really no way. There are firms that have basically taken a snapshot. The short interest has come down by those numbers, but not necessarily really been cleared out entirely. So the interesting thing is the volume in GameStop has been so tremendous that the other way to actually gauge a crowded short is, how much short interest is relative to the volume. And by that metric, it really isn't anymore. In other words, if you were short and trapped and wanted out, you could get out this week. And so it's unclear if this is going to remain a battleground. It's unclear how much juice is left in that trade. They've found pretty much all the crowded shorts in this market. The losses in aggregate are in the tens of billions, probably, across the industry, across Wall Street in terms of these particular short squeeze stocks. That's a big number for a handful of hedge funds. It's a nothing number for the overall market. That's $35 trillion. So those are the ways I think you could kind of characterize it.
Now, lawmakers in Washington continue to weigh in on the short squeeze frenzy, and Ilan Moy has the latest details for us. Ilan.
Well, Wilfred, the fallout just keeps on coming. Today, it was GOP Senator Josh Hawley claiming that Wall Street has rigged the system against small investors. He's arguing that these retail traders on Reddit have come under even more scrutiny than the financial bad actors who crashed the market back in 2008. And that rhetoric echoes the sentiment we're also hearing from progressives who see a through line between the breakdown in our trust of big institutions back then and what's happening now. Still, the common ground on Capitol Hill is probably going to end there, because Democrats say this is why there should be a systemic solution to the problem. We heard Senator Elizabeth Warren on this show yesterday using this moment to call for a wealth tax. Today, she sent a letter to the SEC requesting information on how it plans to handle the issue of GameStop. And the letter said that the recent chaos reveals a clear distortion in securities markets. Now, guys, the SEC has said that it will protect retail investors when the facts demonstrate that there has been abusive or manipulative trading activity. Back to you.
Ilan, thanks so much for that. Certainly something to keep an eye on in the days and weeks ahead. Keith, I wanted to pivot back to the broader markets. What are you thinking about S&P 500 levels and the key kind of levels to watch from here?
Yeah, well, we had the S&P 500 in our work got oversold actually on Wednesday. It was the first index to go that way with the volatility we had this week. And now all the other major indexes, the Dow, the Nas, and the Russell 2000 have hit those levels today at the same time that the VIX has hit an overbought level. So clearly in the models that we have, we would expect a short-term relief of the selling pressure. Now, obviously, things could continue to draw down from here, but if I were a betting man on some of the things that we look at, I would think the S&P 500 should trade back into the 3840, 3850 level, and also the Dow Jones Industrials, I think, should get back to the 31400 level, somewhere in there. But again, a lot is going to depend upon that. If we continue to see, the Reddit traders, the Robinhood traders, if they're free to roam the trading sphere, so to speak. That could continue to have some people a little skittish about stepping back into the market. Two things that should turn around the market, though, and lend in my thesis is the transports. It's remarkable how that linkage always works. Transports usually lead the Dow Jones Industrials, and they did again. The transports are oversold, and they should bounce back a little bit as long as there's some relief. And the dollar had rallied from its lows and got a little strong, and that's now overbought. And as that relieves, that'll be instructive and constructive for U.S. equity. So I expect all those types of linkages to kind of firm up next week. But again, a lot is going to depend upon what happens Monday, Tuesday. The rhetoric out of Washington, quite frankly, does not help at all. But I would expect it to trade back.
Yeah, dollar up 0.4% this week. Elena, final word to you on where you see the opportunities amid all this craziness and as we're seeing the market pull back here.
Yeah, absolutely. So we have always felt that you have to be proactive, not reactive to this kind of scenario. So in terms of portfolio positioning and how we're looking at the outlook forward, considering we're long-term investors, we have focused on where are the news and where is the data in regards to the speed of the vaccines. We completely agree with Fed Powell's comments this week that the economic recovery will depend in the success and the speed of this project. We got good news from Novavax and J&J this week to add to the supply, right, of vaccinations. So going forward, we have included in our portfolio some recovery trades in the travel and leisure sectors. We continue protecting them in the case of inflation with inflation-protected securities, and then as well as we continue our long in clean energy, and we still are keeping gold in our portfolios.
As well as at the management level, and that across the institution, the DNA of the institution in terms of the transparency, the fairness, and going for the compliance part is very, very important, and which has been done. And I think this has been seen across our employees as well as on our staff.
In the age of digital disruption, get fresh business perspectives on the fast-changing world of tech, innovation and startups from one place. CNBC.com/technology.
Positive news on the vaccine front today. Johnson & Johnson out with trial results of its one-shot COVID vaccine, showing it to be highly effective at preventing severe disease, even with the new variants. Drug maker Novavax also releasing positive data on its trial vaccine. That stock closed up 65% today. Joining us to discuss is former FDA Commissioner Dr. Scott Gottlieb, who also sits on the boards of Pfizer and Illumina and is a CNBC contributor. Welcome back, Dr. Gottlieb. Good to have you.
Thanks a lot.
So the top line on J&J, 66% effective. Explain why you and everyone should hail that as good news when we've had other vaccines, like the one that you sit on the board of, Pfizer and Moderna, at more than 90% effective.
Well, look, this is a very good result. I don't think you can make apples-to-apples comparisons across the clinical trials. They were run a little bit differently. A lot of the subjects in this clinical trial were in South Africa and Latin America, where we know there's different variants circulating that the vaccines aren't going to be as effective against, and that's probably going to read through to all the vaccines. The result, the top-line result in the United States was around 72% effective. We have to keep in mind that the variants that are circulating in the U.S. right now are also different, and there may be some differentiation that make the vaccines a little less effective. We don't know. We're not doing sequencing at scale to really answer that question. The good news about this vaccine is it's one dose. It could be delivered in an austere setting. And the immune protection that it affords seems to be pretty durable. If you look at the clinical trial data from the phase 2 study, and also from this study, based on what we know, the immune cells that the vaccine was generating continued to increase for the duration of the time that they were looking at these patients. So that's a suggestion that the immune protection that it affords may be more durable. And so we're looking at, clinical trial data that tells us what happens in the first 2 or 3 months. We have to also think about what happens in 6 months or 8 months. This is an effective vaccine. The safety profile was good. I think it will be approved by the FDA, and it's a great addition to the market.
So broadly speaking, it sounds like we're worried about the South African strain in particular here. We are starting to get data, as you referenced, J&J, Novavax, Pfizer, Moderna. Overall, Dr. Gottlieb, what is your confidence level in the vaccines that we have and their ability to prevent severe disease against this mutation?
Well, look, I think we had experimental evidence before that suggested that there was a reduction in the neutralizing antibodies against these variants. So it's not a surprise to now see clinical evidence from both the Novavax trial and the J&J trial that, in fact, in the real world, in humans, in vivo, the vaccines aren't as effective against those new variants. I think the good news is that they are still effective against those variants. And so 50, 60% effectiveness is pretty good. Remember, the original clinical trial parameters that FDA laid down in terms of the approvability of a vaccine was it had to be 60% effective. And so these vaccines appear to be more effective against the South African variant, or as effective as the original parameters for approval. I mean, the good news was that the mRNA vaccines were 95% effective. You know, the Novavax vaccine is very effective. The J&J vaccine is very effective against the wild type, against the original form of coronavirus, but they're not as effective against these new variants. We're going to have to reformulate the vaccines. We're going to have to develop boosters. We have time to do that. In the meantime, these vaccines are still going to be effective against these new variants. They're still a backstop against the spread of these variants into the United States, and we just have to get people vaccinated.
How important is it, Dr. Gottlieb, or how much of a game changer is it to have a single-dose vaccine? And will that push the J&J vaccine to the sort of top of the list, as it were, in terms of what we want to roll out and produce as quickly as possible?
My guess is that this vaccine will get thrown into the mix with the other vaccines and used in an interchangeable fashion. It's good to have a single-dose vaccine. It's good that this can be delivered in a more austere setting. It doesn't require the same kind of storage. Remember, there's going to be data coming out looking at this vaccine as a two-dose regimen as well. And so if that data is especially strong, you could see a situation where this gets rolled out as a single-dose vaccine. But people who want to get the extra protection from a second dose could get a booster from this vaccine later on in the year, maybe in the summer, maybe in the fall. We'll see what the two-dose data looks like. But for a single-dose vaccine to have this kind of effect, this kind of a robust effect, and see a durable immunity getting induced, which is a suggestion that it's inducing memory B cells, CD4 and CD8 cells, so it's inducing a broader complement of immune cells. That's a really good good development. And Novavax data looks very good as well. There's a question of whether or not they're going to be able to file for approval on the basis of that UK study, or they'll have to wait for American data. But that looks like a vaccine that's going to be successful as well. So this is good news. We're going to have 4 successful vaccines probably on the market. And J&J, remember, can supply the market. They'll start having doses available in February and March. And so you layer that on top of what's available from Pfizer, the company I'm on the board of, and Moderna, and we're going to have enough vaccine to vaccinate the public. Finally, the federal government, I think, frankly, should option the additional 100 million doses on the J&J vaccine. They should secure that supply right now.
On the topic of securing supply, Dr. Gottlieb, what do you make of the spat between the EU and the UK about vaccine supply that's kind of ongoing at the moment? And where do you stand on whether it's the German health ministry or President Macron today sort of briefing about individual details of certain parts of the data when both the UK and the EU medical authorities have approved the vaccine?
I just lost sound, but I'll just comment. There's going to be more supply coming into Europe. You see some agreements to bring on additional manufacturing capacity. Novartis struck an agreement. Sanofi announced one. So I think you're going to see more supply coming into the European market, which hopefully is going to alleviate some of these issues. I think the issues that you're talking about were particularly with the AstraZeneca vaccine, but you're going to see, I think, more of the companies bringing supply into the European market.
Okay, Dr. Gottlieb, we're out of time anyway, so we'll leave it there. Thanks so much for joining us. Much appreciated. We've got some breaking news on Robinhood. Kate Rooney's got it for us. Hi, Kate.
Hey, Wilf, Robinhood again limiting the amount of shares that customers can buy for certain stocks. We've got a couple new names to add to that list. Beyond Meat, Starbucks, GM. So not the names that we've been talking about. You think of GameStop, for example. There are now 50 names in total on that list. I just spoke to Robinhood. It's not entirely clear why they're adding names like Starbucks. They did say that this has to do with market volatility. They're monitoring stocks by the name. They're looking at each stock and seeing if it fits a certain criteria. We don't have a lot of detail on exactly what that is. They say, though, it is a fluid situation, and they are updating their blog post. But again, the list of restricted stocks now includes 50 names. Back to you, Wilf.
Okay, Kate Rooney, thanks so much for that. Up next, Mike Santoli will have a look at the short interest in the market and what it means for investors. That's next.
The countdown to the close of the US markets is sponsored by IG.
Our strategy is really to go as tough as we could, both in terms of arrival restrictions as well as internal social distancing restrictions, with a view to reduce to a very minimum the number of infected cases in Hong Kong so that all people could gradually go back to normal. We are now going into devising more sophisticated means of allowing businesses to resume.
Matheson, Melissa Lee, Kelly Evans, Our Lunch on CNBC.
We created Karma by really setting out to do something to help people versus just trying to make money.
A visionary rule breaker who's reshaped the entrepreneurial landscape.
It just seemed like the simplest idea in the world. You buy a pair, I give a pair.
Where others see problems, he sees solutions.
He is amazing at being able to recognize when something is not working and pivoting.
And he's only just getting started. The brave ones, Blake Mykowski. CNBC.
GameStop rally rolling on despite today's broader sell-off, with shares finishing the week higher by nearly 400%. Costs and AMC Entertainment also seeing a boost from the frenzy, rallying by more than 1,800 and 200% respectively. With the recent rally driven by users of social media platform Reddit, New York Times' Kevin Roose says this reckoning was a long time in coming. He joins us now for a discussion along with Nick Bilton, special correspondent at Vanity Fair. Very good afternoon to you both. Thanks for joining us. Kevin, I'll start with you in terms of the key takeaways from the craziness of this week. And I guess the first question is, how long can it continue? Are we in a new era where this will become the norm, or if these users experience losses, will it kind of move on to something else fairly quickly?
I think this is the new norm. I mean, I think that the frenzy around GameStop or whatever other stocks Reddit is deciding to pile into today, like those run-ups are going to be temporary. Those stocks will come back to earth eventually. But I think this phenomenon of sort of distributed power in investor, in the investing community, this idea that the internet can sort of seize on something and put enough money behind it to really move markets. I think that's something we've seen happen in other areas of life, that we've certainly seen that in politics and entertainment. So I think it was only a matter of time before it happened in finance too.
Do you think this could have happened, Kevin, this past month without there being significant short positions, i.e. if this wasn't a sort of short squeeze play, would it have had the same effect? I guess the examples last year might be Tesla and Bitcoin to say that it could have had the same effect, but to what extent has that accentuated it? And if those short positions go away, will this also, again, move on?
I think the short positions makes for a great narrative, which is a lot of what is compelling people on Reddit and things to sort of pile into this trade. It feels good to take down someone you've identified as you know, as the big guy or the establishment. And what's really interesting is that short sellers used to be those rebels taking on the establishment, who were the long funds. So it's interesting how that's kind of flipped on its head. But I think that dynamic of sort of, you know, lots of retail investors taking on whoever they decide is the establishment is going to continue, because that's what we've seen in every other place this has happened.
No matter what happens, Nick, do the social media companies, do the Reddits, and it's also happening on Instagrams and Facebooks and other social media sites, do they bear any responsibility ultimately if this ends badly?
I mean, it's a great question. I think that they can't control it. I think, you know, Kevin is completely right. This was a long time coming. I think that and you're not putting the genie back in the bottle. With GameStop, you saw the part of it was as a result of the shorts. With other companies, it's not. With BlackBerry, I mean, look at them. They drove up Tootsie Roll. There was a point this week where they were buying AAGH stock just because it spells out ah. I don't think that there's anything that can be done about this at this point. And I think that any company that tries to stop it, as we saw with Robinhood, quickly becomes the bad guy, even though they were originally there to kind of help these retail investors.
Do you think that, Nick, ultimately the users of the last couple of weeks will get hurt by this, or do you think a lot of them have made a lot of money and that will be their lasting memory from it all?
You know, the funny thing is, I don't think they care. I think, you know, when I've been on the same message boards watching, you know, the Wall Street bets and everything, and they could sell right now and make millions, a lot of them, and they're still saying hold, hold, hold. For them, it's, you know, they're doing it for the lulz. They're doing it because they can, and they're doing it to take on the big established players. You know, what's been so fascinating is that who is the establishment has changed, and that's what it continues to happen across social media platforms, across politics, media, you name it. And I think that it's going to, I don't know how you stop it from continuing.
Well, Kevin, you've been following all these social media platforms for a long time. Usually we come on and talk to you about politics and what we've seen about the Capitol insurrection. How do you think this plays out ultimately for social media? Do you think that it helps these companies grow? Is this a new value proposition for them, that they have these stock trading groups that are gaining a lot of attention, or ultimately is it going to hurt them?
I don't really think it has much to do with the companies at all. I think the people, you know, who work at GameStop are probably as confused as anyone this week. And I don't think it's something that you can really plan for or you know, build into your models for you know, your next couple of quarters. Like it's totally random almost by definition. And I think that actually companies and their investor relations department are going to have to act a lot more like online. They're going to have to think about things like, you know, their social media strategy. I mean, I think Elon Musk, you know, whatever you think of him, he's really used social media effectively to turn sort of attention into interest in Tesla stock and interest in Tesla. And so I think this sort of memification of finance is going to continue, and the companies that are able to harness that are going to do pretty well.
Thank you for joining us. Good angle to talk about. Kevin Roess and Nick Bilton. And by the way, you can check out Nick's new documentary, Fake Famous, premiering on HBO Max on February 2nd, of course, about Instagram realities. Let's send it over now to Mike Santoli, taking a look, Mike, at short interest in the market. Topic du jour.
Yes, Sarah, just trying to portray the scale of this activity right now. Barclays has this amazing data. This is options volume in, first of all, high short interest stocks in general. So there's really only, as I said, a few dozen where this applies. That's the right scale over here in terms of dollars. And just look at how it's just gone completely off what had been the top of the charts before. And if you exclude GameStop, which by far is the biggest contributor, you still have this massive surge. However, if you look at overall short interest in the market across all stocks, it is not that much of a factor. So you still have relatively muted levels of total short interest relative to total market cap. So in other words, it really is localized. It has not ended there. It has not yet been cleaned out. We haven't had the full purge. But for the overall market, it doesn't seem to be much of a driver. That's the overall dollar volume of shorts. But as you see, compared to the total market cap right now, because the market's up so much, it doesn't seem like it's going to be that big of a factor, guys.
Good to know. Mike, thank you. Later on Closing Bell, more on this story. The Reddit user who started it all, the trader who launched the GameStop frenzy and bought in at $5 a share. And Monday, do not miss the former chairman of TD Ameritrade on Squawk Box talking about all of this. We'll be right back here on Closing Bell.
We closed down just over 2% on the Dow, 620 points. The low of the session had been down close to 750. S&P also down nearly 2%. Nasdaq down 2% for the week as a whole. S&P down 3.3%. Still to come here on Closing Bell, the CEO of EY on how much President Biden's nearly $2 trillion stimulus package proposal would boost the economy and the jobs market.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
BBVA says it is planning a sizable dividend policy in 2021. This after posting a fourth quarter profit of 1.32 billion euros. The Spanish lender also announced it will buy back around 10% of its shares.
We have an unparalleled strength in our balance sheet because we sold our U.S. franchise to PNC in 2020 for $12 billion. Very attractive valuation. This provides tremendous value for our shareholder.
It's 11 a.m. on Wall Street, and Squawk Alley is live.
Carl Quintanilla, John Fort, Squawk Alley on CNBC.
Time for a CBC News Update with Sue Herrera. Hi, Sue.
Hello, Wilf. Good to see you. Hello, everybody. Here's what's happening at this hour. Dr. Anthony Fauci saying he hopes to start vaccinating children by late spring or summer. He says it's needed to achieve herd immunity. Vaccines have not yet been approved for children, but Dr. Fauci says data is being gathered. The CDC reporting a big acceleration in vaccinations with nearly 1.7 million Americans getting shots since yesterday, bringing the total to almost 28 million. France says it is closing its border to people from outside the European Union to stop the spread of the new variants and prevent a third national lockdown. The new measure goes into effect on Sunday. And in Seattle, a late-night rush to get people vaccinated after a freezer storing more than 1,600 doses of COVID vaccine broke. Clinics sent out urgent messages and people responded by the hundreds, some in pajamas and robes. Get the shots before the vaccine expired. You are up to date. That's the news update, Sarah. Have a great weekend. I'll send it back to you.
What a time we live in. I hope they used all those shots. Thank you. You too, Sue. Have a good weekend. Up next, President Biden and Treasury Secretary Janet Yellen calling for swift action on coronavirus relief funds. The CEO of EY joins us next with what it could mean for the business community and the economy. And as we head out, another look at the Dow today. It closed down 620 points, 2% amid the GameStop trading frenzy. Closed down almost 3% for the worst week since back in October. Closing bell, we'll be right back.
Tomorrow is just waiting to be created, to be reinvented and redefined. And it's those who dare to push the world forward, discover and reshape markets, and embrace the possibilities of data that will reimagine our potential and transform society as we know it. With new ideas and new technology, get there with NASDAQ.
On Squawk Box, Chevron CEO Mike Wirth, earnings insight, new momentum in the energy sector, and the outlook for demand, what investors need to hear now.
President Joe Biden meeting with Treasury Secretary Janet Yellen earlier today, calling for swift action on coronavirus relief.
We have learned from past crises the risk is not doing too much, the risk is not doing enough.
The President's American Rescue Plan will help millions of people make it to the other side of this pandemic. And it will also make some smart investments to get our economy back on track. I want to emphasize the president is absolutely right. The price of doing nothing is much higher than the price of doing something, and doing something big.
Let's bring in EY Global Chairman and CEO Carmine Di Sibio. Great to have you back on the program, Carmine. We wanted to ask you about stimulus off the bat because you have a good lens into corporate America, doing accounting and consulting for so many different companies across a wide swath of industries. How badly does this economy, in your estimation, need almost $2 trillion more of stimulus right now?
Well, I think, Sarah, thanks for having me, by the way. It's always great to be here. And I do think the economy does need stimulus. It's something that's incredibly important to small businesses in particular as we go forward. And around the world, the economy is poised for a really big recovery as soon as we can get past the COVID issue and pandemic. And, you know, this week, many CEOs, including myself, we had a lot of virtual meetings as opposed to being in Davos. And there is excitement for the second half of 21 as the vaccines get rolled out. And I do think stimulus is needed now, though, in the U.S. and in other countries as well, mostly around small businesses as well as sectors that have been really hurt by the pandemic. So I think it's the right move. The amount is something that needs to be debated, I guess, but it certainly will help at this point.
You've also been talking a lot about climate and how that relates to some of your business decisions. It does seem like something the White House and big business is increasingly aligned on, Carmine. So what are you expecting from the administration as far as specific policy actions? They canceled Keystone XL pipeline, rejoined Paris climate. What else is going to affect you and the business community?
Yeah, first of all, Sarah, let me just say on climate, the companies, and in particular U.S. companies, are getting on board. So the private sector, that was one of the biggest parts of the conversation this past week, is around climate. And we at EY actually announced on Monday that we will be net zero by 2025. That's 2025. You know, many companies, you know, are announcing 2030, 2040. And obviously for us, it's a bit easier than, let's say, a General Motors. But that's a big step. It's a leading step for anyone in professional services, net zero in 2025, and we will be carbon negative from 2021. This is something we had planned for several months now. We were carbon neutral in 2020. We think it's so important, and we're advising our clients very similar to what we're doing. It should all be part of your strategy in terms of how you move forward. And this is not just about oil and gas. I know we talk a lot about oil and gas in the sector and you know, and new energies and so forth, but everyone's going to have to do their part. All the sectors are going to do their part. And I do think the Biden administration is on this with the appointment of John Kerry. I really feel that something has changed in terms of the U.S. in general. And even before the election, private companies in the U.S. And public companies, they were on board. Something has really changed. Obviously, Europe was ahead, but now companies are all announcing plans to be really in alignment with the Paris Accord. And I'm glad that President Biden will re-sign the U.S. to the Paris Accord. But it's something that is top of mind. It's something that's important. It's important, obviously, to young people and to younger generations. But it's also, Sarah, important in terms of making money going forward. Things will shift. And just because we want a sustainable economy doesn't mean that you're not going to be able to make money through a sustainable economy. And that's what we're really advising a lot of clients on, is how do they take advantage of this? So if I give an example, consumer products, let's just take, you know, any kind of consumer product, labeling how much carbon that product, what it takes to make that product is going to be something of the future. And younger generations are going to buy products that frankly, take less carbon, that are better for the atmosphere. That's happening already in all surveys that we do with younger generation, but it's important. So my message is, this is not just about, you know, it's about making money, but also about saving the planet.
To what extent have you been able to bring forward some of those targets that you mentioned by scrubbing out or reducing business travel, particularly international business travel, the sort of Zoom revolution of the last year has enabled, as opposed to it really being driven by climate mentality?
So Will, thanks for that question. And that's when we say net zero, that's obviously a defined term. You can't just buy offsets to whatever carbon emissions you're putting out. So we are going to get there, to get to net zero, by reduced travel. And we have that very modeled out for the next 5 years. We're going to go off the base year of 2019, but we are going to reduce our overall emissions by 40% and our business travel by 35%. That does not mean that we don't believe in travel or we don't believe in in-person business. We do. We really believe in a hybrid model. But to make this very real, in our model, we actually have a year where travel is going to go back to close to the 2019 levels because there's pent-up demand to travel and for our people to travel and be with clients and so forth. But then from there, it would scale down. What's important, though, is that our client travel in the model is really a reduction of 5 to 10%. We'll see how that moves along. But our internal travel, and the example I give is if you run a group that's either national in the US or global, and you had 4 meetings a year, once a quarter, there's no reason why you can't have 2 virtual and 2 in person. These are some of the things that we've learned by living through the pandemic and operating virtually, and we certainly don't want to lose that.
Carmine, thanks so much for joining us. Much appreciated.
Thank you. Thanks so much.
Still ahead, Amazon, Alphabet, and the other big names on deck for next week, all reporting their numbers. We'll discuss what to expect.
The world needs to pay attention to climate change and the broader sustainability agenda.
At Walmart, we're working in 4 areas specifically: climate, nature, waste, and people.
We have set a vision, one planet, one health, which means that the health of the planet and the health of people are interconnected.
Tackling climate change is essential to deliver the prize of a more prosperous, equitable, resilient, and sustainable world.
When the future first arrives, we often don't recognize it. Interactive Brokers founder Thomas Petterfy brought the future to the floor of the American Stock Exchange in 1983. The company had fabricated Wall Street's first mobile computer, and it changed finance forever. Today, Interactive Brokers continues to push finance forward by building the latest technology you need to increase your success. Move your account to Interactive Brokers.
The German Finance Minister Olaf Scholz has told CNBC that Europe did the right thing by coming together to forge a joint approach to fighting the fallout from coronavirus. However, speaking exclusively to Aneta, Scholz admitted the bloc was acting too slow in its COVID vaccine procurement.
We have to admit that there could have been a situation where Europe would have asked for more vaccines earlier in the last year, but now anyone is working very hard to do the best that we get enough vaccines.
Rebellion, the traitor who turned the world upside down, officially going on the record. What he had to say about GameStop's major market rally, straight ahead.
We expect the level of activity to go back to the pre-COVID period towards the end of this year or early next year. What we believe is that even if we get back to the numbers that we have seen pre-COVID, the quality of end of this year.
the crisis, volatility, relief efforts, economic impact. Understand what's moving and why. Squawk on the Street on CNBC.
The news cycle is racing along. We have to be checking every bit of it along the way, because one false narrative can change the course of how we respond to this pandemic. And we can't let that happen. We're going to do our dead level best to get it exactly right and never tell people how to think about it.
The Reddit user behind the GameStop frenzy weighing in on the moves in an interview with the Wall Street Journal today. Keith Gill is his name, known as Deep Expletive Value on Reddit and Roaring Kitty on YouTube, telling the Journal he's a, quote, normal guy, and expressed a sense of amazement about what has happened, saying, quote, I thought this trade would be successful, but I never expected what happened over the past week. He also said the story was, quote, much bigger than him, and he supports retail investors and their ability to make a statement. Gill's mother also weighed in on the article on her son's newfound fame, saying, quote, he always liked money. Gill telling the Journal he first got into GameStop back in June 2019 when the stock was about $5 per share. The stock finished higher today at $325 per share. And guys, what I found interesting about his article is he wasn't looking to start a movement, even though that's obviously what it became. And for all the people who say this isn't fundamentally driven, well, Gill's original rationale was very fundamentally driven and correct. He said that people were saying this is the next Blockbuster, and he just didn't see it that way. He thought that there was an opportunity here for the retailer and that it looked cheap, right?
I mean, some distance from the move from $5 up through, I don't know, you want to call it $40, you want to call it $50, whatever the number is, there absolutely was a fundamental case. Michael Burry, the Big Short of Big Short fame, was also somebody who was long this stock. But at some point it got detached from that, and now it's mostly about a short squeeze, which absolutely made this an upside-down situation and made it a very asymmetrical bet for those people who are willing to come in and buy it and try to, contribute to a squeeze. So there's no doubt about it that this company made it through 2020. It does not have a terrible balance sheet. It's not as if it's out of cash. So I don't think that it ever was a great bet to go to zero, as maybe some of the shorts we're looking at. But at 325, it's a totally different animal than whatever, a CFA accredited value investor thought he was buying.
Mike, when we look at the likes of Apple down 5% for the week as a whole, after, of course, reporting blowout strong numbers earlier in the week, and lots of tech names and others reporting next week, was Apple down because of the GameStop frenzy or down because of a buy the rumor, sell the fact thing on strong earnings?
I think it was mostly down in this general move of people just pulling in some of their winning bets. I think the numbers were fine. Maybe they were discounted by the run-up in the stock before we got to those numbers. But really what's going on right now is this repositioning shock it's kind of vibrating throughout the market. And that's most of the explanation, I think, for what's been happening all week.
Deep expletive
And Wilfred, I apologize for calling them a mob. They're not.